Okay, so hello students, welcome to QuintEdge. This is CA Krupang Purohit, and with this video, we have brought for you the revision of the entire FM syllabus in a single video. Okay, so what we are going to do here, we are going to discuss few things about this video. Okay, what is the target attempt, what are the materials to be used, and how you can use this video very effectively. Right, so please pay 100% attention. So first of all, the target attempt over here, like for the upcoming exams, we have March 2026 and the June 2026. Right. So definitely, if you are going to give your exam for March 2026 and June 2026, you can use this video, okay, for your FM revision. But if there are no syllabus updates in FM, right? Generally, there are no syllabus updates in FM. Like this year also, there was no syllabus update. So if there are no syllabus updates for FM, okay, then you can use this video, okay, for September 26 and beyond. But whenever there is going to be a change in the subject, we are going to bring the new video. All right. So this is the target attempt. Now talking about the material. So over here, the QuintEdge students, okay, if you have already enrolled for FM with QuintEdge, you already have the material. So that is the base material for this entire revision video. But if you are someone who has not enrolled for FM with QuintEdge, okay, then what you can do is you can keep the ACCA study hub, okay, ACCA study hub parallelly along with this video. Okay, you can keep the ACCA study hub open parallelly along with this video, okay, and you will be able to revise your entire syllabus. Now, how to use the video effectively? Number one thing, okay, this video is not a replacement of the entire course, right? So it is not practically possible to discuss the entire syllabus, everything in detail in a short video. Like this is around 10 to 12 hours of video, okay, for the revision purpose. So definitely it won't be possible for us to cover the entire syllabus, right, within 10 to 12 hours, but this is for the revision only. Okay, so if you are someone who has already studied FM, then you should be using this video in order to revise your concepts. Right? What you should be doing is, whatsoever is the material which you have used in order to prepare for FM. Okay, just like once you have gone, I'm believing that once you have gone through the entire syllabus, right? Entire syllabus, once you have covered. Even if let us say you have not covered the entire syllabus right now, and now you want to study, then what you can do is watch the revision video once, right? Watch the revision video once and then read the material, right? Even if you are, let us say, using this video for revision, what you need to do is watch the video first and then read the material, right? And try to cover the entire video, at least thrice. Okay, what happens is, if you revise while using a video, okay, there is someone, like you feel that there is someone along with you, right? When you do the revision on your own, it becomes little difficult. That's why the revision videos are very helpful. So what you should be doing is target the sections. Okay, we have divided the video into sections. Okay, investment appraisal, then you can go for cost of capital, then you can go for the working capital. Okay, so investment appraisal, all the chapters, right? Watch the revision video for all the chapters. Okay, so in our syllabus, we have kept the investment appraisal from chapter number 3 to 7. So what you need to do is watch the entire section of investment appraisal and then start reading your material for the investment appraisal. As I have said, you can use the ACCA study hub if you are not a QuintEdge student. Those who are those who have already enrolled for FM with QuintEdge, you already have the material and you have to keep the PDFs open for chapter number 3 to chapter number 7. But as I have said, you have to go through this entire video at least thrice. Right? That will help you to make your concepts stronger, right? When you go through a particular topic once, okay, you have understood that topic. When you go through that topic for the second time, okay, what happens is you generate some kind of familiarity. You increase the familiarity with that particular topic. And when you go for that topic for the third time, okay, then that topic goes into your like long-term memory. So this should be the strategy, that you should be going through all these things for at least thrice. Now the problem over here is that you cannot take this as a replacement of practice. Okay, you have to do the practice. So if you are someone who has just studied the study material, okay, the PDFs you have read, or the ACCA study hub you have read, okay, but you have not done the practice yet, then that is not a replacement. Revision is not a replacement of practice. Okay, what you should be doing is, while watching the entire video for the first time, along with the video, what you should do is start doing the practice questions. So for example, you have watched the entire video for this section only. Okay, don't watch the entire video at a stretch. Watch the entire video content for investment appraisal, and then what you need to do is just start solving the practice questions along with the video. Okay, solve all the practice questions that you have, okay, along with the video, and then you can move on to the next section. Okay, and then once you complete the entire syllabus, then go for the second revision, then go for the third revision, right? And at that time, second time and third time, what you need to do is, whatsoever are the toughest questions that you have marked in your first round of practice, those questions you should be doing again on the second and the third round. Okay, this should be your strategy. After completing the entire course for 3 times, you can go for the mock exam, practice exams. Okay, so definitely this is, like, you might feel that, sir, this is too much, right? I have never worked this hard, right? So that is not an excuse which you should have. Okay, this is a professional exam. You have to work hard. You have to watch the videos, revision videos especially, at least twice, thrice, and that will increase your conceptual clarity. All right, so wish you all a very best of luck. Okay, if you need anything from us, if you need any help, just write your like whatsoever doubts or queries are there in the comment section, and we will try to answer as many questions as we can. All right, thank you everyone. Best of luck, best wishes from all of us. Okay. All right, guys. So let us begin with the revision of entire FM syllabus. Now, first of all, we have this chapter number 1 and chapter number 2. Now, these two chapters are very basic and are mostly theory part only. So I'm not covering these two chapters in the revision. Okay, for like in chapter number 2, we had the macroeconomic policy, we had the fiscal policy, how governments use it in order to control the supply of money in the economy, and how they try to control the recession and the inflation, and all those things are the part of it. So I'm not covering the theory part of these two chapters right now, okay, in this revision session, and we'll be focusing more on the practical part so we can do the interlinking of all the concepts. So if you guys have any questions related to these two chapters, you can later on let me know later on, and then we will discuss that. So starting with the first section of our syllabus, which is our investment appraisal. So as we know that we can divide the entire FM syllabus into different sections. One of the section is investment appraisal. Investment appraisal. And now investment appraisal, we have our chapter number 3, 4, 5, 6, and 7. All right. And now investment appraisal is directly linked with the another section, which is valuation. Okay. There is direct linking between valuation, which is chapter number 18. So first of all, the first segment of the revision will be focusing on these chapters, starting with the investment decision part. So over here, just focus on the screen. No need to open the PDF, right? The main, like, there are different metrics through which we can do the investment appraisal. We can approve whether we should go for this investment or not. So one of the metrics over here was payback period. Okay, payback period is the very basic technique, right? Payback period is basically going to consider that within how many years we are going to receive our money back. So I don't think anybody would be facing any kind of issue in calculating the payback period. So we're not discussing that in detail. We can move forward to the next technique, which was the ROCE, return on capital employed. So return on capital employed is basically a ratio which is going to tell us that how much return are we generating on the capital that we have invested in the business. So we have to take the average annual operating profit. Now over here you need to focus on the word operating profit. Operating profit. Okay. whenever you are calculating capital employed, see, you are not calculating return on equity, you are calculating the return on capital employed. Now capital employed includes both the things, your equity as well as your, so it will include your total equity plus total debt. So over here you have to take the operating profit. Your operating profit is nothing but your EBIT, earnings before interest and tax. So that is the key matrix that you have to focus on, right, while you are calculating our return on capital employed, ROCE. While we are talking about the initial investment or the total capital, we can use, instead of the total capital, we can use the average investment as well. Average annual operating profit upon average investment. So your average investment will be initial investment plus the scrap value divided by 2. Now, we had a detailed discussion what is the logic behind taking the initial investment and the scrap value. But if you have forgotten that logic, right now all you need to do is you just have to remember that instead of taking the total capital, sometimes you can take the average capital. Sir, what is preferable if both is given in the question? If both is given in the question, you have to use the average formula. Average operating profit upon the average capital. If average is not available, or you are not able to calculate that, in that case you are going to use the this formula without the averaging. So average capital is going to be your initial investment plus the scrap value divided by 2. Initial investment plus the scrap value divided by 2. This is going to be your average capital, and above that you have to take the average annual profit. Moving on, this was also an easier method, and now we are going to move forward towards the important methods, which is your discounted cash flows. So we started with the discounting. Like, for starting discounting, we understood the concept of compounding. Compounding, in compounding, we have understood that future value is equal to the present value multiplied by 1 plus the rate of interest divided by raised to the number of period. This is the formula for future value. And all we did was to tweak this formula, and we found out that the present value of a particular future cash flow, okay, future cash flow is going to be 1 plus r raised to n. Now, the entire concept of discounting, there are major different scenarios. Scenario number one, either there is a single cash flow. Okay, you are making a particular investment, and in that investment, let us say you have invested 100 right now, you are going to get, let us say, 150 after 2 years. So you are just going to find out the present value of this single cash flow. That is very easy. You just have to, let us say, the rate of interest is 10%, 150 divided by 1 plus the r of 10% raised to 2. This is single cash flow. Then we can have multiple cash flows. In multiple cash flows, there can be a situation where we are going to have uh, identical cash flows. So for example, from year 1, in the year 0, we are investing, let us say, 100. And in year 1, 2, 3, 4, 5, all these years, let us say we are going to have 10, 10, 10, 10. And in the last year, apart from the return of 10, we are going to, let us say, have our capital back. So over here, these 10 that you are able to see are identical cash flows. Whenever you have identical cash flows, in order to find out the present value, what you are supposed to do, you have to multiply the annuity factor with a cash flow. Okay, annuity factor with a cash flow, and then you have to add the present value of the final, like this terminal value, present value of the terminal value. Clear with this? Any confusion in this? Yes or no, guys? Quickly. Clear?
Yes, sir.
Yes, sir.
Right? So that was the second situation. Third situation over here can be that we have all the cash flows are different. Year 0, 1, 2, 3, 4. All the years can be generating different cash flows. In that case, all we need to do is find out the, so for example, you are investing 100, 1 year it is generating 10, 1 year it is generating 50, some year it is generating 20, some year 25, and in the last year, let us say it is generating 105. as you can see, the cash flows in all the years are different. So over here, what we have to do, we have to find out the present value of each and every cash flow individually. Either we can use the discounting factor, right? We can just multiply the cash flow with the discounting factor using the present value table, or we can just find out the present value using the individual cash flows directly using the formula. So 10 divided by 1 plus the rate of interest 10 percentage raised to the number of period. So this was the, I think I've made a mistake over here. So whatever, this is the present value of the first year. Similarly, you can find out the present value of all the future years and future cash flows, and that will give you the present value of, like the sum of it will be the present value of all the future cash flows. Now, over here, what we have done for investment appraisal part, whenever you have the present value of the future cash flows, okay, we subtract the initial investment from that. We subtract the initial investment from that, and that gives us, can anyone tell me what will it give me?
NPV.
NPV, exactly. So NPV is equal to present values of future cash flows minus the initial investment. This is the formula for finding out the NPV. NPV is the third and the most important method of investment appraisal. Okay, payback period, ROCE, and then NPV. So this is the third and the most important method of investment appraisal. Now we are going to link this with chapter number 18, valuation. This particular present values of the future cash flows that we have found out. Let me use some interesting new color. Let us say this one, purple. So this present value of the future cash flows is nothing but the value of a particular asset, or maybe security, or maybe investment, business, anything. Okay, whatever you are trying to find the value of, okay, whatever class of asset you are trying to find the value of any particular asset, the fundamental value of any particular asset is nothing but the present value of the future cash flows. So when you say NPV, you are trying to figure out that actual value, what is the value of this particular investment that I am making, right? And how much do I need to invest right now in the year zero? You are comparing this, that what is the actual price, what is the fundamental value of this particular thing against what I have to pay. This will give you, so this is one of the valuation technique that we are going to see in chapter number 18, and this is the NPV which is in your this first four chapters, like 3 to 7 in the investment appraisal part. So this was the, and this is the most important investment appraisal technique. Majority of the question, like at least 10 to 15 marks of questions will be there in the examination from this particular segment. Now, this is not a guarantee, but it is that important. Clear till here, everyone? Yes or no? Any questions?
Can you please repeat this last part?
Which part?
The value of the firm.
Value of the firm or asset. This is just a present value. So for example, if you look at these cash flows, if I find out the present values of all these cash flows, so 15, let me just write it in the Excel itself. 0, 1, 2 years. And over here, I'm going to have cash flows. So it will be initial 100, 10, 15, 20, 25, and 105 is the last year. So 2, 3, 4, 5. Okay. Now what I can do is I can quickly find out the, and by the way, if you guys remember, if we want to find out, let us say the rate of interest over here is 10%. So as we have discussed that you can use the NPV function in your exam, okay, but this NPV function, NPV, okay, NPV function is actually giving you the present value. If I use like this, NPV, and I select all these values, you don't have to select the initial investment. This is giving me the present value of the future cash flows. If you want to find out individually, we can. I can directly say present values. Present value of this will be this divided. First of all, let us find out the present value of the future cash flows. This divided by 1 plus the rate of interest. And okay, let me just fix this. As I have told you, that don't use linking. So for example, this one rate, it is going to be common for all these cells. Don't link this over here in this cell. Just type it manually, 10 percentage. Don't link it in the CBE platform. You cannot fix the cell reference in CBE platform easily. So this one you can link. Cash flows you can link, years you can link, because it is going to change when you copy paste the formula. Okay. So that is fine. Now this is the present value of the future cash flows. Okay, 118.79. That is the. Now what would be the NPV over here, Sneha? NPV will be this plus this.
18.79.
18.79 is my NPV. So NPV is nothing but the present value of future cash flows minus the initial investment. But over here, this present value of the future cash flows is nothing but the value of the business. This particular business, asset, security, whatever it is, okay, whatever is this investment opportunity, the present values of the future cash flows is nothing but the value of this particular business, that as on today, its price should be this in the market. Getting it?
So this is the time zero price, right?
Exactly. This is the time zero price. So, when you are getting this opportunity that you are having some particular asset whose intrinsic value is this 118, and you just have to invest 100 rupees right now in order to buy that particular asset, right? You are technically making a profit. It is a good deal, and that's why we approve it in the NPV case. Anything above zero is acceptable as per the NPV. Clear? Yes or no?
Yes, sir.
All right. Now, one major important aspect over here, whenever you will have a question or related to NPV in exam, okay, especially the section C question, you have to comment. If a question like this is available, it is written in the question that calculate the NPV. You have to comment that since the NPV is positive, we can go forward with this project. You have to give your recommendation. You have to comment about the acceptability of the project, whether it is asked in the question or not. By default, whenever NPV is asked in the exam, you have to comment about the acceptability of that particular project. Understood? So, chapter number 4 is all about that, discounting present value, this annuity factor, present value factor, and calculating this. So, one of the concept over here is EAIR, equivalent annual interest rate. So, let us see how do we calculate equivalent annual interest rate, effective annual interest rate. Just a minute. Yes. So effective annual interest rate is basically trying to find out that if you are given a, let us say, semi-annual interest rate, let us say over here, Sarah borrows $100, 2% compounded interest a month. How much principal plus interest will be owed after a year? So we want to find out. Okay, this one is for the principal. Let us use this in order to find out the effective annual interest rate. So for effective annual interest rate, this is the formula over here, that the annual interest rate is equals to whatever is the interest rate per period raised to the number of period. What happened? Chalo. So effective annual interest rate in this particular, there is one more situation for discounting factor that we are going to cover in a while. But let us first of all calculate this. You are given with an R of 2 percentage, R of 2 percentage. All right. Over here, we have to calculate effective annual interest rate. that would be into the bracket 1 plus this raised to the number of period. If it is a monthly rate given to you and you have to find out the annual interest rate over here, you have to first of all calculate the number of periods. So in this case, since it is a monthly rate, there are 12 periods in a month. So what we are going to do is 1 plus this raised to 12. And we have to subtract 1 from it. So that will give me the effective annual interest rate of 26.82%. I hope everyone is clear with the effective annual interest rate. Yes or no?
So,
Yes, Neha?
so in this, why can't we use the cross multiplication? Like if it's 12% for 1 year, how much
Cross
for 1 month?
multiplication. Okay. So in that case, you are saying we can directly do it like this, 2 multiplied by 12. Okay. This is what you are saying. Technically, right?
Yeah, 2% for 1 month. So how much
Yeah,
would
1
be?
month is equals to 2%. So for how much for 12 months? So this is just like this, 2% multiplied by 12 divided by 1. Okay. This will give you 24%, but this is simple interest. Okay. Simple interest. If you are saying this is a compounding interest rate, if you are given in a question that this is a simple interest rate, 2% is a simple interest rate, in that case, you can calculate like this. But if you are given that this is a compounding interest rate, what is it? 2% compound interest a month. In compounding case, you have to calculate like this. Clear?
Yes, sir.
All right. So let us move forward. And now we are going to calculate. Now, while we are talking about discounting, we have seen this compounding in reverse. Discounting is nothing but compounding in reverse. Basically, we have seen the future value formula, and then we have seen how to find out the present value using that formula. And first of all, we have seen simple discount factor. This is basically for a single cash flow. This is something which we have covered already. Then we have then the PDF talks about the time value of money. Investment appraisal, we are going to use two techniques. One is NPV, one is IRR. IRR is the fourth technique for investment appraisal, which we are going to talk about in a while. But moving on, I wanted to talk about all the different types of discounting factors. So this we have talked about. Now the next and the most important factor, okay, it is for, oh yeah, here it is. Annuities we have covered. All right. So first of all, single cash flow is covered. Then identical cash flows is covered. Annuities is basically used for, annuity factor is used for identical cash flows. Okay. Here it is. Identical cash flows, and that is also for a finite period, finite number of years. Over here, if I go back, this was the third situation. Here it is. This was the second situation. Identical cash flows for a finite number of years, single cash flow. And this we have seen that all the cash flows are of different numbers. Okay. All the cash flows are not identical. And now here comes the fourth situation, which is identical cash flows for an infinite number of period. If you are given that a particular project is going to generate identical cash flows, let us say $10 for an infinite number of periods. Okay, the n is infinite. It is going to give you, this particular project is going to give you $10 for an infinite number of period. In that case, how do you find out the present value? In that case, all you need to do is, let us say the rate of interest is 10%. The simplest thing that you have to do is just cash flow divided by the rate of interest, 10 divided by 10 percentage, and that will give you the present value of 100. This is nothing but the value of this particular investment, or I can say the present value. Please keep this in mind. Present value is equal to the value or price or valuation. Okay, this is going to be just like this in the entire chapter number 18. Clear till here, everyone? Yes or no?
Yes.
Yes.
Perfect. Chalo. So now I can say that almost the entire this is covered, our investment appraisal, except the last concept. Chalo. So this was the annuity. See, I'm not covering questions in this revision session. All you need to do is complete the revision session and start doing the questions itself. And I would recommend after the revision, don't do the questions from this PDF because the questions in the PDF are very simple. Uh, like it is for the understanding purpose. All you need to do is section C PDF you have, start with that, or maybe just go back to the questions which you have solved earlier. Okay, and figure out the questions, find out the questions in which you made the mistake, because in the last day we don't have the time to cover all the questions. So next thing is perpetuities. It is something that we have covered just now. Okay, it is identical cash flows which are going to be for an infinite number of period. Moving on, I think this chapter is over now. Just okay, IRR. Now let us discuss IRR. IRR is the last concept, last technique in our investment appraisal. So technique number 4, method number 4, IRR. Internal rate of return. IRR is basically going to tell you, if I just copy this question that we have solved just now, these numbers, let us just copy these numbers. Okay. Internal rate of return is going to give you a rate, okay, a required rate of return at which the NPV is 0. Okay, these are the cash flows, okay, which we used just now. Now, for us, IRR, and the easiest method of finding the IRR is using the function IRR. All you need to do is use the function IRR. Okay. As we know that in CB platform, you cannot have the syntax. When you type IRR, okay, the way I am able to see it on the Excel right now, I can press a tab and I can see the entire syntax. A bracket is also added on its own, but this feature is not available on the CBE platform. What you need to do is you need to type IRR manually. You need to open a bracket. Okay, and you need to remember this syntax, values and the guess. You don't need guess, okay, for your FM syllabus. All you need to do is just values, bracket close, press enter. What happened? Did I make a mistake? Oh, sorry. Yeah, I didn't. Oh, sorry. See, in NPV function, you have to ignore the initial investment, but in IRR function, you cannot ignore the initial investment. Okay, it will give you an error. So that is very important. In IRR function, you have to take the initial investment, bracket close, press enter. And now this is exactly the rate of return. Okay, this is exactly the discounting rate at which your at which your NPV will be 0. Okay, now if I find out the present values at this rate, this will be this divided by 1 plus this discounting rate. I'm fixing it right now, but don't do this in CBE platform. At this I'm doing just for the sake of understanding. Okay, chalo, copy and paste. All right. And by the way, any time, any given point of time, the present value of any cash flow at time 0 should be same only. If you are getting something different over here, that means you have made a mistake. Okay, just check your formula. So this can act as a check for you. That anytime if you're trying a formula for a present value, and if these two values are not same, you have made a mistake in your formula. So check that. Chalo. So now if I have a total of all this, let me just add a row over here. If I have a total of all the present values, it should be 0. Okay, it is 0. It's just the formatting. Chalo. It should be 0. Understood? IRR is the discounting rate at which the present values of the future cash flow. See, this is the present value of the future cash flow. The sum is 100. The present values of the future cash flow is equal to the initial investment, which means your NPV. This is your NPV. Okay, not the sum of the present values. The sum of the present values is this. Exactly 100. Okay. So you can say that this is a magical number at which the present values of the future cash flows will be exactly like our initial investment, and our NPV will be exactly 0. Understood? Yes or no? Quickly. Hello.
Yes, sir.
All right. Others? Divjot, Atharva?
Yes, sir.
Okay. Chalo. So now what we need to remember is that if, let us say, I have given you in the question that IRR of a particular investment is 14.96 percentage. Okay. But this particular investment right now, whichever is given in the question, is able to generate, is going to generate, sorry, is going to generate 14.96 percentage. This is the initial, this is the IRR of this particular project. This is how much the project is going to generate. But your required cost of capital, your required return, whatever investors you have in your company, those investors require, let us say, 16 percentage. Are you going to accept this particular project? Yes or no? Quickly. Hello.
No, sir.
No. Right? Divjot, agree?
Yes, sir.
Perfect. So that is the entire thing over here. IRR and NPV. If NPV is less than zero, if it is negative, we are going to reject a particular project. If IRR, if IRR is lesser than the required rate of return, we are going to reject a particular project, and vice versa. So that ends the chapter number 4 over here. Now, chapter number 5 is all about relevant cash flows as to what are the costs that what are the cash flows which you need to ignore, and what are the cash flows that you need to consider while figuring out these. These cash flows are calculated in real life. There are a lot of calculations done behind reaching to these cash flows. All right. So, what are the costs that you have to ignore and take into consideration? Here is the list. Let us just quickly discuss them. First of all, if a sunk cost, see this is the list of cost which needs to be excluded. If a sunk cost is there, sunk cost means something that you have already incurred, money already spent. So if in a question you are provided that the project's actual cost is $50 million, and out of it $10 million are already spent, in that case you have to ignore this, and you have to take into account only $40 million for considering. If anywhere it is mentioned that money is already spent, you have to straight away ignore that particular amount in order to decide whether to accept this project or not. Non-cash cost, depreciation, we have to completely ignore. If it is given that this is the cash flow, okay, we can never get that cash flow is after before depreciation. Chalo. If it is given that this is the profit of the company after giving the effect of depreciation, let us say 10 million, and in this 2 million depreciation is deducted. So your actual cash flow is 12 million. Okay, in that case, you will need to add back the depreciation. So non-cash cost you have to ignore. Book values, FIFO inventory values, you have to ignore. See, the present values, if you are provided with the actual values, realizable values of particular assets, you have to ignore the book values. Unavoidable cost, that is money already committed. Now see, these two are the most important things: already spent and already committed. If these two words are written in the this thing in the question, then you have to ignore that particular amount. Out of 50 million of the total investment of the particular project, 10 million is something that is already committed. Then you have to ignore that. You have to take into consideration only 40 million. Are you going to be able to recover 40 million from this particular project or not? That is only what you have to consider. Finance cost, such as interest, this is also something that you have to ignore. Why? Because interest is something which is already a part of your WACC, weighted average cost of capital. It is already part of your discounting rate. Weighted average cost of capital, what is it? We are going to revise it in a while, but it is already a part of your discounting rate. Okay, when I am doing the discounting over here for the NPV, right, over here in this particular question, when we did the discounting, We want to find out that are we able to generate a 10% return or not from this particular project. And at that time, we have already considered this is our WACC, this is our weighted average cost of capital. It includes the interest. All right, we are already saying that whether we are able to generate the enough profit from this particular project or enough cash flows from this particular project so that we can pay 10% interest to the investor, which includes your debt holders. So we are not going to include the interest over here. So if at all you are given in a question that, let us say, cash flow for this particular company is, let us say, 10 million after paying $2 million of interest. Okay, then what you are going to do, you are going to add back that interest and you are going to say the actual cash flow is $12 million. If the interest is already deducted, you have to add back the interest. Understood this logic, everyone? Yes or no?
Yes.
Sneha, Atharva?
Yes, sir.
Perfect. So that is what this chapter is all about. But now we are going to talk about the most important part of this chapter, which is TAD, tax allowable depreciation. Tax allowable depreciation. So for that, what we will do is we will directly take a example tax allowable depreciation, and let us start with this example itself. Okay, example number 1, tax allowable depreciation over here. Asset is bought for 5,000 at the start of an accounting period. It is sold at the end of the third accounting period for 1,000. So over here, we are going to hold the asset for 3 years. So let us calculate the tax allowable depreciation. All right, we are talking about the relevant cash flows. Relevant cash flows. All right. And now in that we are talking about tax allowable depreciation. This is very important. Okay. Just I know majority of you who has already practiced a lot, they know how to calculate this, but let us have a very quick revision and then you have to practice the more uh, complicated, complex questions for this particular topic. So an asset is bought for 500,000 at the start of an accounting period. What is the purchase price? Purchase price of this particular asset is 5,000. And then it is sold at the end of the third accounting period for 1,000. So either the selling price will be given or the scrap value will be given. That what is the scrap value of this particular asset after 3 years or 4 years or whatever is the number of period. The corporation tax rate is 30% and tax is paid 1 year in arrears. Tax allowable depreciation is 25%, reducing balance with a balancing adjustment in a year of disposal. This particular line, if it is not written, we have to assume that it holds true. Okay, this is the way how we are going to calculate what is balancing adjustment. We will just see in a while. So over here, purchasing price of the asset is 5,000, which means that income tax is going to allow me the tax allowable depreciation in the first year is going to be 25%. Okay, it is given 25% reducing balance method. So the balance at the end of first year, I would say closing balance at the end of first year is going to be whatever is the remaining amount. Okay, this minus this is my balance at the end of first year. So this is the tax allowable depreciation, and over here the tax savings, you have to create another column of tax savings. The amount of depreciation which is allowed by the income tax, right, on that you are going to save taxes over here, that is 20%, I guess. What is the tax rate? 30%, sorry. So 30% you are saving right now because of the tax allowable depreciation. This is something that you have to take up on the while you are computing the cash flow, and you have to add. This is a positive thing for you. Okay, you are saving this money. So that is that. Now the balance in the second year is this. At the opening of the second year is this. tax allowable depreciation for the second year, you can just copy and paste. This is the tax allowable depreciation. This I can copy and paste over here. This is my tax savings in the second year. All right. Similarly, I can just copy this formula for closing balance. All right. And I can paste it over here. Now, this is my closing balance at the end of second year. Now, recently, what the mock papers that we have taken, many students have directly maybe taken the tax savings over here, calculated the tax savings on the closing balance. Some have calculated the tax savings on the for second year on the opening balance of second year. So be very, very precise, be very, very careful that you have to calculate the tax savings against the tax allowable depreciation. Whatever depreciation the income tax is allowing, right, on that you are going to save the taxes. Now, if you remember, we don't have to calculate the TAD, we don't have to calculate the TAE in the last year, in the year of sales. In the year of sales, first of all, what we will do is we will have the scrap value or whatever is the selling value. Okay, that is over here 1000. That we will subtract, and then whatever is the balance. Okay, this 2800 minus 1000. This 1800 is the balance which we have not taken into our P&L account. Okay, this is a capital expenditure. 5000 is a capital expenditure. This entire thing should go through our P&L. This entire thing should be booked as an expenditure throughout the life of the asset. Out of which we have said that this is our expenditure in the first year, this is our expenditure in the second year, this is the depreciation that we have taken in the books. But what is yet to be taken in the P&L? This is the balance. 2800 is something that we have not booked as an expense in the P&L, out of which 1000 we have sold, 1000 we have received back by selling that particular asset. So 1800 is something that we are yet to book in the books of accounts, okay, or for the income tax purposes. So 1800 is something that we will book in this particular year, and as a result, the tax savings in this year will be 30% of this. So this is going to be your tax savings in the third year. Understood, guys? Yes or no? Quickly.
Yes.
Yes, sir.
Perfect. Chalo. So that is for the second year, and this is the concept of tax allowable depreciation. So with this, let me see what is left in this chapter. With the tax allowable depreciation, other assumptions, tax rate is constant, and assumptions you can go through. You can ignore the assumptions right now while you are doing the revisions. You can just focus, and this is how you have to. Yeah, this is also a TAD question. More tax flows. So before and after discount rate. Okay, before and after discount rate is something that you can ignore at this end moment. Okay, if you remember it, and like at the last, you can go back to this topic, but right now you can skip it. Okay, then comes the inflation part. Perfect. Chalo, let us discuss what is real rate, what is nominal interest rate, and then let us see the questions related to that. Let me just have an overview. All right, so let us do with this inflation rate. So there are two types of inflation rate. One is nominal and one is, sorry. So there are two types of, if we take into consideration the inflation, okay, inflation, there are two types of discounting rates. Okay, one is your nominal rate and one is your real rate. Okay, nominal rate is going to take into consideration the real rate of discounting, which is this, which is coming from here. Okay, and it is going to take into inflation into accounting. Okay, so the way we were given the cash flows in the previous questions, let us say these are the cash flows. Okay, let me just copy it and paste it over here. So basically, while finding out the present values, either you can use the real rate of return, okay, or you can use the nominal rate of return. What is the difference between the two? Real rate is the normal, on an average, the industry rate of growth, what is everyone expecting in the market. Okay, and the nominal rate is going to add this. Nominal rate is going to say the real rate of interest plus the inflation. Okay, this is something that you need to consider. So these are the two different types of rate of returns, discounting rates, which you can use in order to find out the present values. Now, nominal rate of return, how do you calculate the nominal rate of return? 1 plus I, which is your nominal rate of return, I is your nominal rate of return, is equal to 1 plus R, which is your real rate of return, multiplied by 1 plus your inflation. Okay. So if in a question you are given that whatever cash flows that we have mentioned in the question, those cash flows are already inflated, then you have to use the nominal interest rate in order to find out the present values. If you are provided with the real cash flows, which means it is yet to be inflation is yet to be given the effect. Okay. So what you can do, either you can calculate the inflated cash flows. Either you can calculate the inflated cash flows by giving the effect of inflation. How do you give the effect of inflation? Whatever is the cash flow multiplied by whatever is the rate of inflation. Let us say 3% is the inflation rate. So that will be your inflated cash flow. So you can calculate the inflated cash flows, okay, and then find out the present value using the nominal rate of return. But if the cash flows are not so this is the case in case of cash flows are not inflated. You inflate the cash flows and then use the nominal interest rate. Or what you could have done is you can use these cash flows which are already not inflated and use the real rate of return in order to do the discounting and skip this process. Okay, so I'm just drawing a chart over here. If your cash flows, okay, there are two possible situations. Are inflated, you can use the nominal rate of return. Okay, but if they are not inflated, it means they are real cash flows. Whatever is not inflated, you use the technical word for that is real cash flows. So whenever in exam you see real cash flows, that is the cash flow which is not inflated. So if there are cash flows which are not inflated, what you can do is give the effect of inflation. Okay, sorry for the bad writing over here. Give the effect of inflation. Array, inflation. Okay. And then use the nominal rate, or maybe directly use the real rate of return. Clear till here, guys? Yes or no? Understood this logic?
Yes.
Sneha? Sneha, you there?
Sir, I missed the real part.
Okay.
Yeah.
Over here, you can directly use the real rate. Let us say the real rate of return is 10 percentage. Inflation rate, H over here, is let us say 3 percentage. Okay. So in that case, what will be the nominal rate of return? Nominal rate of return will be, so I have to rearrange this formula. I will be whatever is the solution for this, 1 plus R multiplied by 1 plus H divided, this minus 1. Whatever is the solution for this minus 1, that will be your I. So in this case, it will be into the bracket 1 plus the real rate of return 10 percentage multiplied by 1 plus the H inflation over here minus 1. 13.3% is your nominal rate of return. So if it is given in the question that these cash flows are inflated, okay, if they are already inflated, you can directly use the nominal rate of return. All right. If they are not inflated, if they are real, either you first convert them into inflated cash flows, nominal cash flows. Okay, how you can do this? Nominal cash flows is equal to you inflate it. This multiplied by 1 plus the inflation rate of 3 percentage. Okay, you find out the nominal cash flows first, and by the way, this has to be raised to the number of years. Okay, and then you find out the present values of these inflated cash flows using the nominal rate of return, which is this divided by 1 plus the nominal rate of return. Getting it, Sneha, now?
Yes, sir.
Perfect. What went wrong? Oh, yeah, see, fixing the cell reference is important. And that's why I say don't do it in the CB. Use type manually as far as possible. And by the way, if you would have calculated the present value using nominal interest rate, if you would have calculated the cash flows, okay, present values using real rate of return, okay, in that case, this original cash flow divided by 1 plus the real rate of return of 10 percentage. Okay, let me just fix this. F4 raised to the number of period. This also should give you the same present values, because this is the real cash flow which you have inflated, and then you have used the nominal inflation rate. Okay, basically nominal inflation rate is also nothing but the real rate which is inflated. So both of them should give you almost the same result. Understood this? Clear till here?
Yes, sir.
Yes.
Perfect. Atharva, you are following also, right? Yes, perfect. Great. Chalo. So this was the general idea which I've given you. But now there are some predefined rules that you need to follow. Okay, what are those rules? Let us read those rules. See, cash flows are inflated to future price levels using specific inflation rate for each. Okay, this process. Okay, just a minute. If you will come to the real, yeah, here it is. The real method. Okay, the real method. Cash flows are expressed at today's price, which is the real cash flow, that is before the effects of inflation. These are then discounted at real rate, okay, excluding the general inflation. This is something which we have seen just now. Use the Fisher formula above to calculate the real rate from nominal rate and the general inflation rate. If if in the question you are given nominal interest rate and you are asked to use the real interest rate, you can use this same formula, Fisher formula, in order to find out the real rate. If this rate is given, I is given, and inflation is given, you can use that to find out the R. But that will never be done in the question. Mostly it will be other way around only. The most important part, the most important line from this particular segment is this. This method only works if all cash flows are inflating at same general inflation rate. What does this mean? In a cash flow, just look at this. There is a revenue, right? While you are calculating the actual cash flow, relevant cash flow for a particular project, there is going to be revenue, there is going to be cash, cost, there is going to be capex, and there can be multiple line items for cost. If all the cash flows, all the line items are inflating at a same general inflation rate, then and only then you are going to use the real method. Okay. What happens in the nominal method? In the nominal method, each and every line item is inflating at a different inflation rate. There are going to be specific inflation rate for each line item. Sales is inflating by 3%, cost is inflating by 5%, okay, capex is inflating by 10%, and then there will be a general inflation rate. That general inflation rate is something that we are using over here in this formula to calculate the discounting rate. Okay, that general inflation rate is something that we are using to calculate the discounting rate. Otherwise, for cash flow items, okay, there are going to be multiple line items over here. Each line item is inflating at a separate inflation rate. Now, mark my words, okay, keep this in mind in the exam, that in exam you don't have to use your brain. Whatever is the question, use the nominal inflation rate method. Until and unless specified in the question that use the real method, you just use the nominal method, because as I have shown you, right, both the methods are giving you the same result. But if any single line item over here within the cash flows, okay, what we have done right now, please focus 100% attention over here. This is the most confusing part. Okay, chalo, just focus over here. What I have done, I've taken the cash flows and I have find out the nominal cash flows using the same inflation rate. Okay, 3%. All the cash flows are inflated using the same, which means I have taken the general inflation rate to inflate all the cash flows. As a result, the present values are same. But if the individual line items, even if a single line item, scrap value, okay, scrap value is the most ignored thing. If the scrap value is inflating at a different inflation rate, or maybe not inflating at all, okay, if nothing is mentioned in the question about the inflation of the scrap value, you can never know whether it is actually inflated value or it is before the inflation, right? If different line items within a cash flow, revenue, cost, or anything is inflating at different interest rates, at different inflation rates, this is not going to be the same. In that case, it is better to use the nominal inflation method only, nominal rate method only. So in exam, until and unless specified otherwise in the question, that specifically it is said, it is asked to use the real method, you have to use the nominal method only. Okay, so over here also, if this question also you see, not this one, which method to use? This one. See, in this method also, they have used the real method only. If you will read after this session, just do this question. Okay, this question, solve this question. In this question, there is no mention about whether to use real method or nominal method. And by looking at this question, you might feel that we can use the real method in this particular question. But in this particular question, scrap value, there is no mention about the inflation of the scrap value. So you can never know at what rate this is growing. Okay, even though inflation is only general, it is not possible to use real method because not all cash flows are affected by the same general inflation rate. So it is always safe to use the nominal method. What you have to do is, if the specific inflation rates are given for different line items, do inflate at that rate. Okay, if nothing is mentioned, general inflation rate is mentioned for different items, then also inflate at that rate, and then find out the discounting factor, which is nominal interest rate. Okay, which is going to be found out using this formula, Fisher's formula, and you have to find out using that. Clear till here, guys? Yes or no?
Yes.
Divjot, Atharva,
Yes, sir.
perfect. Chalo. So now the last part is the working capital. As such, there is nothing complicated in the working capital, but all you need to remember, the major mistakes that the students are making in this particular area is that when you are given a working capital in the question, let me just see if a question is available. I could have shown you directly. All you need to remember is that when you show working capital negative, so cash invested, see, you have started with 15,000 as the level of working capital required in this particular business. Every year you require this much working capital. Okay, so working capital is basically your investment. So at the beginning of the project, you are going to invest entire 15,000. Okay, that is your cash outflow. In the second year, the total requirement of working capital is 1600 and 16,500. So you just have to add additional cash flow in the business. Your cash outflow is going to be just 1500, and vice versa. And at the end of the project, whatever is the total working capital invested in the business, every year you are investing this is the total working capital invested in the business. That should become your inflow at the end of the project. But if it is mentioned in the question, okay, as recently we had discussed, Neha, that if a particular project is going to be reinvested or repeated after the end of the machinery or after the end of the particular project, in that case the working capital will not be coming back. Okay, in that case you won't have this inflow. Otherwise you have to have this inflow at the end of the project. Clear with this? Understood?
So,
Yes, Neha.
can you show the calculation of this on Excel, the working capital?
Okay, so you want to see the like calculation of this 15,000
No,
or
like
this
when I do it on
incremental?
Excel, I don't get the correct values. That's why.
No, so you want the this incremental thing, that how much do we have to invest every
Yes.
year? Okay.
Yes.
All right. So over here, let us talk about this working capital. All right. So these are the requirements of the working capital. Okay. So over here, year 0, 1, 2, 3, 4, and 5. 1, 2, 3, 4. Okay. 4 till 4 I have taken. Chalo, 4. And it is given that the working capital needed in the business will be 15,000. Okay. Then we will need 16,500. 16,500. Then 18,150. 18,150. And then we will need 19,965. 19,965. Okay. Chalo, these are the requirements of the working capital in all the upcoming years as per the calculations, whatever is the calculation in the upper side. So now what should be the cash flow? Okay, what should be the cash outflow, actual cash outflow in the business? That will be in the very first year. Okay, in the year 0 itself, while you are starting with this project, at that time you will invest 15,000. Okay, next year this should be your investment. Okay, this should be your investment, invested capital, working capital, out of which you have already invested 15,000. So what you need to do is you have to take this as a minus sign and the previous balance, okay, previous balance as the plus sign, and this will tell you that incremental should be 1500. Copy paste. Okay, copy paste. This should be the thing. And now if I copy paste this over here, I can see that my entire 19,965 would be recovered at the end of the project. Clear with this, Neha?
Yes, sir.
Perfect. Chalo. Any questions still here from chapter 3 to chapter 5? Time horizon, scrap value, and everything is simple. You can just read this. And now we are moving towards chapter number 6, which is capital rationing. And here students are making many mistakes. So first of all, and recently, yeah, uh, Raghav has not joined today, but he has solved the mock exam and there was some discrepancy, and he mailed it to ACCA and it was resolved. So what is it? Let us discuss one by one. So capital rationing, first of all, let me just start with the new sheet. So this sheet is relevant for chapter 3 to chapter 5. Now we are starting with chapter number 6. So in chapter number 6, capital rationing, we are going to discuss what is basically capital rationing. When you have a limited capital, when you have a limited capital in your business and you have to decide that out of the different projects, what are the projects that we can undertake. Okay. All right. Now, see, in our FM's syllabus, the situation is very simple, that the capital is limited in the very first year, like the year in which you are investing. In that year, you have a limited capital, let us say $5 million. Okay, you have only $5 million, and right now you have to decide that out of whether different projects are there, A, B, C, D, E. Okay, let us say in A you have to invest 2 million, in B let us say you have to invest 3 million, over here let us say 4 million, 1 million. Okay, and over here let us say anything like 5 million, entire 5 million. So you have to decide that how can we invest this 5 million in these different projects. All right, so now for that we have various situation, and this is the only kind of situation which is going to be there in our exam. In our exam they will never say that the capital is limited for the first this much is limited for this year, next year it will be limited by this year, because that is a very complex situation, and that is not being dealt in the AFM as well, in the advanced financial management as well. It is not being dealt over there. Also we are going to learn how to generate equations so that computers can do it, so we don't have to do that manually over there as well. Over here what we have to learn is that there are different situations for this kind of a entire scenario. Number one is the projects are divisible. Projects are divisible. So first of all, what will happen? you will be provided with the requirement of the capital of all these projects in the year 0, and you will be provided with the NPV. Okay, so let us say if you invest 2 million, you will make a profit of 2 million. Over here, let us say you will make a profit of around 4 million. Over here, let us say you will make a profit of 3 million. Over here, let us say you will make a profit of let us say 3 million over here also. And let us say over here you will make a profit of uh, 3 million as well. Okay. So what you are supposed to do is, if the projects are divisible means you can enter into this project in any size. Like let us say you want to enter just 50% of the A. Okay, A is 2 million. If you want to enter 50% of A, you have to spend only 1 million. Okay, and the profit will be also proportionately 1 million. So over here, what we are supposed to do, we are supposed to find out the profitability index. Okay, whenever you have divisible projects, in that situation only you have to find out the this profitability index. So there are going to be two situations related to divisible projects. One is the projects are purely divisible, and another one is this mutually exclusive divisible projects. So we are going to come at mutually exclusive right now in a while. But first of all, let us say all the projects are not mutually exclusive. Mutually exclusive means uh, they are not able to be incurred together. Let us say project A requires a particular set of land, and that same particular piece of land is required by project B. So they cannot be, even though you see the total requirement is within the limit, 2 million plus 3 million is within the limit, but we cannot incur these two projects simultaneously. So first of all, when we have the divisible projects, but right now forget about this, right now no project is mutually exclusive. Every project can be undertaken mutually. A plus B is possible. So in that particular case, first of all, you have to find out the profitability index. Profitability index is basically your NPV divided by your initial investment. Okay, let me just write this data in a table format. Okay, so the capital needed is 2, 3, 4, 1, and 5. And over here, the projects are A, B, C, D, E. All right. And over here, NPV is going to be 24333. Okay. 24333. So over here, profitability index is going to be your NPV divided by your capital. Copy and paste. Chalo. So over here, chalo, this is your profitability index. And based on this profitability index, you have to given the ranks. Okay, you have to give the ranks. So the project with the highest profitability index, please don't do it otherwise. Okay, capital divided by NPV, don't do that way. It is NPV divided by the capital. So the projects with the highest ranks over here is going to be the rank number 1. Highest profitability index is this rank number 1. Then comes this 2, then comes this 3, then comes this 4, and then comes this 5. All right. So in this particular case, you see the project with the highest profitability index, you are going to incur first. All right. So over here, what we are going to do, you are just going to start selecting the project which is the project with the highest rank, project D. So generally, what will be the questions? You will be first of all asked, okay, in divisible projects, you will be first of all asked. Let me open a PDF to show you that what is the kind of marking system for this kind of a question. Marking system practice. Let me have FM mock exam. So let me see over here. This is not, this is cost of equity, business risk. To B. Yeah, this is a question of this profitability index and divisibility. So you see, there is 1 mark for calculating the profitability index. There is 1 mark for formulating the optimum investment schedule. Whenever you will have a question related to divisible projects and capital rationing, first of all, you will have to calculate this ranks, and then you have to prepare the optimum investment schedule. That what is the best proportion of different projects that we should be undertaking. All right. So there is 1 mark for that. And the last one is the NPV of the investment schedule. So from this investment schedule itself, you are going to get 2 marks out of the three, and one is for calculating the profitability index. So that is how the marking system is. But if you have an in-depth question on this, let us say 5 marks, 7 marks question, then it will be based on that. So first of all, this is the step one. We have calculated the profitability index. Now you have to prepare the optimum investment schedule. Okay, so in the optimum investment schedule, first of all, what you are going to do is pick up the project with the highest, uh, not the highest, but the uh, first rank. Okay, the project with the first rank over here is project number D. In that, how much do you have to invest? You have to invest one. How much NPV are you going to get? You are going to get NPV of 3. All right, so over here, this is, and now let me just have a balance capital available. Okay, balance available. First, it was 5 million, right? The limited capital is 5 million. Now we are left with, so we will say this minus this. All right, so now we are left with balance of 4. So what we are going to do, pick up the project with the next rank. Next rank is project number B, project B. So over here, I'll say project B and take the capital of that. Okay, so I will take the capital of project B, which is 3, and you will take the NPV for that. So NPV for project B is 4. All right, and over here, now the balance left is 1. So we got 1 million. Now you will pick up the project with the rank number 3. Okay, so over here, rank number 3 is project A. Now you see the capital limited, like available capital is just 1 million, and the investment needed over here is 2 million. So what we are going to do, we are going to have enter it into a proportion. We cannot enter the entire A, but what we are going to do is we are going to enter A in this proportion. We are just having a balance, whatever is the remaining balance that we will enter. So we have to find out the proportionate NPV. This NPV is for entire investment of 2 million. But how much we are entering? We are entering just 1 million. So the proportionate NPV should be 1 million, and the balance left is 0. Balance available to us is 0. So this is the maximum possible NPV from this particular set of projects. This is the maximum NPV that we can have. No matter what permutation combination you try, okay, you cannot generate NPV more than this out of these projects. Understood, everyone? Profitability index? Yes or no, quickly?
Yes, sir.
Sneha, Atharva, quick.
Yes, sir.
Chalo, great. Atharva, perfect. Chalo. So now we are going to look at directly situation number 3. Okay, situation number 3 says that, let me just close these PDFs. Now we don't need them. We are already at chapter 6. Chapter 6. Chalo. Third situation is mutually exclusive divisible projects. When the projects are divisible, no doubt about that, but projects are mutually exclusive. Let us say B and A cannot be incurred together. B and A cannot be incurred together. In this situation, first of all, see, first step will be as it is. You have to calculate the profitability index and you have to do it like this. But the second step, while formulating this, you have to ignore A. You have to see, figure out all the possible outcomes using the top ranking this projects. So first of all, since B and A are mutually exclusive, you are going to ignore A. Okay, once you have D and B, D is for sure, is always going to be there. So that is the possible combination 1. Let me simultaneously create combination with this is combo 1, combo A. I'm going to have bold and italics, bold and underline. Then we are going to have combo 2. So that will be combo B. Okay, I'm just going to copy everything. This I have copied, pasted, D capital and everything is, so I'm going to copy from here itself. Project D is final. All right, chalo. So, all right. Now over here, instead of A, I have to ignore A because A and B are mutually exclusive. The next project, the next rank over here is rank 4, which is C. So what we are going to do over here in the combo A, we are going to enter into C. So over here, what is the capital available with us? 1. So what we are going to do, proportionately, we are going to figure out that this is the NPV if we would have invested 4, but right now we are investing just 1. So this is the NPV available. As a result, the balance is 0. That is fine. But this is the max NPV possible because A and B cannot be entered together. So that is combo A. Now I will find out combo B. So in this case, instead of B, we will ignore B and we will go for A. We will go for A. Okay. So over here, if I go for A, what is the capital needed for A? Capital needed for A is this. All right, NPV that we will generate will be this. Okay. And now the balance left is 2. So we are left with 2. Now we will see, we started with rank 1. We ignored rank 2 because we wanted to have a possible combination with A, which was rank 3. And now we will see rank 4. Okay, rank 4. Rank 4 is C. So in that particular case, capital available is 2. So over here, I will say 2 is there. Okay, and NPV available is NPV. This NPV divided by 4. Okay, multiplied by the capital that we have used. NPV 1.7, 1.5. Balance is 0. So now let me calculate the max possible NPV in this. 6.5. So out of the two combinations, it is clearly evident that this is a better combination. This is a better possibility. Okay. See, majority of the times, the project which are ranking higher, okay, if you will pick up them, like if you will have that in combo, majority of the time your NPV will be maximum. But there was a question in the recent mock paper by ACCA. In that question, there was an issue. What was the question? Let us discuss that question. Let me see if I can just quickly find that. Let me see. Yeah, I have found out the question. Let me just load it over here. Is the question visible now?
Yes, sir.
All right. Chalo, quickly solve this question. Everyone. Sneha, you have done it already?
Yes, sir.
Okay. Done, guys? Okay. 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 I'm also solving it parallelly. You also continue. To be very careful with the decimals. Sometimes it can be 0.003. So don't give that the rank 1. Chalo, so if you have not done so far, just focus on the screen right now. Okay. I will be completing this question. So are you getting the correct ranks, Divjot? Can you
Yes.
just check?
Yes. Yes, sir.
Okay. Atharva, how far you have reached so far? Sure. Once we have this, the next important step is, see, I am doing it on a horizontal way, but always have all the steps, all the questions in the vertical way only. Okay. Yesterday itself, I was checking a paper and the student has done one section over here, like one requirement over here, another requirement over here. So I was not able to, like, I had to enter rows for checking it. So it was a bit difficult. So I would always request, do all the questions in a vertical way only. Don't do horizontally. All right. Chalo. So optimum investment uh, would be चलो सबसे पहले what we are going to do is list the projects. I'll just have it based on their rankings, investment, this, and so we need to prepare combo 1. This is combo 1. Okay, combo 1 is going to be A, which is the project with the highest rank. B is the project with the highest rank. So the investment that we have to make over here is 160,000. A and B are mutually exclusive. So first combo will be taking B. NPV that we'll be getting is this 600,000. Now in this, we cannot have A. Okay, so we are going to have another projects. So next project that we are going to take is M. Okay, and then N we cannot take. N we cannot take because it is a negative NPV. So NPV negative we are going to ignore completely. We don't calculate the profitability index as well. Next we will take Q. So M over here is going to generate an NPV of 3500. Q over here is going to generate an NPV of 1575. Oh, sorry, these are the NPVs. Okay, investments needed for them is 75, and this is needed as 108. So total investment needed over here is 443, and total investment needed over here is 110. Sorry, total NPV is 11075. This is combo 1. Similarly, we can have a combination 2. Please write combo, don't write combo, please write entire word. Okay, combination 1, combination 2. Okay, I am at the liberty over here, but in exam you don't have to do it like this. Chalo. Combination 2 will include A, okay, but it cannot include B. So we are going for the next rank, which is M, and then we will go with the Q. So that is the second combination possible. And over here, we are going to see investment needed in A will be 250, investments needed in M will be 175, and investment needed in Q will be 108. So 533 is the maximum investment needed for this combination. In that case, the NPV will be 6500, M will be 3500, and Q will be 1575. So you see, this is the combination resulting in a higher NPV. So whenever the projects are mutually exclusive, whether the projects are divisible or not, okay, in this case the projects were divisible, and we have calculated by based on the ranks. But whenever the projects are not divisible, you will try to make different combination without the ranks. Okay, when the projects are not divisible, you can find out if there are any other combination possible. But you see, in this given case, there are no other combinations possible. These are the only two combinations. And in this case, you see this one is the higher NPV. Even though B is ranking 1 over here, right? Even though the profitability index is higher, but since the NPV, the actual absolute value of NPV is lesser than this, you see this is a better combo, because actually the capital required, okay, is less than the limit over here. Limit is 550,000. If the limit would have been, let us say, 500,000 only, okay, then in that case the story would have been slightly different. In that case we could have not entered the entire queue. We have to restrict it to something, I don't know, whatever is the balance, and in that case the NPV could have been lower. But since there was, limit was higher, and we were able to take up projects with higher NPVs, okay, as a result the total NPV was higher, and as a result this is the combo that we will be going. This is the actual optimum investment. So you should ignore this. You should take this downward somewhere else in the working capital. Okay, working capital, and just name calculation of other combo. Optimum investment, you should just remove this name and you should just say that this is the optimum combo. This is the optimum investment, this thing. And this is the NPV at the optimum NPV. This was the question. I think the question was that what would be the maximum NPV that the company could see by optimizing the investment within the limit of 550,000. The answer is 11,575. So that is the trickiest question related to the profitability index thing. All right. So the second situation which is yet to be discussed was the situation of non-divisible projects. In case of non-divisible projects, similarly, you just have to create different types of combos with all the projects. The combination with the highest NPV has to be selected irrespective to the profitability index. You don't need to calculate the profitability index in this particular situation. Clear till here, guys? Yes or no, quickly?
Yes, sir.
Sneha, Tharva, are you guys with me?
Yes, sir.
Perfect. Now we are, chalo, this one, multi-capital, multi-period capital rationing. So far whatever we have seen was related to a single period capital rationing, which was the initial period. Multi-period capital rationing is going to use linear programming, and it is not examinable. It is not examinable in AFM as well. Over there you are just supposed to create an equation, nothing else. Okay, because it is practically not possible to calculate using even Excel as well. You need proper softwares for that. Chalo. Now the next part of this chapter is asset replacement decision and asset replacement decision, and this one, equivalent annual benefits. So we will combine both these topics and we will pick one question, and that will give you the entire result. Just give me a minute. So target for today, what I'm planning is, uh, what we are going to do today, we will complete investment appraisal, okay, which is almost over now. It will be done in like next hour, it will be done. And we will complete the cost of capital. All right, cost of capital also, it won't take much time now because we have discussed the major basics, and then I will give you an overview of cost of capital, then uh, and the valuation part. Okay. So first of all, let me know, are you guys comfortable stretching this session beyond, and like we will have a 1 hour lunch break, and we will try to wrap up before like 3 p.m., 4 p.m. so that you can have the entire evening for yourself in order to revise the section C questions. Okay, from this particular topics. And then tomorrow morning again we will start, and the remaining portion, which is your working capital and the risk management, these two are the two different areas. So that will cover tomorrow morning. So the tomorrow's entire evening you will have with yourself for covering the section C questions for these chapters. Okay, agree with this plan, everyone? So right now we will have 1 hour lunch break, or do you want to have a session in the evening for, let us say, 1 or 2 hours, and right now you want to do the section C part? Just let me know what is your preference.
So break right now.
Break right
An
now
evening session.
and evening session.
Yeah, that's okay.
Okay, so you want to have like, so what time can we start with the evening session? Devjot and Atharva, what are your preferences?
Whichever suits you, sir.
Okay, so I would say right now it's 1 p.m. Let us continue a little bit and let us complete this part and this part, these two part. Okay, and we will have a 1 to 2 hours of break for lunch break, and then we will complete this. It will need around 1 hour to 2 hour, and then you will have the entire evening with yourself to complete the section C questions, go through section C questions of these three areas. All right, Sneha, does that work?
Yes, sir.
Perfect. Chalo. So I'll be back in 5 minutes, and after 5 minutes, we will complete the remaining part. So Atharva, okay, yeah, Atharva has also given a green signal. Chalo. So I'll be back in 5 minutes, and then we'll complete the investment appraisal and the valuation part. Perfect. Chalo. So guys, I just need a feedback. Like so far, how is it going? Like, are you guys able to recall all the concepts very quickly? Because the entire like motive of this session is to save your time in revising these concepts which you might have lost the touch with. Okay, and then you can just directly quickly focus on the practice session instead of going through all the PDFs. So far, do you feel, is it giving you the desired result? Like, are you able, do you find it effective?
Yes, sir.
Yes.
Nice. Chalo. So the last part of this chapter, okay, lease and buy decision. Okay, we are yet to discuss this. We are yet to discuss equivalent annual benefit and equivalent annual cost. So what happens is that, see, if I, let us say, pick up any question, let me pick up any of the questions. I'll pick up the question for cost. So whether it is cost or whether it is benefit, it doesn't matter. The logic applies the same to both. So let me pick up a question, which is this. Chalo, ये वाला question will pick up, and so we are still in chapter 6. Now we will solve this question. So see, equivalent annual benefits and equivalent annual cost. These two concepts, equivalent annual cost and equivalent annual benefits. These two concepts are basically going to compare the situation. Okay, it is helpful in a situation where the projects are going to be repeated for a foreseeable amount of time in the future. It's not infinite. I've drawn the symbol of infinite over here, but foreseeable future, which means they are going to be repeated, replaced each year. Okay. Over here, it is not mentioned in this question, but generally determine whether the machine should be replaced each year or every 2 year. Right. Over here, let us say this particular machine, just read the question. For a machine that cost $20,000, this machine is costing $20,000. This is a one time investment. Running cost is 5,000, 5,500, which is like maintenance cost. If you sell this particular, now there are two options. Okay, option number one, option number one looks like this. Year 0, 1, 1, 2. There is no year 2 as such. Okay, and over here, running cost, scrap proceeds. All right, determine whether the machine should be replaced each year or every 2 years. Okay. Chalo, so over here, cash flows. All right. You have to spend $20,000. Okay. And you have to give 5,500. Okay. And in the year one itself, okay, in the year one itself, you can sell the particular, machine for 16,000. So that will be like your income. Okay. This is option number 1. Or the second option available to you, this is option 1. Now option number 2 is that instead of this, in the second year we are going to sell. We are not going to sell in the first year, we'll sell in the second year. As a result, we will need to incur a further cost of, just a minute, machine information is available. Okay, this is the inflow, guys. See, this is the cost. Just a minute, I think this question belongs to equivalent on annual cost part. The wordings in the question are slightly incorrect. Machine is the cost of the annual maintenance cost of the machine is this. The residual machine is expected to be, okay, it's the same thing. Running cost is this. Yeah, okay. All right, I thought it's cost savings. Chalo. So it's cost only. It's the maintenance cost only. It's a cash outflow for us only, and that is the case over here in the second year, 5,500. So if you keep the machinery over here, it is 5,000 for the first year. Over here, it is 5,500 for the second year. These are the two options available to us, and you can sell it for the second year for 13,000. Scrap value will be 13,000. Understood this? The two options that we have available from the question. Everyone, yes or no?
Yes.
Sneha, Atharva.
Yes, sir.
Okay. Now see, if the option is available like this only, like it is a one-time event. If it is a one-time event, what you would do is you will find out the present value. That's it. Like discount rate given in the question is 10%. All you would do in this situation is just find out the present value and you can compare it. That is also absolutely not 100% correct. Okay, but still, let us assume that you will directly find out the NPV by using this formula. NPV rate is 10% discounting, and the values are okay. This is going to consider this entire thing as a two different set of this. See, whenever you have a single year repeated, you cannot use the NPV or IRR formula. Okay. In this situation, you have to find out the present values manually, and that would be this divided by 1 plus the discounting rate of 10% raised to the number of period, and copy this and paste it over here. And now your NPV is just the sum of all these items. And same goes over here. Oh. I should have not done it like this because there is other content. Shift cells to the right. Chalo, let me just find out the present value similarly over here. Divided by 1 plus the rate of interest, which is your 10%, bracket close, raised to the number of period. Copy and paste. Okay. Over here, your NPV is going to be sum of all these items. 1834. And here it is under 10,000. So if it is a one-off event, you would say that, sir, it is better. Okay. It is better to go with project A, right? Because over here, the NPV, the negative, see, NPV is negative in both the things because it is cost. We are just comparing the cost. We are given that this is a machinery. This is option 1. This is option 2. Okay. over here, this NPVs, both the NPVs are negative. So which one is negative? Like the smaller amount, we are going to pick up that, right? It is clearly evident that this is a better choice than this. Okay. But the thing is that it is going to be repeated. Okay. It is going to be replaced. It is a replacement decision. Equivalent annual cost is talking about replacement. That right now you have two options. Either you can replace the machine after 2 years, which means you have to again incur a cost of 20,000 at the beginning of the third year. At the ending of the second year, if you sell it for 13,000, you will again incur a cost of 20,000. You again incur a cost of 20,000 at the end of first year, at the beginning of the second year. In that case, if you have to compare, you have to take equivalent annual cost. So over here, equivalent annual cost is going to be nothing but the NPV divided by the annuity factor. Okay, annuity factor, you can just look into the annuity table, and right now I'm not wasting time in that. We can just pick up the annuity factor directly given in the solution over here, which would be 2-year annuity factor, 1.736. And over here, the annuity factor for the first year is nothing but the discounting factor only, 0.909. Okay. So this divided by 0.909, right? This is 11,000. Okay. 11,002. And over here, equivalent annual cost is this divided by the annuity factor. Annuity factor over here is 1.736. 1.736. So now you see this is a better option. Option 2 is a better option. Replacing the asset every 2 years is a better option as compared to replacing the asset every single year. This is equivalent annual cost, where you have to repeat a particular decision for an n number of years. You are going to compare the two projects, two options based on the equivalent annual cost or equivalent annual benefits. Instead of this, if this could have been given, let 5,000 is going to be our income from this particular project, or let us say cost savings from this particular project, then it will be shown as a positive. It will be kind of an cash inflow for us. Okay. In that case, you see both the NPVs are over here available to us, and you can see this is a better option. And in that case, equivalent annual, see, this is, I've just created the question randomly over here. That's why it's not that kind of say contrasting to each other. Okay, it is clearly evident that this project is better in the lump sum case also, and in the equivalent annual benefit basis also. Equivalent annual benefit is nothing but the same thing. NPV divided by the annuity factor. NPV divided by the annuity factor. That's all. Equivalent annual cost and equivalent annual benefit. But the main concern over here in this type of situation, equivalent annual benefit and equivalent annual cost, is that the projects are going to be repeated for a foreseeable future, and you have to make a choice between this. Clear, everyone? Understood equivalent annual cost and equivalent annual benefit? Yes or no? Quickly.
Yes.
Sarva, yes. Okay. Sneha,
Yes, sir.
perfect. So we are done with that. Now you just have to go through the questions for both. Don't need to read anything from this. Okay, lease or buy decision. Lease or buy decision is basically you just have to compare. See, it is just a financing option. So if you just look at a question directly, you will get the thing that whether you lease a particular,
So
this is just a, yes, Neha.
the screen is on Excel.
Okay, this is not shared. Arre baap re. Chalo, I'm glad that I have copied this question. Now, lease or buy decision. So for lease or buy decision, okay, when you are just focus on this. What are the relevant cash flows? See, when I talk about lease or buy decision, okay, in so far in investment appraisal, first of all, lease versus buy. Okay, this is a financing decision. This is a financing decision. Okay, whether to go for a project or not. Okay, let us say there is project A. Okay, whether to accept this project or whether to reject this project, this is your investment appraisal decision. That will be based on the future cash flows of this particular project. Okay, that is your investment appraisal decision. But now, since let us say you have approved this project, once you have decided to approve this project, now you have to decide whether we should buy this. Let us say you have approved this project, then you have to decide whether we have to take this project on lease, whether you should take this machinery on lease or whether you should buy this machinery. Okay, that is your lease and buy decision. And this decision is basically a finance decision. It is not your investment appraisal decision. This is your finance appraisal. Okay, so over here what you need to do is, see, if you will take the lease, what will happen, you will have to make the lease payments. Okay, and whatever lease payments that you are doing, this is an expenditure. Okay, so this will be a negative cash flow for you, and you will have tax savings on whatever lease payments that you are doing. These are the two cash flows, which are going to affect your decision of taking a lease. If you will buy a particular machinery, right, right away what you will do is you will do the capital expenditure. You will have a capital outflow immediately of the entire amount. On that, you will have tax savings, right? You will have the tax savings on the tax allowable depreciation. Every year you will be allowed an amount of depreciation by income tax, and on that you are going to have tax savings. So these are the two what I can say types of cash flows relevant for your lease and buy decision. So while doing the investment appraisal, you will not take into consideration the TAD. Okay, so far what was happening, that while we were doing the investment appraisal, we took that let us say whatever were the cash flows, operating cash flows. Okay, and we were adding the tax savings from the TAD. Okay, we were adding the tax savings from the TAD because so far we were having a very simplistic assumption that we are buying the asset. But now onwards, since we are having that entire decision as a separate calculation, when you are given the question related to this kind of a project, okay, where you have to make a lease or buy decision, don't consider this. While doing the investment appraisal, you will just focus on the future cash inflows, that how much you are going to generate from that project, and you are going to do the discounting of that project at the WACC. Okay. Over here, for lease, you will be doing the discount rate that you will be using will be the rate for the debt, whatever is the debt discount rate for the debt. And for the buying decision, again you will use the discount rate for the WACC. That is the major thing that you need to consider over here. So let us directly look at a question and we will be able to get this. So this is the list that we have just given: purchase cost, capital cash outflow, tax benefit, okay, and the scrap proceeds. Yeah, definitely scrap proceeds. Capital outflow only I would consider that, right, while creating the line for capital outflow. So that is also a part of it. Scrap value should also be considered. Chalo. And in lease, only two cash flows are relevant. So over here, let us just look at this. Okay, we will directly look at an question and an answer. We are not going to solve this entire thing. An asset cost 200,000, okay, for the first day of its new accounting period. So that is the cost. If I purchase the asset, then I have to pay. Its scrap value is 25,000. Operating inflows are 150,000 for 2 years. Tax rate is 30%, 33%. Okay, 1 year in arrears. Company's WACC is 10%. Tax allowable depreciation is 25%, and the reducing balance basis with a balancing adjustment in the year of disposal. But this is applicable only if we purchase the asset. So right now we have to divide this into two parts. One is investment appraisal, which should focus. What will your investment appraisal will focus on? Just this part, that this particular asset is generating operating and inflows of this 150,000, and your tax rate is 33%. Taxes are paid 1 year in arrears. That should be the only focus of your investment appraisal part. deciding whether to accept this project or not at a discounting rate. What discounting rate? Company's WACC is 10%. Okay, that should be your first thing. Initial investment we are yet to consider. Ultimately, we will first decide what is the investment appraisal, like what are the present values of the future cash flows, what should be the financing decision, and then we will figure out the NPV. Okay, so that is the first part. Just look at the calculation for operational benefit. You took this 150,000. These are your cash flows, project's return, and this is the discounting factor. You have used the annuity factor over here. Okay, two finite cash flow, identical cash flows, 150 for 2 years for a finite number of periods. You took the annuity factor. This is the present value for that. 49,500 taxes on this to be paid in the second and the third year. Okay, this is slightly complicated using two different annuity factors, but what we could have done is we could have done it in a simpler manner. Let me just paste the question over here directly. Chalo, let us do this itself. I'll just copy the question. Copy the question. Chalo. And let us have a solution. So first of all, what we are going to do is we are going to focus just on the operational benefit that we are going to have from this project. Okay, which is the part of investment appraisal. Okay. Bold, underline. Chalo. Over here, we are going to have year 0, 1, 2, and then we are going to have cash flows. Cash flows will be 100 and okay, what I can do is, okay, I should have done it this way horizontally. Whenever you have multiple line items, please use the horizontal format. Whenever you have a single cash flow item for every year, then in that case only use vertical format. So over here we are going to have EBIT. I think EBIT is given, or what is given? Operating inflows. So it's just EBIT. Okay. So EBIT. Now, even though EBIT is given over here, we cannot we are not going to deduct interest. Okay. So EBIT is given, which is 150,000. 150,000. This. All right. And I'm going to take into consideration the tax which I am supposed to pay the next year. So next year tax rate will be 33%. 33%. 49 this. And now I can have net cash flow. I cannot say net, but net operating cash flow. Okay. Will be this plus this. Copy, paste. See, I have not returned the capital outlay as we do in all our questions. Capital outlay, and then we do all the entire calculation. But here we don't have to do that. Present value of operating cash flows, net operating cash flows will be this divided by into the bracket 1 plus 10% WACC raised to the number of periods. Okay, copy this, paste it. All right, so this is your present value of operating cash flows. So total present value is going to be the sum of all this. Clear till here, guys? Yes or no?
Yes, sir.
Sneha, Atharva. And now
Yes.
this, perfect. This should match their answer 182, 289. They have used annuity factor. If you want to do that, you can do that, but that is slightly complicated. Okay, our answer is slightly different because of the rounding off. It is off by 100, but it's fine. So now next part, I am doing it horizontally just to give you a better idea, which is your lease versus buy decision. So I can say financial,
Sir, the
uh,
previous PV was on 10%, right?
which previous PV?
This one. The
Yeah,
operational benefit is 10%,
yeah,
right?
this is at 10%. This is at WACC. Okay, just
Okay.
refer to this chart again and again. Okay, discounting rate, this has to be done at WACC. Now we are going to do the calculate the another part, which is the financing decision. Over there are two situations: borrow and buy. Okay, in borrow and buy, what will happen? So I'll just copy this, paste it over here, and that is your B, financing decision. Financing decision. Okay, over there, first of all, we have borrow and buy. Now, over here, you would have noticed one word, extra word that we have written, borrow and buy. We are saying that whatever is the capital outflow that you have to incur for this particular project, whenever you are doing lease versus buy, in that case, you have to assume that whatever outflow that is going to happen, okay, that has to happen from a borrowings, capital outflow. Okay, 200,000 that will be done from a borrowing. In that case, you are going to have an interest expenditure. Okay, but interest we don't have to consider, so that is fine. But pre post cost of debt, pre cost of, okay, that has to be done. 10.7 discounting factor 7. This is also 7. All right. So one thing I have misstated over here, this one, this discounting rate that we have to use, that is also the discounting rate for post tax debt. Okay, post tax cost of capital, cost of debt, and this also should be post tax cost of debt. That is something that we should be constant with. Okay, instead of this should also be post tax cost of debt. Okay, this is consistent. Chalo. Why? Because we are trying to compare borrow and buy. So what will happen over here? Capital outlay. See, don't have to consider interest. Okay, interest is already included in the discounting rate. Capital outlay. First of all, chalo, let me just copy the schedule. Copy, paste over here. Capital outlay will be, in the first year you will invest 200,000. It is 200,000 or 220 million. 200,000. Okay, perfect. 200,000 is invested and you will get a scrap value of 25,000 on the last day of the next accounting period. Next accounting period is 220. On the last day you will get how much? 25,000. This is a positive cash flow. 3 I am just keeping for the tax purposes. Chalo, that is done. Now, other than that, what is going to be there? Other than that, there is going to be tax allowable depreciation. These two things we have considered. Tax allowable depreciation. So for tax allowable depreciation, we can create a schedule, working note. Okay. See, working note I am doing right now along with this, but you can do it in the exam. You can do it right now along with this, and then cut paste it in the somewhere in the bottom. Tax allowable depreciation. So whatever is the purchase price of the asset, 200,000. Okay. TAD for the first year. What is the reducing balance percentage given in the question? 25 percentage. Reducing balance basis with a balancing adjustment in the year of disposal. Chalo, 25 percentage of this will be my tax allowable depreciation, and tax savings on this will be this multiplied by 33 percentage. Tax allowable tax rate is 33 percentage. Okay, so the balance at the end of first year, at the end of first year is going to be this minus this. All right, and the tax allowable depreciation for the next year, you don't have to calculate the tax allowable depreciation for the last year. The asset is sold in the second year itself. Okay, so we don't have to calculate tax allowable depreciation, but over here we have to subtract the scrap value. Scrap value is 25,000. Okay, so whatever is the balance that can be taken to the PNL. All right, so the balance over here is this plus this. So the tax savings for the second year is going to be this. But now, as the tax is payable 1 year in arrears, okay, even though this is the tax savings for the first year, it will be available. Tax savings will be available in the second year. Okay, and this one is the third year. All right, so that would be the case. Now what I can do is just shift all these things, shift cells down, F4, F4, and I can find out the present value of capital outlay, borrow and buy decision, present value of borrow and buy decision. Okay, that will be, okay, I need first of all net cash flows. Net cash flows in that case. Here, you can use the word net because net cash flow is something difficult. So, right. So, if you don't know what to name exactly, just use the word net. That will be sufficient. Now, present values. So, this divided by 1 plus the. Now, the cost of debt has to be used. So, you can have a separate working note for cost of debt. Working note 2, cost of debt. Okay, cost of debt post tax. Okay. So cost of debt is given in the question, which is your bank loan. You see, using a bank loan at 10.5% interest rate. That is the cost of debt. Okay. Anyway, in any indirect way, the cost of debt will be mentioned in the question. So you first of all take that 10.9 percentage and then you find out KD into the bracket 1 minus the tax rate, which is the, I'm just writing tax rate, corporate tax rate. Okay. So this multiplied by into the bracket 1 minus 33 percentage, bracket close, press enter, 7.3 percentage. So I'm going to use that over here. This divided by 1 plus 7.3%. See, they have done the rounding off to 7 percentage. So I'm just doing it for the sake of matching the answer. But in exam, you can do write 7.30 manually. Okay, raised to the number of periods. This should match, obviously, right? If it is not matching, you have made a mistake. For year 0, it should be same. And then it should be like this. Okay. So this is your capital outflow. Total present value over here, in this case, would be a sum of all this. Bracket close. Okay, 1300, something like this. So in this case, the NPV, if you do the borrow and buy, in that case, the NPV will be this plus this. Oh my God, this much? Seriously? Yeah. Okay, okay. Yes, 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 yes. They have given that big an NPV. Okay, you can compare. Okay, so I have calculated NPV directly, but that is also not needed to be done. First of all, you calculate the present value of cost for both the decisions. This is borrow and buy decision. Similarly, you have to calculate the present value for lease decision. Okay, for the lease decision is very simple. You just have two lease payments and you just have two tax reliefs. Okay, they have used the annuity factor, but as I have shown, can create a table like this, and in that way you can calculate the present value of the lease payment, which is 127. Whichever is the lowest cost out of the two, 130 versus this, okay, you can take that cost over here as your present value of the present value of the cost of finance, and you can compare it with the present value of operating cash flow, and this can be the final NPV. So if you want, you can calculate the NPV in both the cases and you can directly compare the NPVs as well. And you can say the highest NPV is with this particular option and we should go for that. So that is ultimately your lease versus buy. Any questions in this so far?
सर बट इसमें रेट तो अलग अलग है ना
किसमें? लीज नहीं, इसमें नहीं.
For
See,
operating, we used a different rate, and for these, we used a different
yes,
rate, right?
cost we will use post this post tax cost of debt. Okay, financing, whether it is leasing or whether it is this borrow and buy. In both the cases, we are going to use 7 percentage, which is your cost of debt post tax. Okay. In operating, we are going to use WACC. Okay, so this summary you can keep in mind. Okay, for project appraisal, use discounting at WACC. I'm just bringing it over here. Okay. Over here. And over here, you have to use post-tax cost of debt for the financing decision. Clear, Sneha?
And then subtract it, right?
Subtract
And
what?
last step
Ha,
may be
ha.
subtracted, right?
Yes,
Both.
whatever is the cost, subtract that from the operating. And then you get the NPV. Clear? So I'm giving you
Yes.
5 minutes. Complete this, okay, with the leasing part. Just calculate it on a rough basis and then just see whether you are getting the exact same decision over here or not. Okay, I'm coming in 5 minutes. Done, guys? Lease for present value of lease. Yes or no? Hello.
So can you show the Excel sheet once?
Okay, in Excel, I haven't done that. So you want me to do this? Chalo, let me also do this. And what is the lease payment? 92,500. So 92,500 in the first year, 92,500 in the second year. The tax benefit will be available after that. Net operating, net lease cost. Just use the word net. Net lease, present value of lease payments of lease will be this, but I have to use a different rate. That rate will be 7.3 percentage. 7.3 percentage. I can copy this, paste it over here, and this should be my total present value, which we are not getting, right? It is 127 something present value. Have I copied this? Yes. This is accurate. 16, no, 1300. Was that matching with the, yeah, this was matching, off by 100. This is coming 127. Tax relief. Okay, see, lease is at the start of the year. In the question, it is given leasing for 92,000 a year in advance for 2 years. Lease payments are tax allowed. So this means this payment is actually happening in the beginning of the year. Okay. So the payment for the first year is happening right now here. This is happening here. And this one, tax is going to remain as it is, wherever it is. Okay, so now this formula I need to copy and paste again. Oh, this I need to say this plus this. Copy and paste. Present values, now I can copy paste over here. Copy, paste. Total present value should be sum of all of them. Now it should match. Getting it, everyone? 127. Yes or no? Please let me know where are you stuck. Sneha, you got this?
I'm not getting the borrow and buy. I got the lease, but borrow and buy nahi aa raha.
Okay. Okay, chalo, pehle lease. So Devjot, you got the lease part. Atharva, you got it?
ये सर लीज हो गया.
Okay. So what is the issue in borrow and buy? Sneha, can you just check? Where are you making a mistake? What number is exactly not matching? Ignore this. This is the prime focus. Tax savings, can you check? Have you got the tax savings correctly? In the correct year, second and third.
Yes, sir.
Then net figures, are these figures accurate?
Yes, sir.
Okay. So are you making a mistake in present value? In present value, why I've taken, yeah, we have to take 7 point, I've taken 7%, okay, over here. If you want to match exactly with them, I have taken 7%. If you are taking 7.3, which is the actual thing, you might be getting a different answer because of that. That is also like off by 400. So what is the actual amount that you are getting?
Sir, I'm getting 269.
269. So these present values are proper. So you have made a mistake in somewhere in the present value, right?
Yes, sir.
Check this formula. This should
Can
be,
I share my screen for a second, sir?
yeah, sure. Go for it.
You have to accept it, sir.
Yeah.
Sir, here I'm not getting it.
Was it? Okay, it is. Just a minute. Just keep the cursor on that. Why are you getting an NPV in the first year? Okay, you have used the NPV formula. Okay, just press F2.
F2.
Just, yeah, F2. Okay, you are using, you have taken these. All right. Why are you taking negative NPV? But okay, in a way, you have to add that as well, right? NPV at the end. Okay, go to this. Go to last part after the bracket in the address bar. No, above that. You are getting 130. Final answer is 130.
इसमें माइनस लगा हुआ
That was like it was adding it. Done. Clear now? Are you there? I think. Sneha, can you hear me? Are you there? We can't hear you. All right, I think you
Yes, sir.
lost connection from the other device.
I had a minus sign. That was the issue. पता
All
नहीं
right,
कैसे.
no issues. Chalo. So now let us move forward and we are done with this chapter. Okay, Devjot, you are clear with this? The first part also?
Yes, sir, but I will again practice it after the class.
Okay, yes, definitely go for it again. This is tricky, little tricky. So, and Athava, you, Chalo. So now there is this one situation that what if the tax benefit is not available? That there can be a situation that you are working in a tax-free economic zone, or maybe you have losses in the current year or brought forward losses. So in that case, you are not going to have the tax savings. In that case, all you need to do is use the cost of debt as it is. Don't do the post-tax calculation for that. Okay, and there is not going to be any uh, this also tax savings on the TAD as well. Okay, so that is the case. This question you just go through on your own. That is very simple. Now these are just the theory part. Just go through this, and with this we are done with chapter number 6. Last part for the investment appraisal. Now remaining is chapter number 7. So chapter number 7 is also a very small chapter, which, by the way, is focusing on the risk. Okay. So for calculating the risk, okay, for first of all, we have sensitivity analysis. Sensitivity analysis is just comparing individual items with the total NPV. If you go through this question after this session, all you need to do in sensitivity analysis is pick up individual variables. You will be given like this: do the sensitivity analysis, calculate what percentage change in the following factors would cause your decision to change. Right? First of all, determine whether the project is worthwhile. So you have calculated NPV, and the NPV was positive 5329 over here. If the NPV is positive, the project is worthwhile. We'll go forward with the project decision. The project is worthwhile as the NPV is positive. The second part over here is calculate what percentage change in the following factors. These are the different variables. Okay. So what change in initial investment will result us to a negative NPV and we will reject the project. So that is simple. You just have to pick up an NPV. You have to just take the NPV, keep it in the numerator for all the variables. See, sales volume, initial investment, or whether it is your fixed cost, or whether it is your scrap value. For all the variables, okay, for all the variables except the cost of capital, you have to take the NPV in the numerator, okay, and divide that by the present value of that respective factor. So whatever is the initial investment, take the present value of initial investment. So present value of initial investment is always the same. That should not change. Okay, so you can figure out that 3.6% change in the initial investment. If your initial investment increases by 3.6 percentage, okay, your NPV will become 0. Okay, you can try this in this particular question. Okay, we had this, you have this Excel file of this chapter. Go over there on this question, try to change the numbers. Okay, we had done this in the class. I'm not doing this entire exercise right now. We are just revising the concept that this much change, this much percentage change in the initial investment can result in a negative NPV, can result in a NPV to become 0. Okay, in that case, we will change our decision. So initial investment, sales volume. For sales volume, what we are going to do, we are going to use the total contribution. Okay, total contribution. Total contribution over here is, you can see, it is 41,250 multiplied by the number of years. But over here, the present value of the contribution, okay, for all these years is 241,189. This is the present value of the contribution. Contribution every year multiplied by the annuity factor. This is your present value of the contribution for all these 15 years. Okay, that has to be there in the denominator, and that will tell you that if your sales volume, see, sales volume, or you can say sales price also, it matters over here, right? If the sales price also changes by 2.2 percentage, so sales price and sales volume, if you are asked to calculate the sensitivity of these two things, you have to calculate the contribution over here. All right. So, and variable cost as well. If the variable cost also increases, but mostly the question will focus. If there is anything related to sales, it will be sales volume only. And for sales volume, you have to use the contribution only. The major questions will be always about sales volume itself from the sales part. Similarly, fixed cost. If your fixed cost increases, what is the present value? See, these are your fixed costs. Yes, Neha?
Sales price, we can directly use sales, right?
For sales price, you can use the present value of sales. Okay, that is also fine. But I don't think there will be a question because it is slightly complicated. Like because that is also dependent on the volume. Okay, so I don't think it will be ever asked. But if it is asked related to sales price, you can use the present value of sales. Yes, you can go for that as well. That makes sense. Okay,
Okay, sir.
but volume is equal to contribution. That you have to remember. Okay, chalo. Fixed cost is going to be the same thing. Present value of the fixed cost over here, we have taken 87,705. All right. And then scrap value. Lastly, the scrap value. So scrap value also, you took scrap value, present value of the scrap value and divided by the NPV. You see the sensitivity over here is 289%. Quick recap: sensitivity, lower the sensitivity percentage, this percentage, the riskier is that particular variable. If your sales volume, see, and you have to think about individual items differently. Okay. Initial investment, if it increases by 3.6%, if the cost increases by 3.6 percentage, NPV is going to be negative. If the sales volume decreases by, because sales will reduce. Okay. If the sales decreases by 2.2 percentage, NPV will be negative. Okay. Fixed cost, if it increases by 6%, NPV will be. So out of this four items, you can see which is the most sensitive item over here for us. Can anyone tell me quickly? Chalo, any guesses?
Sales volume.
Sales volume is the most sensitive over here because it is the least percentage. The lowest is the percentage, which means a minor change in the sales volume will result in a different decision. So that is the sensitivity analysis. Scrap value, you see, is irrelevant for us. Okay, because over here there is too much sensitivity, 300%, which means if even if it changes by 300%, even if we have to pay for the scrap value instead of getting anything, we won't change our decision. So that is sensitivity analysis. Okay, lastly, there was cost of capital. So cost of capital, basically you have to focus on IRR. You have to calculate the IRR. IRR of this particular project is 15.7%. As we have seen that NPV at IRR is equal to 0. This is something which we have studied in the beginning. Okay. So NPV at IRR is 0. Right now, whatever is the cost of capital, whatever is the cost of capital given in the question, the difference is your sensitivity for that. So if it is asked that what is the sensitivity of this particular project in respect to cost of capital, you have to calculate IRR and you have to compare the cost of capital, both the cost of capital, and you have to say if the cost of over here, you see capital rises from 15 to 15.7%, the project will be rejected. If the cost of capital is beyond 15.7%, because then the NPV will become negative. That was about sensitivity analysis. The next technique that we use for risk analysis is simulation. So the most famous simulation is Monte Carlo simulation method. We don't have to do any practical related to Monte Carlo. Monte Carlo is slightly complicated. It is better if you go back to that particular lecture of Monte Carlo. Okay, you have to create the simulation. You have to run it multiple number of times. Okay, you will be provided with the probabilities of different variables. Sales can be 1,000 probabilities, 10%. Sales can be 10,000 probabilities, 50%. In that way, you're going to be given probabilities of various variables. From that, you have to use random number tables and run the simulation multiple times. And the final result, you have to prepare a list that I got an NPV of 2,000, 50% of the time, I got an NPV of 3,000, 20% of the time, and you have to prepare a probability distribution table. But this is something which is not examinable in a practical aspect. Okay, there can be any theory question from this particular thing. So if you are like, it can ignore this as of now. Once you are done with the rest of the syllabus, then you can come back to Monte Carlo, try to read the PDF. If you are not able to recall, you can ignore this and go back to lecture and then read the PDF again. But meanwhile, first of all, complete other items from the entire syllabus. Next thing is probability analysis. So this one is expected value. Expected value is basically nothing but multiplying the whatever. See, this kind of a probability distribution is given. Okay, project 1, it can either the project one say like the sales will decrease by there is 40% probability that this will be the NPV. There is 30% probability that this will be the NPV. There is 30% probability that this will be the NPV. So in that case, what you have to do is you just have to multiply the X with the probability. Okay, you just have to multiply these two items and you get the expected NPV of project 1, expected NPV of project 2. That is your expected this thing. Over here, there is this complicated question where you are given cash flows for 2 different years. Okay, so this question I would recommend that after this session, like this is something which you need to refer. Okay, so that is basically your expected probability. But what is expected probability? The most important part, the most important theory part over here is this one. This. If the decision is a one-off, the average might not be reached, making it an inappropriate situation. So I'm giving you a very quick and a small example about expected value. Okay, this is the most important theory part from this particular segment. Expected value. Okay, so let us say there are 3 particular possible outcomes, 3 possible NPVs. One is 100, one is 200, and one is 300. Okay, these are the only possible outcomes. You see, 150 cannot happen, 101 cannot happen, 201 cannot happen, 199 cannot happen. These are the only 3 possible outcomes of a particular project. The probability of this happening is 30%, this happening is 40%, and this happening is 30%. Okay, if you run this particular project 10 times, out of 10, 3 times you are going to get 100. Okay, 40% of the times, which means 4 times you are going to get 200. Okay, 30% of the times, which means 3 times you are going to get 300. Okay, if you run a particular project for 10 times, for 10 different times, these will be the outcomes. 30% of the time you will get 100, 40% of the time you will get 200, and 30% of the time you will get 300. So over here, you see my average over here. Average over here is 200, which is nothing but your xi multiplied by pi. 100 multiplied by 30%. Okay, 200 multiplied by 40%. Okay, and 300 multiplied by 30%. If I just add all these 3 values, I will get 200. Okay, so xi multiplied by pi, the expected value is nothing but an average. Average of what? If a particular project is undertaken multiple times. Okay, 10 times if I undertake this, on an average I will get a return of 200. But let us say if I have to do this only one time, if I will do this only one time, the actual result can be anything. Over here it can be either 100 or either 200 or either 300. Okay, any one of the 3. See, over here the numbers are taken in a different manner. Let me just take 250 over here. It is pure average. So let me just take a different number over here. That will make you understand better. Let me assume that this is 250. Chalo. If I take 250 instead of 200, what will be my actual result? Actual result will be 220, and over here 250, copy, paste, 220. Okay, 220. But you see, in a way, what is this average? This average is 220. In a way, what is the real possible outcomes? These are the only real possible outcomes. Okay, if it is a one-off event, if I have to undertake this project only one time, either of like any of the 3 values can be the actual result. Now, if you read this, if the decision is a one-off event, the average might not be reached. What is the average? 220. If you do it one time, you are not going to reach to an average. Okay, making the decision, making it inappropriate for such situations. You cannot use expected value, okay, in order to make this kind of a decision, one-off incident. But if you are going to use it for some event where you are going to repeat a particular project multiple times, Okay, in that case, you can use the expected value to make a decision. Understood, guys? Yes or no? Quickly.
Yes, sir.
This is for the probability analysis, right?
Why probability analysis? This is for the expected value. Yeah, whenever probability is okay, okay. In that sense, yes. Whenever probability question is given. That's what you're
Okay.
asking?
Matlab, if there's a question on probability analysis, then we can
Hmm.
write this. Yeah.
Yes, yes. Chalo. So that is your expected value. And the disadvantages in this thing, you can just go through this question. Discounted payback period is nothing. It's just the payback period where you are going to find out the present values of the cash flows, and then you use the cumulative present value. This is something very basic. Let's not discuss this. Risk management, this is all about just a theory part, that how you can just manage your risk by using different tools. So with this, we are done with the investment appraisal part. Okay. Now business valuation is also very simple, because the most complicated part in that was the discounted cash flow, which we have already covered. Okay. Other than that, the other methods of business valuation, net book value. Net book value is simple. You just take the total of all the this what we say, your assets, and subtract the liabilities. Okay. Net reservable. Sorry, here it is, assets minus liabilities, whatever is the equity, that is the value of your equity. Other than that, second method over available with us is net realizable value method. Over there, instead of the book value of the assets, what you are going to do, you are going to take the net realizable value of the assets and subtract all the liabilities, and you will get the value of the equity. Third method is net replacement cost. Okay, how much does it take in today's scenario to create a similar business? Estimated depreciated replacement cost of the net asset, like whatever assets you are having in your business. If someone wants to create a same business from scratch, how much investment do they have to make, right? And how much investment do they have to make for the depreciated assets? Like your asset has been used, let us say you have purchased 5 years ago. If someone wants to purchase a similar asset in the market, what should be the price of that asset? Or maybe if they purchase a new machinery today, what should be the depreciated cost for that? So that is your net replacement cost. Basic methods. Then comes the
So,
income based. Yes, Sneha.
what do we mean by depreciated? If it's a new machine and the cost of that is taken.
I'm going to take new machine. I'm not going to buy a new machine. I'm going to just go in the market and figure out that what is the cost of this new machine. Let us say you purchased a machine. Okay, over here, I'm just starting with chapter number 18. In that, first of all, we are talking about net replacement cost. Okay, replacement cost. So over here, what we are going to do, let us say you purchased a machinery for 100, okay, before 5 years. And let us say you are expecting that this will run for 10 years. So right now, every year you are going to depreciate it for 10 years. Okay, right now, what will be your book value in your books? It will be 50 after 5 years. If I go in the market and try to buy a similar asset right now, it will cost me, let us say 500. Okay, that is the cost of that machinery right now in the market after 5 years. Okay. Now your asset is 5 years old. So what would be the cost of this asset if I would have, like if the depreciated cost? Okay. If I want to buy a similar asset right now, right, the depreciated cost will be, I will calculate the depreciation on this. I'll say 50, 50, 50, 50, and at the end of 5 years, this should be the price. I'm not actually buying the asset. We are not actually buying the asset. We are just trying to calculate a cost. So we'll just go in the market. We will figure out that what is the cost of this new machinery, and we'll just apply the depreciation on that. That your machinery is 5 years old. If this machinery would have become 5 years old, then this should have been the cost. This should have been the price. Understood?
Yes, sir.
Okay. So that is it. Now the income-based valuation methods. Income-based valuation methods. The first and the foremost, we have price earnings ratio, and the another one is yield, uh, earnings yield. Okay, these two are the same. Just a minute, I will show how. And that is it. We have in the price earnings ratio. So basically price earnings ratio, let us just see what it is. It will also not take much time. Chalo, price earnings ratio. So let us say there is a company A, company B. So in company A, let us say the EPS is 5, and the price of that company in the market is, let us say, 100. Okay. And if let us say Divjot is running a company and the Divjot's company's EPS is 10. Other than that, everything is same. Like they are in the same location, same business. Most of the factors are same. Okay. Capital is also proportionate. What should be the value? What should be the value of Divjot company's share? Anyone can tell me quickly? Simple. Just don't think from like
200.
exactly 200. Proportionate to that, right? Your EPS is 500, 5. Your company's price is 100. What you have done is price earnings ratio is equal to 100 upon 5 is equals to 20. You just multiplied this over here, 10 multiplied by this. So basically price earnings for according to this formula, price should be whatever is the PE ratio multiplied by the EPS. Okay. So 20 multiplied by 10 and you can get this. All right. So that is that easy. And this is just about price earnings ratio. You can have it yield over here also. Yield would be, what would be the yield in this company A? Yield in this case would have been 5 divided by 100. 5 divided by 100, 5 percentage. 5 percentage. Your company's EPS is already 10. Okay. So if I say that what should be the price based on the yield, it should be 10 divided by 5 percentage. Right. Your company's yield is basically EPS upon price. Okay. Price earnings ratio was price upon EPS, price upon EPS. This one is EPS upon price, just the reverse of it, nothing else. All right. So this would be very simple. EPS is equal, price is equals to 10 upon this. What should be the price of this company? As simple as that, 200 and 10 divided by 5 percentage. Yield is nothing but the reverse of price earnings ratio. That's it. If you remember any one, then also it will. But I think this is very basic. So now, by far, once you have done the entire FM, yield and price earnings is something that you should be like doing. Uh, you don't even need to read the PDF. Clear with this, guys? Yes or no?
Yes, sir.
Devjot, Atharva?
Yes, yes.
Chalo. Perfect. Now, moving to the main part of this chapter, valuation chapter, which is your cash flow based valuation. So, for cash flow based valuation, number one is dividend valuation model. Dividend valuation model, this we are going to discuss now again in the cost of equity chapter. Just, yeah, sorry about that. Chalo. So, dividend valuation model. So, this is a part, something coming from the cost of equity portion, but let us cover it. Okay. Dividend valuation model, right? This should be covered first, then we should be going to the cost of equity. So, price of a particular company's share should be equal to whatever dividend that company is going to pay on the perpetual basis divided by the cost of capital. Okay. This is something which we have seen in the perpetuity formula also. Okay. That you could have, okay, present value of this, present value of a particular company's future cash flow. Let us say whatever is the cash flow, finite but for an infinite period of time, should be nothing but cash flow divided by R. This is something that we had discussed in the beginning of the session, right? Perpetuity. In the case of perpetuity, the present value should be this. So basically, as I have discussed earlier as well, that the price of a particular business or an asset or a security is nothing but the present value of the future cash flows. So basically, dividend for an investor is nothing but the cash flow that it is he or she is going to generate from a share, and required rate of return is the cost of equity. So price of a particular company share is equal to dividend upon the required rate of return. This is based on the dividend valuation model. Clear everyone? Yes or no?
So,
Yes, Sneha?
sir, the assumptions made are that the required rate remains constant, right? And then the growth rate would also remain constant.
No growth rate. We have not talked about the growth rate right now. This is a basic model that the cash flow is going to remain constant and the required rate of remain is going to remain constant.
So the dividend would also stay constant in this one.
Sorry. Means the dividend is going to remain constant and the required rate of return is going to remain constant.
Okay, sir.
Right. Now coming to the growth part. If the growth is given in the question, then our formula gets a little bit different. In that case, D0 multiplied by 1 plus the growth rate, and you just have to subtract the growth rate from the denominator. If a growth rate is given in the question that the dividend is going to grow at this rate, okay, then you just have to multiply that in the numerator, 1 plus the growth rate, and you have to subtract it in the denominator. This will be your formula in the case of the growth rate. Clear with this, everyone, so far? Yes or no?
So,
Perfect. Now, there are different methods of finding the growth rate. These methods we will discuss in detail while we discuss the cost of capital tomorrow. Or no, not tomorrow, today only, after the break. So, that is your first method of valuation based on cash flow. So far, we have seen four methods of doing the valuation. Now, these are the different questions for different scenarios related to the growth rate, which you should be going through. Okay, and now comes the last part, which is the discounted cash flow basis. And over here, it becomes very simple. You just have to find out the present values of the cash flows. Whatever is the present value of a cash flows, that is the value of the asset. That's it. That's the DCF, discounted cash flow method. Other than that, the practical aspects and everything, this is all the theory part. I would require you to just go through this. Behavioral science, these are the factors which are going to affect. See, so read the heading. Practical factors in business valuation, apart from whatever we have discussed, the numerical part, right? What can be affect the marketability, liquidity? If a particular share is not liquid, it is illiquid, it is going to be valued less. If a particular share is not marketable, means liquid, it's not liquid, it's going to be valued less. Information sources, okay, a private company shares, okay, because a lot of information is not publicly available, its value is going to be less as compared to someone which is listed in the stock exchange, because their information is available very easily, right? So that is one of the factor. Market imperfections and pricing anomalies. Market imperfection and pricing anomalies means that the general market is not that rational. Okay, fundamental value. See, while as an analyst we are doing so many research, we are doing cash flow, we are doing applying discounting rate and all those things, we are assuming that the general investor are very rational. They will also do all the things that we are doing, right? We have done a lot of research and we have figured out that the value of this particular company share should be 100, not more than that. But there are people in the market who are ready to buy it at 150, 200. They are ready to buy it. Even the PE ratio is 300. P ratio being 300 means you are ready to pay 300 rupees for a share which can give you a earning of only 1 rupee in the entire year. People are ready. Now, if you find the yield over here, it is going to be very low, 0.000 something. Okay, people are ready to buy at that price, right? So there are market imperfections, there are pricing anomalies. What can be the reasons for that? There can be human behavior. Then there can be, these are the different reasons. January effect, people sell shares at the end of a particular financial year to save taxes. Overreaction effect, small war news is going on and everybody starts selling the shares, right? Small capitalization discount. Small capitalization discount means uh, if the company's market cap is very low, the big institutional investors are going to ignore that company. If the mutual funds, the pension funds, they are going to ignore the small funds, small companies. As a result, they are not going to be valued properly, those small companies. Okay. Market capitalization is nothing but basically ordinary shares multiplied by the market price per share. But there are two things which is going to affect the market cap. If someone, let us say, try to sell the entire company, let us say for 50 more than 50 percentage of the company, right? They are giving away the control of that company. In that case, if let us say I am selling 51% stake in my company, right? I would ask you for a control premium. Okay. So generally, market cap is not going to give me an idea that at what price the actual deal is going to happen if the stake is more than 50 percentage. Other than that, if the if let us say you bought the shares of my company, but if you if let us say I want to sell the shares of my company, and if I start directly selling in the open market, 51% of the stake I want to sell, right? In that case, my price will drop drastically. Being the promoter, if I sell a huge chunk of shares, right, the price will drop drastically. In that case, I need to sell it off the exchange. I need to sell it off the exchange, and in that case I have to give the discount to someone who is buying from me. So these two things are contradictory, but these two things are applicable in the real life deal as well. Based on the situation, based on the real life situation, the final price between two parties will be decided. Okay. So behavioral finance, there are so many behavioral things, different. You have to read through all of this, different uh, behavior patterns that the traders or the investors are going to have, and as a result, there is going to be pricing anomalies in the market. The price will not be actually the way it should have been. All right. With this, the chapter is over. The debt valuation is like in the debt valuation. This is the first thing: preference dividend. The same formula, price of the preference share dividend is equals to dividend upon the cost of equity, cost of the preference share, right? Same goes with the irredeemable loan note, same formula, nothing different. Other than that, whatever is left is also redeemable loan note. All right. So last 5 minutes we'll be wrapping this up. In the redeemable loan notes, there is a possibility that the loan notes may be convertible. Like there is sorry, redeemable loan notes is simple. You can just go through this. It is not that different. But this one is important. Convertible loan notes. Convertible loan notes. What will happen? Let us say this is important. Chalo, focus over here. Convertible loan notes. Okay. If I tell you that right now, whatever is the share price, whatever is the price of my bond, okay, we are talking about loan notes. We are talking about bonds. Price of a bond is, let us say, 90 rupees as on today at year 0. And the rate of interest, coupon rate is 10%, which means this is going to be paid on par value of 100, which means I'm going to pay you in 1, 2, 3, 4, 5. For 5 years, next 5 years, I'm going to pay you 10, 10, 10, 10, 10. Or from the investor's perspective, what will happen? 90 is the investment, 10, 10, 10, 10, 10 is the cash flow. Okay, we are trying to find out the cost from the investor's perspective. So investor would have to invest 90 today, which is the share price, and they are going to receive 10, 10, 10 for the rest of the 5 years. And in the 5th year, this can be converted. Whatever is the outstanding amount, you are going to receive that par value. But this can be converted into shares. Those shares right now value, let us say 5 rupees per share. Okay, so as per the right now's ratio, we are going to give you 20 shares at the end of the 5 years. But let us say after 5 years, okay, the price of the share has become, let us say 10. Okay, 10 rupees per share. All right, in that case, the value of the total shares that you are going to receive is going to be 200. So if you are an investor, you have the option either go for the par value or go for the share value. What will you choose? Tell me. Is there anyone who will choose this?
No,
Hello? No, right? So you are going to choose this. So while doing the valuation of a convertible loan note, what you are going to do, you're going to find out the present value of these particular cash flows, present value of these particular cash flows, and you are going to find out the present value of any of the two things, either the par value or this, whichever is higher. Okay. That is all about the convertible loan notes. You have to pick up any of the two, whichever is higher. So that is something that you have to go through in these questions. And that ends your chapter number 18, which is your valuation. So valuation chapter, in the entire chapter, I would ask you skip the rest of the part. Like you can, I am pretty sure that if you have done the entire FM well, you will be very confident in the rest of the things. What you need to focus is on this particular part, convertible loan notes. Spend more time on this, solve all these questions. These are the three different types of questions which can be asked from this particular section. Three to, there was a third one, two, and okay, only two questions are there. So solve these two questions, and maybe if there are any other section C questions, this is important from this particular chapter. This is the most complex thing from this particular chapter. Go into the section C questions file and solve over there. Got this, everyone? Yes or no?
Yes, sir.
Sir,
Yes, Neha?
can you explain this one step wherein the redemption take place in 7 years and conversion took place in 8th year, so we
Eighth year.
do the
Okay.
discount?
So
Yes.
let us solve that question. So just give me 5 minutes. I'll be back in just 2 minutes. I'll be back in 2 minutes, and let us solve that question. Okay.
Just that step.
All right. Chalo. So let us do this. This question itself, in this question itself, there is a situation that either the loan is redeemable at par after 8 years, or alternative, the loan is convertible after 7 years into 11 ordinary shares. These two are the options available. So what you can do is over here in this particular question, uh, let me just write question 10 over here, and you just want to understand the last part, that how to calculate the present value for that. So what I'm going to do is that let me just write the year and everything so I can explain it better. So this is going to be 0 to what is the number of years? 8 and 11. All right. Chalo, let us directly find out the present value of the redemption thing. Okay. Present value. First option is option 1. Par value. Par value after 8 years. And the option number 2, is what I can say, price. Share price. Shares after 7 years. All right. We have to compare these two things. So over here, first of all, par value, what will be the redemption value? Redemption value will be 100. But apart from this, interest for the 8th year is something that you are going to get. Interest of 8th year. If you go for this particular option, you will get one more year's interest, right? Which is, what is the rate of coupon? 7. So 7 over here you will get. So total you are going to get is 107, right? If let us say the shares after 7 years, now over here there are two situations, that the current share market value increases by either 4% or by 6%. All right, this was the situation. So current ordinary share price right now, current market price is 6.5 per share. All right, 6.5. And over here, let us assume the growth rate of, right now I'm assuming the growth rate of 6%. Okay, the another one you can do it on yourself, 6%. So in that case, the share price after 7 years will be this multiplied by 1 plus the growth rate raised to 7 years, 9.77. Okay, so the redemption value for you, right, 11 shares, you can convert it into 11 shares, will be this 107.509, and this is 107. So both are 107. So you might feel, sir, it is irrelevant. But no, this is after 8 years and this is after 7 years. So it is clearly evidence, Neha, if someone is giving you 107 after 8 or 107 after 7, which one will you choose?
107 after 7.
After 7 years, because of the time value of money. But still, if you want to have a numerical reason over here, what you can do is convert this. If I draw a timeline, okay, This is a very weird timeline. So let me just have a straight timeline over here. Chalo. This is year 0. This is year 8. Generally, so far what we have learnt is that we were converting everything to present value and that was easy to compare. Right now, the problem is that there is one element which is available on the 7th year. Let us say this is the 7th year. So there is this price 107. The share price is available for 7th year, and this one is available. The redemption value of 107 is available for the 8th year. If you want, you can convert this into 7th year, okay, and that can be done by discounting by 1 year. If something, if you were given that this will be the value after 1 year, what you will do, you will find the present value as on today. You will discount it by 1 year, right? And that will give you present value by 1 year. If you go from 1 to 0, right, 1 to 0, you are discounting it by 1 year. So if you want to go from 8th to 7th, what you will do is you will just discount this by 1 year. So 107 divided by 1 plus 8% is the, I think, the cost of debt in this particular case, raised to 1 only. So this should be the actual value of this redemption value 107 as on the 7th year, 99.07.
This is cost of debt after tax, right? Or before tax?
Before
Tax.
tax,
Okay.
before tax we have to
Okay.
take, because we are talking about the expectations for the investors.
Yes, sir. Yes.
Whenever we use we are doing calculation for investors perspective, in that case we will take before tax. Whenever we will do from the company's perspective, cost to company, in that case we will use post tax.
Yes.
Okay, chalo. So for Divjot and Atharva, it would have been a slightly bouncer because you are not familiar with this question. Once you will solve other questions related to convertible loan notes, then you will be familiar with this situation. Okay.
Sure, sir.
Yes, sir.
All right. Chalo. So with this, we have done with the business valuation as well. Now we are done with the two major areas of our syllabus. Okay. Now, cost of capital won't take much time. It will be hardly 1 to 1.5 hours of session today. And then by the evening, you can complete these three areas, section C questions from these three areas, and you will be pretty much done with like more than 50% of your syllabus for tomorrow. Now, we are going to start with the last part today, which is COC, cost of capital. So I'm starting with chapter 8, first of all. So cost of capital, if I let me just see if others are joining. I guess Divjot won't join. Atharva just joined and but he's facing some issue. Chalo. Let us begin. So, first of all, equity finance. Basically, what is cost of capital? Cost of capital is like this particular segment of the syllabus is dealing with how to figure out the WACC. Throughout the investment appraisal and throughout the valuation part, the most important part over here was the discounting rate, which we can say is nothing but a WACC. Majority of the cases, WACC is our discounting rate, or maybe sometimes in some situations, discounting rate can be something else. As we have seen in the lease and buy decision, the finance part was calculated using the discounting rate of this debt. Okay, post tax cost of debt. So over here we are going to learn what is actually WACC. So WACC is basically a weighted average. WACC is a weighted average of all the different types of uh, capital that we have in our business. So it can be because of cost of equity, cost of debt, it is cost of preference shares, or maybe any other types of capital that you are using in the business. So because in debt also there can be different types of debts, right? So we Chapter number 8 talks about cost of equity. First of all, this chapter number 8 is going to talk about detail in cost of equity, and chapter number 9 talks about only the types of debt. What are the different types of debt that is available for the business? And then 10 talks about the WACC, and that we will see in a while, one by one. So first of all, what are the different sources of equity? One is retained earnings. Okay, retained earnings is, it is something that the business is already having, but it is still a part of the equity. In our balance sheet, we always show that retained earnings is nothing but a part of the balance sheet. So it is also an important source of capital. But if you are using retained earnings, you should be aware that the expectations of the shareholder, that the return that you will be generating on this retained earnings is also equivalent to the cost of equity. Please be mindful that if you are using the retained earnings, don't assume that, sir, this is the fund which was already with the business, so we are not liable to generate any return on that, right? Because it's not the case. You have to generate the exact same return as the shareholders want, right? You have to generate the return as per the expectations of the shareholders over here, because that is the fund owned by the shareholders. So retained earnings is basically the internal source of fund available to us. Apart from this, there is one important theory related to equity finance, not equity finance, but related to source of capital, which is pecking order theory. Pecking order theory says that because of certain reasons, you have to follow this sequence. Retained earnings, whenever you need funds, you should follow this sequence. First, you should try to use retained earnings. Second, you should try to use the debt. Third, you should try to use the equity. In this sequence only, you should try to take the funds in your business. The what is the reason behind this sequence? Reason number one, issue cost. If you look at the cheapest source of new finance, it is retained earnings. You don't have to pay anything extra in order to uh, raise funds, right? Because this is something which is available with the company itself. So retained earnings is the cheapest source of funds. Then if we talk about the issue cost of bond issue or bank issue, it is cheaper. It is the next cheapest source of new finance as compared to, it is cheaper as compared to the equity. The most expensive source of new finance is fresh equity. So you have to use the pecking order theory. One of the reason is issue cost. If we talk about the asymmetry of information, so what happens is, further justification is the existence of asymmetrical information. What happens is, so what happens is that those who are, this is, let us say, the business, okay, those who are within the circle of the business, the management and everyone who are inside the business knows more than what someone knows from outside the business. This is known as asymmetry of information. The knowledge they have about the business is more than the knowledge someone else is going to have about the business. Because of this asymmetry of information, what people will do, they will try to, this person who is sitting outside the business will try to judge the actions taken by the management. If let us say you take debt, if let us say you take debt, you give a signal in the market that you are confident about the cash flows of this business. Why? Because you are ready to pay fixed interest. Okay, this gives a good image in the outer world. Okay, but if you are not taking debt for a particular project, and let us say you are raising equity for a particular project, this gives a signal that you are not confident about the cash flows of this particular project, because you don't want to, and thus you don't want to commit to a fixed interest cost. As a result, you are going for equity. So this gives a bad signal to the investors outside the company. So this is also one of the reason for using the pecking order theory. Okay, conversely, outside investors assume that managers with unfavorable inside information would issue shares as they would be overvalued. Okay, one more reason, because of asymmetry of information, what happens is that right now, let us say price is 50. Price of my share is 50. And if I want to come up with an issue, let us say I'm going to come up with a new share issue. Okay. But I know that the quarterly results are very good. Quarterly results are very good. The company share price is going to increase in the future. From 50, it might become 70 in the future. So if I want to raise new capital, will I raise the new equity shares over here or will I raise the new equity shares over here later on? Right? Yes or no?
Raise later on.
Yes. So we will raise later. As a result, what happens is whenever you will come up with a issue, okay, right now you are not raising the funds. Yeah, right now you're not coming up with the issue. As a result, the outside people, whenever you will come with the issue, whenever you will raise later, whenever you will raise the funds, whenever you will come up with an IPO, the people outside the company will think that this is the maximum value that the company's management thinks that they can get. As a result, they have come across with the new issue at this price. And as a result, as soon as you come up with the issue, the price will drop because this is something that they feel is the maximum price that they can get for this particular share. So in this way also, it is going to the signaling is like in this way also the management is giving a signal to the people in the people outside the company, and as a result equity is considered as a bad sign. Whenever, therefore, an equity issue is interpreted as a bad sign, investors may start to sell their shares, causing the share price to fall. The issue of equity is a last resort. So that is also one of the reason for the pecking order theory. Lastly, just a minute, I will be back in a minute. Yeah, sorry about that. So let us continue. So the third reason is the available sources. Internal finance, as the retained earnings is the internal finance. It is going to be available very easily, right? If you go for a debt, it becomes like you can get debt easily as compared to the equity. But if you try to get the equity finance, it is going to be this. They will become heavily equity finance. Okay, so if you go for the equity finance, it will become very difficult to get the equity finance because people are not going to invest in your company because there is very high chances that they may not be able to recover the funds. So these are the three reasons why the packing order theory holds true, and the particular sequence. Generally, the companies follow particular sequence for raising the funds. Now, working capital management, we will discuss that in detail in the working capital area. Right now, you can ignore that. External equity, these are the different sources of external equity. We have offer for subscription, offer for sale, placing, rights issues. These are the different ways through which the external equity can be raised. Internal equity is nothing but the retained earnings, but the external equities are
So,
this different sources. Yes, Neha.
what's the difference between offer for sale
Offer for
and
sale and
subscription?
offer for subscription. Okay. See, when I come up with a new IPO, what will happen? This is the company. Let us say this is the company, and this is a very weird building. Okay. And they go to the general public. Okay. Over here, I am placing my shares on a, let us say this is a stock exchange. Let us say NSC. Okay. So what will happen? I will just give the shares of the companies to the general public. Public can get the shares of the company, and they have to pay the money. This is just a normal IPO and everything. Now this one, offer for subscription, is basically taking money from the public for the shares, against the shares directly from the public. Offer for sale or subscription by tender. If I add a feature of tender that the public can do the bidding, okay, they can do the bidding. They can say that, like, for example, right now I have given my shares for the IPO. Generally, if you see in the IPO also, you have to do the bidding. You have to give that what is the maximum price that you are ready to pay and what is the minimum price. Like, there is a price band. You have to select that what is the price at which you want to subscribe. Generally, everyone subscribe. The general everyone applies at the higher price only, but that is a tender where you are getting an opportunity to decide a price in a price band. So that is offer for subscription. whether it is normal or tender. Now, what is offer for sale? In offer for sale, company is not going to give the share directly on the exchange to the general public. Rather, they will give it to some institute, investment bank or something like that. Okay. This investment bank will purchase all the shares of the company, and this investment bank is going to give it to the general public. They are just going to sell the shares. So the company does not have to enter into this entire chaos of launching an IPO and giving it to the general public. This investment bank is going to give the shares to the general public. Clear?
And then placing is also same.
No, placing is finding the private investors. In placing, the sponsor, typically an investment bank, places the shares with its client, usually pension funds, insurance companies, rather than offer shares to the general public. You are going to have bigger clients, insurance companies, pension funds, like that.
So everything else is same, just isme we are directly selling it to the client rather than
Yes,
public, right?
yes, yes. The equity share is the same only. It is just the method of giving it to someone, like whether you are giving it to general public or some specific clients, or how you are giving it to them. That is different.
इसमें भी first we'll sell it to the investment bank and they'll sell it, right? आगे?
No, we won't sell it to the investment bank. They will find the clients for us. They will, these people only will buy. They will act as a broker or commission agent over there. Over here, we are selling it to them.
Okay, got it, got it.
Clear? Chalo. Rights issue is, I guess, very simple. Now,
Yes.
moving on for the options for unquoted company. So unquoted companies, what can they do? They can become quoted. They can list their shares. They can stay unquoted. Okay, rights issue or private placing. They can raise funds through rights issue or private placing to engage in what is known as introduction. They will just bring the company to the exchange. See, over here they can raise new equity. Okay. Over here, they are just bringing their company in the exchange. They are not raising new funds. All right. So that is for options for unquoted companies. Then IPO factors to be considered. What are the things? What are the legal restrictions and everything that you can just go through? Official listing requirements in different countries. These are the listing requirements. That is fine. Alternative markets is basically the market for smaller companies, small size companies. We called it SMEs, small and medium sized entities. Okay, in India, we have SME IPOs and everything. SME exchange is a different exchange. So there are markets for smaller companies as well. What is important in this chapter is this, talking about the practical part. Okay. Theoretical X rights price. TERP. Theoretical X rights price. So let us directly take an example and we can just know that what is theoretical X rights price actually. So over here we are taking this example, question number 1. Okay, theoretical X rights price is basically trying to find an average price after a rights issue. Once you give the rights issue, you are actually giving the price at a very high discount. Okay. Okay. Can we take the second one? Yeah, sure. Let us take the second example instead of the first one. So here is the second example. So assume in question 1 above that Mr. X. Okay, the second example is also okay. It is based on the first example. So first of all, we have to calculate the X rights price, and then we can discuss their profit and everything. So first of all, company has 100,000 shares. Okay, this company has 100,000 shares. So what I'll do is I'll just create some columns over here. Okay, number of shares, and number of shares is how much? 100,000. Okay, then we will have with a current market price of 2 each, current market price of 2. So the total equity market cap, I can say market cap is basically Market cap is this multiplied by this. This multiplied by this. All right. Chalo. So that is done. Hmm. Okay. Now, after trading closes for the day, the company announces it will take on a project with an NPV of 25,000. Now, if the company is taking a project with the NPV of 25,000, right? NPV is basically the profit it is making, a notional profit it is making as on today. If I am taking a project whose future values, okay, are something different, but the present values of those future values as on today is more than the initial investment that I am making, and it is more than by 25,000. So what will happen, this 25,000 will be added in my market cap. The market will react in such a way that my share price will go up, my share price will rise. Over here my number of shares are same only, 100,000 only, but my total cap will increase. Okay, it will increase by 25,000. Whatever was my market cap, that will increase by 25,000. And as a result, my share price would have increased. See, this is not how you have to do it in exam, but I am just trying to show it in the form of numbers that this is what is happening. The market price will increase in such a way. If I accept a project with positive NPV, the market price will increase in such a way that this is incorporated. This NPV, the project with positive NPV, is incorporated in the share price. The project will be financed by a right issue of one new share for every two existing shares. One new share for every existing two shares. The rights price is $1 per new share. So, what is happening? You are issuing new shares. What is the new shares? uh, for every two shares, existing shares. Okay. So you are going to divide it by two. This is how many new shares you are issuing. And how much money are you getting against it? You are getting $1 against it. So technically, how much money is coming into the business? This is the money coming into the business. Now, if I try to find out my actual market cap, my market cap will be this only. This is the actual assets that the company is having with itself, $275,000. And what is the number of shares? The new number of shares will be 100,000 plus this. All right. So now the actual price of my company share should be this 1.833, taking into account both the things. One is your positive NPV and your this particular thing, the new money that is coming in the business and the new number of shares. So this should be the price of my company. Will this exactly be the price in the market? The answer is no. We don't know what will be the exact price in the market. This is a theoretical X rights price. That once the right is exercised by the uh, shareholders, then the price should become this much. Okay, getting the point of theoretical X rights price.
Yes, sir.
Perfect. So now that is represented by this formula. Now, if we go back to this formula, pre-existing value of the company, pre-existing value of the company was 200,000. Okay. Plus the proceeds of the rights issue. Proceeds of the rights issue were 50,000. I can just select this. And the project's NPV, whatever is the positive NPV of this particular project, this has to be divided by the number of shares after the rights issue. So in this particular case, it is 150. If you divide these two things, you will get the theoretical X rights price of 1.833. Now coming to the second question, which is assume in question 1 above Mr. X owns 1000 shares in his company. A shareholder's wealth depends on whether he exercises his rights. So Mr. X position, if he takes up his right, if he takes up his right, let us say he is owning 1000 shares. So let us create this of Mr. X 1000 shares. Okay, number of shares and the current market price and value for Mr. X. So over here right now the current market price was 2 and Mr. X value that Mr. X was having was 2000. Now show Mr. X position if he takes up his rights. If he takes up his rights, so what will happen in that case? See, if he takes up his rights, the X rights price, theoretical X rights price is 1.833, which we know. And what will be the number of shares he will be having? He will be having this plus the 50%, which means the extra 500 shares he will get. In that case, his value will become this multiplied by this 2749. Okay. But in this case, what is happening is that he is investing 500 shares, and over here he is putting $1 each. So 500 is something that he is putting in the business, sorry, in the company. He's giving 500. As a result, his net profit, if you will see, is this minus this 2. Clear with the first one? 249 is his profits.
Yes, sir.
So Mr. X position, if he takes up his right, in that case, he is a profit of 250. If he sells his right, if he renounces his right, so what will happen if he will sell his share? So first of all, I'll just copy this, and now I'll just paste it over here. In the second situation, this is something that we already have. If he sells his shares, if he sells his rights, what will happen? This 500, he will invest at 1. That is something that will be his investment. But now if I just look at the profits on what is he having after this. So I can say this is his investment, okay, and this is the assets that assets that he is having, or I can say the uh, whatever he is possessing. So over here,
But he didn't take the right.
no,
So how did he get the price? One.
he renounces and sells his rights.
Yeah, so how is he getting 1,500 shares? It would just be 1,000 for him, right?
Okay, sorry, he will be selling his rights directly straight away. All right, so what will happen over here, his investment will be just this 2000 only, and over here his shares will be just 1000, and this will become 1.833, right? But apart from this, he will sell his rights. So his rights value for his rights was, now we have to find the value for the right. So the value for the right, this particular share will be worth of 183. Like the future value, I cannot use the word future value, otherwise it will create confusion. But I can say theoretical X rights price of this particular share is going to become, like, this is the price of the share that is going to become. He right now has some contract with him, he has some right with him. That right is right now worth, we have to find out the worth of that right. If he uses this right, or if he sell this right to someone else, okay, then that person can buy this particular share for just $1, because that is the value, that is the amount that you have to give because of that right. So technically the value of that right should be, the contract should be 0.83, right? So if he is selling that particular contract, he had how many contracts? 500. So if he sell that particular contract, what is the amount of cash that he will be having with himself? He will be having a cash of 416 with himself. Getting this?
Yes, sir.
So this is what his profit will look like in the case of selling the rights. Chalo, clear till here?
Yes, sir.
And last one is does nothing. So if he does nothing, then in that case is not going to get the benefit of selling the right, or maybe let me just do it over here. So he's not going to get the benefit of selling the rights or having the rights, having the shares. So in that case, his value will be like 270. No, not this much. It will be just 1000 shares, and he will have a loss of 167 over here. He will suffer a loss of 167. That is the question related to theoretical X rights price. Clear?
Yes, sir.
Perfect. Now we have, okay, there was one more thing. Like, here it is. See, once you calculate the theoretical X rights price, value per share, value per right is this 0.83. Now, if I say value of a right per existing shares, I just have to take the value of a right share, value of a right divided by the number of the existing shares that I need for that right. So that will give me value of a right per share. Chalo. So that was it from this. Now, bonus issue is something, bonus issue, stock splits, these are the different, these are like both the things are ultimately going to have the same effect. This you can just read once. Dividend policy. Okay, what are the factors affecting the dividend policy? Legal constraints. Company has to do give the dividends based on the legal factors, right? Liquidity requirements and shareholders' expectations. Those are the things which you should be taking in mind. Signaling, as you give more dividends, it will signal that the company is going to have a good thing. If you give less dividend, it is going to signal that the company is facing some issues over here. Stability, borrowing covenants, these are the different borrowing covenants because the banks are going to put limits on you about how much dividend you can give. So these are the different things which you need to keep in mind while deciding the dividend policy. What are the different dividend policy? Constant dividend, paying the same amount every year. Constant growth, growing the dividend every by the same amount every year. Constant payout ratio. Okay, whatever profit you make, if you make 100, you are going to pay 10. If you make 200, you are going to pay 20. Constant payout ratio. Residual dividend policy, that invest in all positive NPV projects. Whatever positive NPV projects are available, first invest in that, and then whatever is the leftover, that you can give in the form of dividend. Zero dividend policy. This is applicable to high growth company who has to grow right now. They cannot afford to give dividends right now. So these are the different alternatives. Five alternatives for dividends. What are the different five dividend alternative policies? Now moving on, dividend theories. Clientele theory. Clientele theory says that if you are giving, let us say, constant dividend on a regular basis, okay, then according to this theory, whatever people who are going to invest in your company, okay, those people exactly know that you are going to give constant dividends. You are giving rupees, let us say 10 rupees dividend every year, or maybe you are growing at a rapid at a constant growth rate every year. So they have this particular predefined set of expectation that every year we are going to get this only. If you change your policy, if you change your dividend policy, these people are going to be affected. Let us say a pension fund has invested in your company and they wanted the regular money, they wanted the regular dividend in order to pay the liabilities. But if you change your policy, they are going to be affected. So they are your clientele, right? A group of specific clients who are coming on a regular basis. So if you change the dividend policy, this PF fund will go to someone else who is paying a regular dividend, and now you will have a new client base who will be interested in the new policy. But if you keep on switching on a regular basis, you won't have your particular clientele, you won't have your particular group of investors, predefined set of investors. So this is something the company should be taking care of. They should follow a constant dividend policy throughout the year. Then comes the bird in hand theory. Bird in hand theory says that no matter what happens, okay, the investors prefer dividend over capital growth. They want the money right now in their hand. Okay, you give me the money immediately, I will invest somewhere else, and then I will figure out what to do with that. But this theory has a counter agreement that if you say that the just a minute, bird in hand theory. So if you say that the investors are interested in dividends only, right, then for example at the time of making the investment, let us say this particular guy had decided that I am going to invest in this five companies, and he has done a lot of research that these are the five best companies. If you give him the dividend, whatever growth he is expecting, whatever is his future growth expectations, right, required rate of returns, he has already said that these are the five best companies and I want to invest in them only, right? Then again, if you will give him the dividend, he will again invest in these five companies only. Then why do you want to repeat this cycle again and again? Instead of that, shareholders would want that, like those who are expecting the growth, they would want that they are not given the dividend and their money is reinvested in that company itself, and that company should grow on a at a good pace. So in that case, that theory says that bird in hand theory is completely not wrong. So that is a contradictory theory over here. Now comes the dividend irrelevance theory, that whether you pay the dividend or not, Modigliani and Miller says that it doesn't matter. This third theory related to dividend says dividend irrelevance theory. Irrelevance. This theory says that it is not like the shareholders are irrelevant whether you pay the dividend or not. Why? Because over here, let us say there is company A and then there is company B. Let us say this company, in this company, someone has invested 100, 100, and over here, someone has invested 100. Okay. They are getting an ROI of, let us say, 10 percentage. Okay. Return on investment, return on capital employed, let us say, is 10 percentage, and same over here, it is also 10 percentage. But in this company, there is a retention, like the retention ratio is 100%, not 100%, let us say it is 50 percentage, which means you are retaining 50% of the money. So the money retained will be 50 percentage of whatever is the profit. This is the money retained, and the dividend paid is this minus this. This is the like this is paid in the form of dividend. As a result, the closing capital in the business, closing balance, will be this plus this. So if I just copy paste this entire thing over here in this company, let me just paste it. But over here, let us say the retention ratio is 0. You are paying the 100% dividend, okay, and your closing should be this plus this minus this. Similarly over here, closing is as it is 100 because you have paid the entire dividend. Now what happens is, now if I just repeat this entire cycle, the next year the balance over here will be, you see, this company is growing and this company is not growing. Now this company's share price is growing because it is retaining the money and there is a growth, visible growth. But over here there is no growth, the share price remains the same because everything is given in the form of dividend. Over here, whatever was retained, that is reinvested and that is becoming the part of your capital and that is growing over here. So the dividend irrelevance theory says that, let us say over here, this particular company who has retained, let us say there is some shareholder, okay, who wants dividend, who wants entire 10 in the form of dividend. So what he will do is, just don't think this as a single share, just think about this as a portfolio. Your portfolio is right now, like your entire value of investment is 105. So what you will do is, you will sell shares worth, out of this, you will sell shares worth 5 over here. As a result, your again portfolio will become 100 in both the cases. Okay, whether the dividend is given or not. And what will happen? You had received a dividend of 5, but you sold shares worth 5. So technically, you also received 5 over here. Getting it? Understanding this?
Yes, sir.
Perfect. So this is dividend irrelevance theory. Next year, what will become your opening balance? Your opening balance is 100. Again, the same thing. This is, yeah, like your value is this. Now again the same thing. Again over here, you will sell worth 5 worth of shares. You will sell, and this you got in the form of dividend as well. So same thing. Dividend irrelevance theory says that you can sell the shares as much as you want in order to make it just like a dividend. As a result, ultimately your growth rate will be same as someone who is getting 100% dividend. So dividend irrelevant, but over here what happens is, uh, so that this is the theory. If the company pays no dividend, the share price should rise due to the reinvestment of earnings. Any shareholder who requires dividend can sell part of their holding to create a capital gain, okay, which is known as homemade dividend. Homemade dividend. But there are certain assumptions over here, that no distortions from personal tax system, that is the dividends and capital gains are taxed at the same rate in the hands of the investor. But in real life, that is not the case. Capital gains, capital gains tax is charged lesser as compared to the dividends. So generally, share investors do prefer capital gains instead of the dividends. No transaction cost, perfect market. Perfect market never exists. We have seen it. Chalo. Alternatives to cash dividend, share buyback program, or special dividends. This is something you can just go through on your own. SME consideration. What are the considerations for SME? What is SME? Difficulties in raising finance, because they are small companies. They face difficulties in raising funds. Perception of risk and uncertainty. Their internal control is weak. They are like there is a lot of asymmetry in information. It is dominant by the owners. So these are the reasons why they are not able to raise funds easily. Absence of security, right? They don't have enough collateral to offer, and shares lack marketability, liquidity is low, tax consideration. In many countries, personal tax incentives are offered on contribution to pension funds, and as a result, pension funds are having large liabilities, so they do not invest in the small. This reduces the potential funds to small companies. The retail investors are also not investing in small companies. They are also not investing in small companies because they are getting incentives because of investing in pension funds, and the pension funds are not going to invest in the small companies because they don't want to take the risk with someone else's money. Funding gap and maturity gap. Basically, the kind of collaterals they have here to offer medium term assets, right? But nobody is giving medium term loans to them. As a result, they use these assets in order to fund the short term liabilities. They use this medium term assets to fund the short term liabilities. This is known as the funding gap and the maturity gap. Financing solutions.
What about the long-term loans?
Long term, they are able to get. Long term, they can easily get long term assets against the long term liabilities. This is something which is available to them because this is kind of like they can trust over
Collateral.
here. Yeah, they get the collateral over here. But see, this kind of, see, land, if you think about land, land is easily sellable and land is kind of secured asset. But if you look at my machinery, right, medium term asset, bank cannot do anything with the machinery, right? They have no use of the machinery. It is very difficult to find its buyer. So in that case, they are reluctant to give the medium term loans. They give the short term loans for that. And other than that, short term assets like inventory and all things, that is also used for short term liability. So that is that. Financing solution. Government should focus on the tax policy, interest rate policy for like lower interest rate for borrowings by these people. So that is the financing solutions for the governments. Venture
Can't hear
capital.
you, sir.
Okay, just a minute. Let me check my mic. Am I audible now? Am I audible?
Yes, sir.
Okay, all right, chalo. So venture capital is basically they are like investors, big investors, private equity, business angels. These are the different sources of equity for small and medium size businesses. So this is something easy, and you can just have a quick glance at it. Government assistance. These are the sources of equity. Crowdfunding is also one of the sources. So that is broadly like this. The major practical aspects from this chapter was theoretical X rights price, and especially value of right per share. That is something complicated, and the profits that the individual shareholder can make by either selling the rights or by investing in the rights issue, and what happens if he does nothing. So that is something that you need to remember from this chapter and try to practice that. Other than that, it is very simple. The entire chapter is very simple. Yeah, any questions?
No, sir. All three.
Okay, chalo. So this one is done. Now comes chapter number 9. Chapter number 9 is again nothing but the sources of debt only. Preference shares, bonds, deep discount bonds, mortgage. What are the different types of debt finance that the company can have? So this you can keep for the last moment when you are done with all other things. You can just have a quick glance at this. This can be important from maybe the theory perspective, but right now you can just skip it and focus on chapter number. Let us move towards chapter number 10. So now, chapter number 10, cost of capital. Cost of capital. Basically, over here, this credit hierarchy, it is giving us the biggest idea that which kind of source of finance is going to be the costliest, because the secured creditors are secured, right? They have this kind of a guarantee. So this is the cheapest source of fund as compared to ordinary shares, because they are facing the highest amount of risk. Okay, so based on the credit hierarchy, it is clear that the ordinary shares is going to be the costliest source of finance for us as compared to the secured creditors. So, risk, required return, and cost of finance. So, secured loans, unsecured debt. Okay, over here we can directly jump to this. You can just have a look at this table where we can see that rank on liquidation equity shareholder is the last, and as the result they are the cost to the company is highest for having the equity shareholders. So now, how do we do the valuation for that? First of all, we have dividend valuation model, which we have just seen in chapter number 18. So if I rearrange this, now this entire segment explains the dividend valuation model. We can directly jump to the valuation using the DVM to do the valuation of equity shareholder. First of all, we can find out the cost of equity using the DVM. So
So
whatever, yes, Neha.
I just wanted to understand the assumptions in DVM. What are the assumptions that we make?
DVM, I think we discussed this in the morning, right? That, okay, let us just have it right now. First of all, so chalo, let me just first of all, cost of equity, if I'm talking about, and over here, cost of equity, we are first of all going to talk about the DVM method, dividend valuation model. So we have just seen in the morning that price of a particular share is equal to, let us say there is a constant dividend divided by the required rate of return, which is the constant rate of return. So we can just rearrange this formula. In the morning we were finding the value of the share of the company, and now we are finding the cost of equity. So if we are provided with the dividend, constant dividend that the company is going to pay, and if we are provided with the price as on today of a particular share, we can find out that what is the cost of equity for a particular company using DVM. Now coming to the assumptions over here, let us have a read. The same expectations, okay, underlying assumptions for DVM, the same expectations, the same expectations for all investors. Therefore, they all require the same rate of return, which is practically not possible in the real world. Okay, in real world, everyone can have different expectations. But right now, we are assuming that based on the dividends and the price, we are assuming that everyone is having the same expectations. Perfect capital market, people are going to act very precisely. If their expectation changes, the prices in the market also changes rapidly, right? Because see, in the broader market, the price is something that is in the control of the investors. Based on their expectations, the price will change. These three things are interconnected. If dividends is connected by the company, that how much dividends are we going to give, this two things, right? This two things, out of these two things, this is something which is not controlled by the investors. This is something which is decided by the investors based on the market conditions. based on the risk in the market. So if their expectation is 10%, they can control the price. They can change the price accordingly by demand and supply. So rational investors are so rational that they are aware, but as we have discussed in the morning, behavioral patterns do exist. As a result, the valuation can be fluctuating very much. No taxes or transaction cost, because as we have seen, taxes are going to be in real life, tax is also going to play a very important role. But right now, while doing all these models, especially the DVM, we are going to ignore taxes. Large number of buyers and sellers of shares, which makes the market liquid. No individual can affect the share price. If today I want to, let us say general market expectation is 10% and my expectation is, let us say, just 9%, I cannot change the market price alone. Perfect information is freely available to all investors. Dividends are paid just once a year and 1 year apart. This is very important, because other than that, if there are interim dividends and if the time period of dividend is different, then the calculation becomes very complex. Right now, we are assuming that dividends are paid on a regular basis at a regular interval of time, and that too once per year. In our syllabus, it is going to be as simple as that for DVM part. Dividends are either constant or growing at a constant rate. Okay, these are the only two situations that we are going to deal with. This was situation number one, where the dividend remains constant. And now the situation number two, if the dividend growth is constant, in that case, the price of a company share is equal to D0 multiplied by 1 plus the growth rate divided by R minus G. So in that case, the cost of the equity will become, if I take this on this side, D0 multiplied by 1 plus the growth rate remains as it is. This comes on the denominator, and this G, which is over here, will become positive over here. So this will be my cost of capital, cost of equity in case of constant growth rate. Clear with this?
Yes, sir.
Perfect. Chalo. So that is our cost of equity in this particular case. Now, here is the most important thing. X dividend market value is the market value of the share, assuming that the current dividend just has been paid. Okay, just has been paid. Come dividend market value is the market value dividend just about to be paid. Only two situations. Either it is just paid or just about to be paid. Only two situations. If given a cum dividend market value, this must be adjusted to an X dividend market value by deducting the current dividend. If the dividend is just about to be paid, let us say 0.2 is just about to be paid, it is cum dividend, and this one is cum dividend price. Okay, then in order to find out the price, okay, see in this formula we always have to use the ex dividend price. Okay, this has always to be the ex dividend price. Then for using this formula, we will have to find out the ex dividend price, which will be cum dividend price minus the dividend of the share, and this will give us the ex dividend price, and then that will give us the cost of equity. Clear till here?
Yes, sir.
Perfect. So all these questions are with dividend with constant growth, dividend without growth, dividend with growth. Chalo, from here we are going to continue. Now we are going to focus and talk about the growth. So while we are talking about this particular formula, okay, now we are going to learn about growth. So there are two ways of calculating the growth. Growth rate can be calculated using two different methods. Method number one is the extrapolation of past dividends, which means you can calculate this based on past dividends. Now, in past dividends, either you can see if there is a trend in the growth rate, maybe a constant growth rate, or maybe it is increasing at a particular number. Okay, so any kind of trend is there. If no trend is there, you can either use CAGR, which is the constant annual growth rate formula. Okay, Chalo, let us break it down. Looks at from past dividend at historical growth to predict the future growth. Okay, for uneven for past 10 years. See, if dividends have grown by 5% annually for past 10 years, the predicted future growth rate is 5%. For uneven but steady growth rate, use the average overall growth rate known as the geometric mean, which is your CAGR. So in this particular case, one is either it can be constant or either you can use, sorry, CAGR, I can say, there are not just two methods, there are multiple methods, multiple situations. So number one, either there can be a constant growth rate. If every year it is increasing by 5%, it will increase by 5% in the future. That is something that we can assume. Okay. Next one is the CAGR, right? But CAGR has to be used when steady growth rate, uneven but steady growth rate, but uneven. Okay, that growth is happening, right? If let us say sometimes from 100, let us say dividend became 101, sometimes it became 105, next year it became 110. Okay, growth is happening but the rate is uneven, then that is for that you can use the CAGR, which is the geometric mean. If there is a discontinuity in the growth rate, rely on the most recent evidence. Discontinuity. Okay, with high growth rate, consider that such growth rate is unlikely to continue. Okay, chalo. So if there is discontinuation in the growth rate, discontinuation, okay, then in that case we are going to rely on the recent data. So there was 100 and from 100 it became 105, and that for some years it remained 105, and then since last 2 years it is increasing by, let us say, on an average around 5 percentage, so something like this, right? In that case we are going to focus on the recent years. Then comes the this part, growth companies. In the companies like growth companies, high growth companies, you have to assume that this growth rate is not going to continue, right? In when the beginning of the years the company might be growing very rapidly, but in that case after a certain number of years the growth cannot continue, so growth can't continue in that case, can't continue. Okay, last one is the uneven dividends. No pattern. Okay, so no pattern in that case. No pattern means 1 year it was 100 and 100, next year it become 105, then it become 103. Over here it decreased. Okay, then let us say 106, then again let us say 104. So if the dividend is any time decreasing, whatever is the dividend, if any time it is decreasing, in that case you are not going to look at this. Okay, this is uneven. This one, which we have talked about, steady but uneven growth, which means it is increasing. Sometimes it's increase. No, I cannot show downward. Sometimes it's increasing. It's always increasing. Sometimes very low. Sometimes more than that. Some like it's always increasing. So that is steady but uneven growth. Over here, the pattern is uneven. So in that case, what do we have to do? In that case, do not use the DVM model. This is very important. There can be an MCQ where it can be showing you that dividend is decreasing in one of the years. In that case, don't calculate using CAGR formula, and in that case, don't use the DVM model itself. So now
So
let us just, yeah, Sneha.
one second, just wanted to go through all the points.
Okay, sure.
Can you scroll the screen?
Yeah, sure. Just read them. Let me know once you're done.
So what are we doing for the third one?
This one,
Yes, discontinuity.
discontinuity. Yeah, you have to rely on the most recent evidence, like whatever are the, whenever you see that there is a growth in the recent area, 105, 105, like you can see that recently it is growing again. There was a discontinuity of growth in between. It was not growing in between. So you have to rely on this, the recent years.
Okay, sir.
Right. Now we will just have a quick look at the CAGR
So
formula.
if we rely on the recent years, then we'll use the same CAGR
Yeah,
for the
see,
last.
If CAGR applies, then you can use that. Like if there is uneven but steady growth rate in the recent year, you use CAGR. If you see a constant growth rate in the recent year, use that.
No, but like if they were not paying dividends for in between for 2 to 3 years and then they
Yes,
start
yes.
paying, then we
So
can
see,
use CAG.
yeah, we can use CAGR. Or what I'm saying is, let us say if they are paying constant, like there is a constant 5% growth in the recent years, you can then use the constant growth rate in the recent years from the recent years. Getting it? Whatever is the method out of the two which is used in the recent years, that you can use. Getting it?
Yes.
Okay. Chalo. So now let us look at this example. uh, Growth using extrapolation. So in this particular case, over last 5 years is this much. Company has paid the following dividends over the last 5 years. Now you see over here it grew by 10 percentage. Over here we cannot see 10 percentage, something different. So we know that the growth is there. In none of the years, the dividend was lower than the previous. So growth is there. There is a pattern. It is increasing. But over here, we have to find out a average over here. So we are going to use the geometric mean, which is our CAGR formula. So we are going to say that growth, in this particular case, how do we calculate? 1 plus G is equal to, you take the last year. Okay, you take the last year, which is your, in this particular case it was 1.45. 1.45 divided by 1. Okay, this raised to 1 by the number of years. Over here it is 1 2 3 4, so divided by 4 minus 1, so it will be 1.5, 1.45 raised to into the bracket 1 by 4, okay, minus 1. So there is a growth rate of 9.734 percentage. 9.734 percentage. That is the growth rate. And then that can be used in the DVM formula to calculate the cost of equity. This one, there is another method as well, but you can ignore that. This geometric method uses geo mean function, but I don't think it's correct. It's not correctly shown. So it's better to use the formula which I have shown, but that is better, and that gives the accurate result. So that is done. Now we are going to talk about the second method of calculating the growth rate. This was the first method, extrapolation based on the past dividends. Now we will talk about the Gordon's growth model. So Gordon's growth model, again coming back to the same example which we had created earlier of this one, as we can see. Now if I erase this data in this particular company, closing
So this
formula,
is return on equity or return on capital employed
where
in the
this one,
Gordon's growth.
Gordon's growth, you have to use the return on capital employed, not return on equity. Return on
So
capital
that
employed
is before tax returns, right?
before tax returns. All right. So ROE, return on investments. But let us see. Let us see one example, because ROE is sometimes confusing. ROI and ROCE. Sometimes, like majority, it should be operating profit only, but sometimes it is used for the operating post tax as well. Like if you try to calculate the net returns. Just a minute. Let me just first create this model again. Chalo. So over here, Gordon's growth model, it is going to be based on Gordon's growth model's formula is this. Growth rate is equal to retention ratio multiplied by the ROE. So over here, the retention ratio in this particular company, in company A, retention ratio in company A, we have seen is 50 percentage, and the ROI
over here we have seen is 10 percentage. So the Gordon's growth model, Gordon's growth formula says that the growth in this company is at this particular rate, at 5 percentage. Now, if we use this particular rate, so I can say the share price after how many years? 1, 2, 3. 3 years. After 3 years, share price after 3 years should have been 100 multiplied by 1 plus the Gordon's growth rate of 5 percentage raised to 3, and it is actually 115.7625. 115.7625. So Gordon's growth rate model says that growth rate is equal to retention ratio and the return on capital employed. Now just focus on this. Rate of return on those retained profits, the return on capitals employed. Over here, it is the formula used over here is this: profit after tax upon shareholders fund. Okay, net assets. This is the formula used over here. But if in case you are provided in a question that ROC, now you see the formula for ROC, the word used over here is return on capital employed. If you will see the formula for ROC in some ratio analysis chapters over there it will be operating profit divided by the return on capital divided by the total capital employed. Okay, so that is slightly confusing. That is slightly ambiguous over here. But in question, I assume that this kind of ambiguity will not be there. You will be clearly given either this rate itself, that the RE is this much, and there is a question over here as well where both the kind of RE can be used. You see, uh, over here, return on capital employed is also used. No, not this one. There is one question where it was written in the notes that we can use either of the, maybe it is in the next chapter. So that is slightly ambiguous, but focus on the data which is given in the question. Getting it, Sneha?
Yes.
All right, chalo. So now let us move forward and now let us talk about Gordon's growth model. Now you can just solve these questions. Cost of equity in project appraisal. So this is okay, project NPV. This is a slightly complicated question. This one is a must. Like you should solve this question before you go for the exam. So after today's session, just do solve this one. Very nice question. And cost of preference shares, again the same DVM formula. Using the DVM formula, cost of preference shares is the same. This entire chapter talks about only the DVM formula only. Cost of debt. So in cost of debt as well, the irredeemable loan notes, the cost of irredeemable loan notes is going to be also calculated using the same formula. But over here, this one will give us the pre-tax cost of debt. Okay, it will give us the interest yield, that what is the coupon that we are paying in this particular bond and what is the price of this particular bond. It is going to give us the gross this thing. So if we want to find the tax shield over here, the cost of debt to the company is going to be KD multiplied by 1 minus the corporate tax rate. So KD is used to denote the pre-tax. Wherever you want to denote the post-tax, you have to write KD multiplied by 1 minus the tax rate. Very bad. KD is equal, post-tax is equals to KD multiplied by 1 minus the tax rate. This is how you have to denote that. So that is done. Redeemable loan notes. Redeemable loan notes, again the same situation, same thing, that the cost of redeemable loan notes you have to find out using the IRR function. So we are talking about this question. Let us say you have to, this is the issue size. Let us do this question to find out the cost of redeemable loan notes. Okay, chalo. So redeemable loan notes, again the same thing, annuity factor. We have to take into consideration the annuity factor, or instead of that we can use the IRR function as well. But here we need to take care that we have to use the post tax interest in order to find out the cost of redeemable. In the case of irredeemable bonds, what we did is, right now we did find the cost of debt, and when we are asked to find out the cost to company, we are going to multiply it by 1 minus the tax rate. That is how we find out the cost to the company. But in case of redeemable loan notes, we have to find out the present value of the interest that we are paying to the customers, but post tax. So in order to find out the cost of redeemable loan notes, let us quickly solve this sum. If you are already familiar with this, just quickly solve this on your own also. I am doing on this side. And if you're not confident about that, then just pay attention on the screen and you can solve it later on. So company has an issue, 200,000, 7% loan notes redeemable at a premium of 5% on 31st December 2026. Interest paid annually on 31st December. It is 1st January 2023 and the loan notes are trading at 98x interest per 100 nominal value. The corporate tax rate is 33%. So what we have to do is we have to write down year and the cash flow. So if someone wants to invest in this particular bond, they would have to pay 98 and they would receive an interest, annual interest of 7%, which is on the par value. Coupon is always on the par value. So they will receive us interest of 7. But we have to calculate the post tax over here. So what we'll do is 7 multiplied by 1 minus the corporate tax rate of how much? 33%. Okay, so that will give us the post-tax cash flow. So this is actually how much we are paying. So this will be second, third, and over here 4.69, 4.69. And this is how many years? 1st January 2023. So 31st, and it is redeemable on 31st December 2026. So 4 years. 31st December, 31st December 23, December 24, December 25, and December 26. So it is a 4-year thing. So this one, and it is redeemable at par 100. Okay. Redeemable at a premium of 105%. Premium of 105%. So a premium of 5. This is what is redeemable. All you need to do is just take care of this post-tax thing. Other than that, just take care if the premium has to be paid. But this in the last, you see all the three things are there. This 4.69 plus the par value plus the redemption value. And over here, now we are going to have IRR. IRR is going to be just the values and press enter. 6% over here. While we are calculating IRR, we definitely have to consider the initial investment. While we are calculating NPV, we have to ignore that in the formula and we have to add that separately. Chalo, IRR is done. This is 6 point. This is how you calculate the cost of redeemable loan notes. Clear with this, Neha? Or are you doing it?
Yes, sir. Clear with it.
Okay. Chalo. Required return to the redeemable debt holder. See, this is something, the thing which we have got over here is the cost to company. Cost to company. It is not the required rate of return of the debt holders. Okay. IRR of the pre-tax cash flows would be the required return of the redeemable debt holders. That will be the gross redemption yield. This is right now the post-tax, which is the cost to company. Gross redemption yield is also known as yield to maturity. So once that is done, semi-annual interest payments, semi-annual can be converted into the annual thing. It is just the reverse of the, you have to first of all calculate the IRR of the 6 months period and you just have to annualize it. It is nothing but the reverse of the effective annual interest rate. So this formula something is you can go on your own. Convertible loan notes. Now comes the difficult part, convertible loan notes. So convertible loan notes, we are going to find the value the similar way. We are going to deal with it the similar way that we have dealt with the valuation. Okay, we have to assume that at the last year, the bondholder would prefer either the higher of the redemption, like either the redemption value or the forecasted conversion value, whichever is higher of the two. Okay, and we have to use again the same table that we have used for redeemable loan notes. Initial investment, okay, post tax cash flow, okay, for all these years. But in the last year, instead of the par value plus premium, we will just use this one will be higher of higher of either the redemption value or the conversion value, which of the two is higher. That is something that we are going to take in order to find out, and then we are just going to find out IRR. That will give us the cost of a convertible loan note. So that entire logic that we have used in the valuation chapter in the morning for convertible loan note, that applies to it as well. Clear with this chapter, cost of capital? Any questions in this?
No, sir.
Chalo, great. Now we are moving to the weighted average cost of capital. Okay. Just give me a minute. Yes, Neha. So I'm back. Are you there?
Yes, sir.
Chalo. So let us move forward. Now we will talk about chapter number 11. So in chapter number 11, we are going to learn about, we have learned about WACC already. So this is basically the formula which will be there in the formula sheet. But you need to make sure that you don't mess up over here. This formula and the asset beta and equity beta formula that we are going to see in the chapter number 12, these two formulas are mostly similar. Okay. The major difference over here is here cost of debt. Okay, we are multiplying 1 minus t over here in the cost of debt, but in the asset beta and asset beta equity beta formula, we are using this taxation part in the denominator. So that is the major difference between the two. But always look at the formula while doing it in the examination. Don't assume that I know the formula and I can do it. So weighted average cost of capital, as we know, is just a weighted average based on the just a minute, I'm getting a message, just a minute. Yeah, so weighted average cost of capital is basically just a weighted average. So I think that is pretty much simple. You just have to create a kind of a table like this, and you can easily find out the weighted average cost of capital. There is no difficulty in that. This question is nice over here. We are supposed to comment, okay, give 4 reasons why it would be preferable to use the market values. So weighted average cost of capital formula focuses on the market weight, okay, market values of cost of equity and cost of debt. But if it is not present, if you are given a data of some family owned company which is not listed, it is not listed, in that case you have to use the book values. But book values are not reliable, so you have to give them the all the reasons that you should be using these are the reasons that you should be using the market value, because book value is subjective. Book value fails to capture the value of significant intangible assets. Market values are current, okay, reflect most up to date values. Weighing using the book value, equity will tend to understate the influence of the cost of equity, because market value of equity is going to be way higher than the book value of the equity. Okay. Over here in this question, there was a significant property which is recorded at historical cost. So it is advisable to restate this to the market value. If you are not, if your company is not listed in the stock exchange, and if your equity and debt is at the book value, at least have the, at least do the revaluation of the assets. Okay, not the current assets, but the fixed assets. If your fixed assets are stated at the current value, okay, they are revalued as per the market condition, then automatically your retained earnings and your profits will increase. Okay, because liability is always at the book value. Book value of liability is fine. It's okay. It's good. But this one, the value of the equity is very understated. Generally, book value is much lower as compared to the market value. So you should be reevaluating, okay, the fixed assets. If you do the revaluation of the fixed assets, the retained earnings will increase, and as a result, the total equity will increase. So that is something that these kind of comments is something that you should
So,
remember. Yes, Neha?
so while using the book value of equity, we'll take both,
Hmm.
right? The shares plus the retained earning.
Yes, yes. Share capital and the retained earnings.
And on the basis of market value, we just take the share earnings, right? The share capital value,
Yes, while we are
market value.
talking about the market value, we have to take the number of shares multiplied by the share value
Price.
of each share, price of each share. Nice. That is a nice observation. So definitely, while you're talking about market value, you will take the market price per share multiplied by the number of
In
shares.
that case, we don't take the retained earning, right?
Retained earnings. No, no, no need. So we're talking about total equity only, like market cap of the equity only. So if you are taking the book value, you should be focusing on just this part, total equity, and which is because of retained earnings. And when you are
So
using the
total
market value,
equity.
when you are talking about the
Total
market value,
equity.
that is also this only, like number of shares multiplied by the market value. That is on also indicating total equity only. So ignore the retained earnings while using the market price, and while you are using the book value, use the total equity. Clear?
Okay, sorry. Multiplied by the cost, right? Into the cost of equity.
Yeah, multiplied by the
221.
interest cost of equity.
Yes, sir.
Okay, give me just a minute. All right, chalo. So now we are moving forward. Implications for project financing. So current WACC is used as the base of discounting rate. Chalo, let us discuss this directly over here. We have started with a new chapter. I can say that this is 8 to 12. We have already reached to 11. Chalo. Now see, once we find out the WACC, WACC is basically for the existing business. All right. So if you are going for a new project, if you are having a new project, in that project's cash flows, you cannot directly discount using the WACC. You cannot use the WACC directly for discounting the new cash flows. This is something which should be used for the existing business. So if a new project is of the same business risk, okay, then you can use WACC. And also the structure, the ratio of debt is to equity should not change. If it is changing, then you cannot use the WACC with the same project. Okay. So if in order to use the current WACC, it is used as the discounting rate only if the project is financed by existing pool of funds. If you are bringing in the new funds, then definitely your WACC is going to change if the cost of those new funds is different. Proportion of the debt as to equity should not change, and the project has the same business risk as the existing opportunities. If any of these things are changing, in that case, you have to recompute the WACC for the new business. Now, there is a concept called marginal cost of capital. What is marginal cost of capital? Additional, let us say right now you have a capital of 100,000 in your business, and right now the cost of capital is, let us say WACC is 12%. This is your WACC. So, if let us say you are introducing some new project in the business, and that project is, let us say, costing just $10,000, and right now from the market, okay, market, you are able to get, let us say, a loan at just 8%. Okay, this is the loan available at just 8%, and the IRR of this particular project is, let us say, IRR of this particular project is, let us say, 10%. Okay, so it might look very obvious that, sir, we can borrow from 8% from the market, and this project is giving us a return of 10%. Then why should we not directly use it? Right? What would be the problem? This is known as marginal cost of capital. This extra 8% for the extra debt that we are taking is 8%. But we cannot use the marginal cost of capital in order to make the decision, because the more the debt you are going to have in your company, okay, the cost of equity is going to increase, because the equity shareholders, okay, generally equity, like generally there is a business risk in a business, but apart from the business risk there is a financial risk in a business. Okay, so equity shareholders need a return for both these types of risk. If the business risk, like for the business risk, they are getting the compensation, but if you increase the debt in your company, the financial risk also increases. And with the increased financial risk, your WACC is going to change. If you have more debt in your company, you have to have, like, your WACC is going to change. Apart from this, apart from this, uh, from a specific source using the marginal cost to evaluate it may not be correct. Okay, is financed by debt, discounting rate of NPV should not be used to do the cost of debt. This overlooks the fact that surplus cash flows go to the equity investors who face the business risk. Over here, you think that whatever, sir, like whatever 2% over here is remaining, right, sir? What is the problem with that? This 2% goes to the equity shareholders. Their expectation is something else. If you are taking up a business, their required rate of return is something else, right? So you should never use just the marginal cost of capital. Okay, in order to do the investment appraisal, you have to calculate the WACC if the ratio is changing. Clear till here?
Yes, sir.
Perfect. Chalo. Business risk and financial risk, as we have discussed, the business risk is faced by the whatever is the activities of the business, that is the business risk. But a risk because of the debt structure is known as the financial risk. What if the company fails to pay the debt? So financial risk is very high. So if I just look at the WACC, okay, if let us say I increase the component of debt, so we can just clearly have an example for this one. So let us say capital, this is let us say 80, and this is, let us say, uh, debt is, let us say, 70. So total capital in the business, just a minute, I'll be back in a minute. All right, yeah, sorry about that. Chalo. So this is the capital, this is my equity, this is my debt, and over here, let us say, cost of equity, let us say, is 15%. This is, let us say, 8%. And uh, weighted average. So I have to do capital multiplied by the cost, this multiplied by this, and I have to bring it down, copy, paste. And now the weighted average cost of capital is this divided by this. All right, 11 point. Now we have to read this. Now focus on this. Cost of capital. See, as company gears up, the shareholders require a return, higher return. So two things happen as gearing increases. When the gearing increases, when the value of debt increases, let us say debt becomes, right now the WACC is 11.73. Whenever the debt increases, let us say it becomes 90. So the WACC has also decreased. Earlier it was 11.73. Now it has become 11.29. Because the debt is cheaper over here, let me just make it 6% to make it more effective. Earlier it was, and let me just make it 20 only. So right now you see it is 13.2. But if let us say if I have a debt of 50, you see it has drastically dropped from 13.2 to 11.5. So as the debt increases in the company, okay, the effect of this, the proportion of the debt relative to the equity in the capital structure increases since cost of debt is less than cost of equity. Okay. As a result, this pushes down the value of the WACC, all else equal. Now, this is the first effect. The second effect is the cost of equity increases due to the increased financial risk, because ultimately the financial risk is faced by the equity shareholders. If you have more debt in the company, they are going to rank lower and lower. And as a result, the cost of equity will increase. Now, you see, from 13.2, because of the increase in debt, it has become 11.54. But because the cost of equity will increase, let us say if it will become 17 percentage, again it is pushing the WACC slightly upwards. Cost of equity increases due to the increased financial risk. All else equal, this pushes up the value of WACC. So net, there has to be some equilibrium at which the WACC will be the lowest. And now the next part of this chapter focuses on that itself. Like high financial gearing is nothing but talking about what are the risks of high financial gearing. Okay, moving on. Next major part of this chapter is this traditional view of capital structure. Traditional view of capital structure says that if you try to find out a balance, okay, if you keep on increasing the debt in your company, if you keep on increasing the level of debt in your company, there will come a certain point, the WACC will keep on dropping and the cost of equity will keep on increasing. All right. We had created the entire. So, what I can do over here is have this like this, bring this over here. This is my cost of equity. This is my cost of debt. This is my WACC. WACC. This is this. What happened? Why is it changing? Okay, because of the sum formula. Equity and this is debt. Chalo. Now let us delete everything else. Array. Ignore taxation right now. Value of debt plus value of equity. Chalo. So this theory says that now let us say in this structure, I can just copy paste this over here. Now just focus on this. If the debt keeps on increasing, if it let us say becomes 60, the weighted average cost of capital is decreasing. If I have in my structure, if the debt keeps on increasing, weighted average cost of capital is decreasing. But there will come a certain point. Okay, let us say if I make it 120, it will stop decreasing. Let us say make it 150, 200. Okay, 250. All right. Okay, chalo, abhi bhi nahi. 400. No, not yet. 500. Not yet. Chalo, not in this particular. Okay, okay, sorry. I had to change the cost of equity as well. Cost of equity will keep on increasing. 20, 25, 30. All right, that will be a complex thing to do. We have this Excel and we had this for chapter. Here it is, traditional view. So here is that theory. Let me just share the screen. Chalo, is this visible file?
Yes.
Great. As the cost of equity keeps on increasing, as the debt keeps on increasing in a company, the cost of equity keeps on increasing. All right, and the cost of debt is going to remain same for a good amount of time. But after this, it is going to become, it is also start going to increase. As a result, what happens with the WACC? First of all, the WACC decreases, but there will come a point after which the WACC will also start increasing. So this is a traditional theory. Traditional theory says that there is a optimum gearing level. This is a optimum gearing level. At this level, the WACC is the lowest. The cost of equity is high. Okay, but the WACC level is the lowest. And at this particular level, at the optimal gearing level, as per the traditional view, the valuation is going to be the highest. All right, that was first theory, traditional theory. And now comes the another theory of Modigliani and Miller. So Modigliani and Miller has two theories, without tax theory and the with tax theory. As per the without tax theory, when the debt keeps on increasing, okay, it is not going to affect the WACC at all. As per their theory, the cost of debt is not going to change. As per their theory, the cost of debt is going to remain stable. Cost of debt is going to remain stable. As a result, the WACC is also going to remain stable. Whatever will be the See, generally it is believed that whenever we will have more debt in the company, the WACC should decrease. The WACC should decrease. But whatever will be the decrease in the WACC, that will be offset by the cost of equity. The cost of equity will increase in such a way that as a result, the WACC will remain constant. That is the Modigliani and Miller theory of without tax. All right. And lastly, we have a Modigliani and Miller theory with tax. As per this theory, with tax theory, they say that the WACC is going to decrease because of the effect of taxation. So we had a separate Excel file for this, Modigliani and Miller with tax. As per this theory, because there is an effect of taxation, okay, now you see the actual cost of debt to the company is very low. As a result, the WACC post tax is decreasing. You see this one, it is decreasing. And no matter what, no matter how much the cost of equity reduces, the more the amount of debt you have in your company, debt equity ratio, the more the amount of debt you have in your company, the lower is going to be the WACC. So, as per this theory, there is a point like the max debt is the point at which the WACC will be the lowest and cost of equity will be the highest at this particular point. And they are assuming that the cost of debt will not increase even if you are having so much debt in your company, but which is practically not possible. So this is the difference between these three theories. And for this, you should be using this Excel file and trying to go through this theory, all this theory. There are chances that there can be an MCQ or something tricky from this particular part because it is slightly tricky. But if you repeat this particular thing 2-3 times, then it will be very clear, especially the graphs that in this traditional view, the cost of debt is going to increase after a certain point, and there has to be a optimal level of gearing at which the WACC is the lowest. Other than that, the two theory, this one says WACC remains constant. And this one with tax theory says that WACC is going to decrease, and the optimal point is the maximum debt. Clear with this?
Yes.
If I ask you, if there is a question in exam that what is the optimum level of debt as per the Modigliani and Millers without tax theory, just look at this graph. What will be your answer?
There is no optimal level.
Perfect. There is no optimal level as per the Modigliani and Millers without tax theory. Okay. So there is no optimal level of gearing. But as per with tax theory, there is a this thing over there. In this one, there is an optimal level of gearing. So that basically wraps up your chapter number 11. Okay, now all these things are just repeated, and that now we have the last chapter of cost of capital. This one is a smaller one. All right, chalo. So let us go. And now we are in the last chapter of cost of capital, which is CAPM pricing model. So CAPM is basically not in the sheet over here. These two sheet, let me just add it over here in this so that those who are revising just from this Excel file, okay, now I can close this, don't save, chalo. Now we are moving forward to the last part, which is your chapter number 12. This I will rename as chapter number 11. So chapter number 10, in chapter number 10 we have seen we have seen the DVM, and in chapter number 11 we have seen weighted average cost of capital. Chapter number 12 talks about CAPM. CAPM model is going to use the risk factor in order to find out the cost of equity. Okay, so basically there are two types of risks. All right, business risk and the financial risk, as we have discussed earlier. Now, this business risk can be further divided into two parts: systematic risk and unsystematic risk. So, systematic risk is something which is faced by the entire economy. Okay, if I talk about COVID is a risk faced by the entire economy. Unsystematic risk is the business specific risk. Business specific risk. Now, this is the area where the students are making the huge mistake when they are asked about unsystematic risk. Business specific risk, so they think that, sir, this risk is faced by everyone. So we have to ignore this. We have to give the extra returns to the investors for this. No, that is not the point. The point is that unsystematic risk is something which can be mitigated by diversification. Diversification. You can do diversification over here for the unsystematic risk. So if you can do the diversification based on the like if you can do the diversification to mitigate the unsystematic risk, this is completely the responsibility. It is the responsibility of the investors to mitigate this. As a result, there is no premium for this particular risk. Okay, investors have to manage this risk on their own. So there are two types of risks for which the investors should get something extra for investing in equity. One is the financial risk and one is the systematic risk. Now, with systematic risk, what happens is that this is the risk faced by the entire economy. Like as I've said, COVID is a risk which is faced by the entire economy. War is a risk faced by the entire economy. But to what extent is a business facing the systematic risk? For example, during COVID, the risk faced by the food industry was very low as compared to the risk faced by the automobile industry. Right? If there are no jobs, if nobody is having job, if nobody is earning good, nobody is going to buy automobile. Okay. So here the risk faced by the automobile sector was very high, but the risk faced by the food sector was very low. So when I the systematic risk, the level of systematic risk faced by different businesses is measured numerically through a symbol called beta. So beta is basically the level of risk faced by a particular industry as compared to the general economy. So over here in the CAPM model, what we are going to do, we are going to give the premium to the investors for the level of risk faced by that particular industry. The level of beta, the risk that the business or their investment is facing. So idea in the CAPM model is basically there is a risk free rate of return. All right. If I invest in a particular company, what is it that I would expect? If I'm investing in a company, let us say I'm investing in Reliance, okay, what is the return that I'm expecting from Reliance? I would want that Reliance should give me, this investment should give me the minimum rate of return that the government is giving or maybe the FDs is giving. This is the risk free rate of return. But beyond that, because I am taking some risk, I should be getting some risk premium. Okay. So generally that risk premium is the return given by the market minus the return given by the risk-free rate of securities. So return given by the market minus risk-free return given by the securities is known as the risk premium. But that risk premium is like there is going to be different level of risk faced by different industries. If my industry in which I am investing, let us say automobile, is facing a risk which is twice the market, okay, and if the food sector is facing the risk which is half the market, then if I am investing in the automobile industry, I should be getting twice the premium. If I am investing in the food industry, I should be getting 0.5 times the premium. So if let us say Reliance is in the industry whose beta is which is twice risky as compared to the general market. So over here I should be getting the twice the risk. So CAPM formula, okay, CAPM formula for cost of equity is equal to risk-free rate of return plus the risk premium, which is nothing but RM minus RF. What is the general return given by the market minus the risk-free rate of return multiplied by the beta. All right, clear till here?
Yes.
All right, we have Lakshita with us. Lakshita, is it clear? Like, from where are you following?
Yeah, yeah. Actually, this is clear to me, but I'm just watching, so it'll, I would be able to revise.
Perfect, perfect. Chalo. So now we are moving forward. Like this is the CAPM formula, which is going to give us the return cost of equity based on the premium. Now we are going to move forward and just have a look. Let us just have a look at the PDF. Systematic and systematic we have seen. So the more you diversify your portfolio, the more you will be able to bring down your unsystematic risk. Systematic risk is no matter what happens, it is going to remain constant. But it is going to be different for different industries. As a result, we have the measure called beta factor. So this can be measured using the securities characteristic line. So let me just open the Excel file from the securities characteristic line over here. So we had this securities characteristic line and securities market line. So securities characteristic line, we have discussed so many things. So this is the securities characteristic line. Basically, this graph is comparing RM minus RF, the premium given in the market, okay, and the premium given by the company. The premium given by the company. If I am comparing Reliance with the general market, if the market is giving me a premium of 6% or not, let us say, okay, here, just look at this. Ignore the negative part, just look at this. If market is giving a premium of 2 and Reliance is giving a premium of 2.4, I can say Reliance is giving me a
So,
premium 1.2 times the general
sir, the
market.
screen is not shared.
Oh, sorry, I need to share this another Excel file. Yeah, so this one is this Excel file which we had prepared for the securities characteristic line. Ignore the negative part right now, just focus on the positive side. All right, so let us say the market, general market, RM minus RF. The market is giving the premium of 2, whereas Reliance is giving a premium of 2.4 as compared to the risk-free securities. And we can say that Reliance is actually giving us 1.2 times the return as compared 1.2 times the premium as compared to the general market. So that is the beta of Reliance, 1.2. So securities market line is basically RM minus RF, which is the market's premium compared to the securities premium. Okay, particular securities premium. The slope over here is 1.2. Okay, if you compare any two values on this line, let us say this one. This is 2.4 upon uh, yeah, 2.4 upon 2. This one also we can compare 1 upon 1.2. So this 1.2 is going to remain constant no matter how two values you divide. Let us say this 4.8 divided by 4. That will also give us 1.2. So this 1.2 is basically the slope of the line. This decides the slope of the line. If this would have been 1.3, it would have been slightly tilted in on any other direction, right? So this decides the slope of the line. Intercept is alpha. Generally, it is always going to cross 0 over here. It should always cross 0 over here. But if it case, like in the long run, the security characteristic line should pass through the point where the two axes meet. Which means if the market is not giving any premium, okay, market is not giving any premium, Reliance Security is also not giving any premium. So generally, ideally, it should pass through 0 only. But in the short run, however, this may not always be the case, and any short-term difference or abnormal return is known as alpha factor. Okay, so if any security is giving you extra return right now, even though market is not giving you any premium, then that security is in the short run is known as alpha factor right now. So that is your securities characteristic line. The next important now, if we try to interpret beta, if beta is equal to 1, which means the share is as risky as the general market. If beta is more than 1, it means the share is aggressive, it is more risky as compared to the general market. If the beta is less than 1, the share is defensive, it is less risky as compared to the general market. Securities, now CAPM model, entire model we have just discussed. But now the important point is securities market line. This is a very important part from this chapter, securities market line. So let me just have it over here. So securities market line gives us an idea. Let me just move the sheet to our file. Let me just delete all the plottings. So. All right. Chalo. So over here, I can see. Array. All right. This would have been a better thing. Let me just delete this. Chalo. See, there is a return provided by the market is 9%. Risk-free rate of return is 4%. Okay, which means that any given point of time, the market should give me at least 4%. Okay, because that is the return provided by the risk-free securities. Risk premium, okay, given by the market is 5%. So if my company's risk is, let us say, if my beta is equal to 1, which means my risk is equal to the market's risk. Beta is equal to 1 means my risk is equal to the market. Okay. If beta is 0, it means that my company is not at all risky as compared to the market. All right. So when the risk is equal to the market, the total return that my security is generating should be equal to the market's return only. So you see 9% over here, When this is 1, exactly 1, at that point of time, the securities line should be exactly over here. This is the line exactly over here. Now, the point of this line, the securities market line, is that for any given level of beta, let us say this is 0.5. Okay, this line over here tells me that at 0.5 beta, I should be getting a return of this much. All right, but let us say if there are two securities, okay, let us say there are two securities. One is security A, which is, let us say, somewhat over here in the graph. Uh, let us say it is over here in the graph, security A, which is giving a return of around 10 percentage, and there is security B, which is also giving a return of around 10 percentage. Both the securities are giving a return of 10 percentage, but their betas are different. One's beta is 0.5, another's beta is 1.5. So purpose of the securities market line is that it tells us that no matter, like, even though two securities are giving you the same return, that doesn't mean that both the securities are same. If one security is beta is 0.5, okay, and the actual return that it should generate is around 6 points, like at 5, at 0.5, I can see in this table it is 6.5 percentage. So it should generate a return of around 6.5 percentage, but it is generating a return of 10 percentage. It is very good. We should invest in this security. We should invest in any security which is above the line, but any securities below the line, this is securities market line, any securities below this line is not acceptable. Why? Because at this level of risk, at 1.5 level of beta, you should be giving a return of around 11.5 percentage, but instead of that you are giving a return of just 10 percentage. Even though both the securities are giving the same return, the acceptability of the securities is different because based on the beta. So that is basically the securities market line. And now one complicated thing written over here in the securities market line is that this particular paragraph, if right now a security is giving you a return of 10 percentage, it is actually underpriced. It is giving you 10 percentage return based on its share price. So if the security is giving such a good return, people are constantly going to buy this particular share. As a result, the price of this particular share will keep on increasing. And if the price will keep on increasing, there will be a point where the return generated, yield generated, just a minute, yield generated by this particular security is going to drop down, and soon it will reach to a level of 6.5 percentage. People will keep on buying this particular share until the return reaches to 6.5 percentage. Same happens with this. If the
So,
security is right now, sorry,
so A is undervalued, right, in this case?
yes, A is undervalued. Anything above the securities market line is undervalued. Anything below the securities market line is overvalued. Clear?
Yes, sir.
Perfect. So over here, since everybody is going to keep on buying, the price will keep on increasing, and as a result, the overall return will decrease for this particular security, and it will reach to a level of 6.5 percentage, and no one will buy beyond this. If this is right now below the securities market line, its price is very low. As a result, it is generating a lower return, right? And people will start selling. Its price is already very high. It is already overvalued. People will keep on selling this particular share, and as a result, its yield will keep on increasing towards 11.5. Once it reaches 11.5, people will stop selling this particular share. So that is the broader idea of securities market line. Chalo. Now let us move forward. Exam formula for CAPM. It is very simple. Like, you don't need to remember this. It looks very complicated. But as we know, the formula is very simple, which is cost of equity is equal to RF plus RM minus RF multiplied by the beta. Now moving on towards more detailed discussion of the beta. Now the beta that we were talking about so far, Okay, this uses of CAPM and all this is fine. Geared and ungeared company. This is the last and the most important discussion in the entire cost of capital segment. Chalo, let me just see if there are any other topics. Project specific discount rates. Okay, that is the part of CAPM itself. Regearing. Okay, that is something that we are going to talk. Asset beta. All right. Summary of steps. We'll see just now. Evaluation of CAPM assumptions and everything you can just read on your own. And this is something that we have just discussed, A and B, securities market line. Yeah, so that is the last discussion for today and last discussion for COC, geared and ungeared beta. So for that, first of all, let us bring the formula for geared beta. So let me just copy this formula. Over here. Geared and ungeared beta. Chalo. So far we have seen that the business risk can be divided into two parts, but the risk can be divided into two parts. One is the business risk, okay, and one is the financial risk. Now, so far, what we were talking about was business risk, like the systematic risk that we have talked about. Unsystematic risk, you are not going to get any premium for that. That is something that the investors are supposed to manage on their own, mitigate on their own. Systematic risk is what you are getting the premium over here. And that systematic risk is calculated using beta. But the beta that we are talking about is an asset beta, is basically the beta or the risk of the business or the industry that you are in. Okay, so if there are two companies, let us say both the companies are into phone industry, both are making phone. So one is this, one is this. So over here, let us say this particular company, company A, is making phones, and over here the risk faced by this particular industry, asset beta, the risk faced by the phone industry is, let us say, 1.2. It is 1.2 times risky as compared to the general market. So this is the exactly the same risk faced by both the companies, both the business risk. And now in this company is 100% equity finance, and this company is, let us say, 80% equity plus 20% debt. So in this particular case, the equity beta is basically the risk faced by the investors is going to be the same, 1.2 only. But in this case, the equity beta is slightly going to be higher than the asset beta because the investors are going to face the financial risk over here. Okay, the ultimate risk that it is faced by the shareholders is the equity beta. So equity beta is technically asset beta plus the financial risk, but we do not calculate, we do not add the risk directly. In order to calculate the equity beta, we have to use the formula for asset beta. The formula for asset beta is basically the risk faced by the entire industry in case there is no debt. Okay, this is the risk faced by the entire business. So what we are going to do in majority of the cases, the asset
Sir?
beta is always 0. Yes, Neha,
Sir?
you saying something?
Yeah, sir. Yeah, when we take CAPM, we just take the systematic risk, right? The compensation for systematic risk.
Yes, so far we were talking about that only, but now once we discuss about this CAPM, we are using equity beta. In CAPM formula, you are finding the cost of equity of a specific company. So in that case, you will be using the equity beta.
So that includes the financial risk also, right?
Yes, definitely. When you try to find out the cost of equity, you are going to find out the risk faced by. See, CAPM also can be for two different things. If you're trying to find out the cost of equity of or of a general investor for the entire business industry only, then that is different. If you're if you're using CAPM to find out the cost of equity of a specific business, then that is also going to be different. Clear?
Okay, sir.
All right. So this is something that we believe that generally, if nothing is mentioned in the question, beta of debt is always zero. So generally, this particular part of the equation is not at all used. This is the main equation. All right. Beta of equity is basically the risk faced by the equity shareholders in if in case there is a debt. So you just have to rearrange this formula in order to find out the risk faced by the equity shareholders. If you have to find out the risk faced by the industry overall, you have to use this formula. Now we are going to go one step forward. Let us say there are five companies A, B, C, D, and E. All right. All these five companies are facing different equity betas, okay, which is your business risk plus the financial risk. All right. We need, let us say there is some new company, company F. All right. So in this company, let us say there is some different debt is to equity structure. All these companies are having different debt is to equity structure. This one is having, let us say, 80% equity, 20% debt. This is having 60% equity and 40% debt. All right, 50-50. All right, 70-30. And this, let us say, is 75-25. All right, so all of them are going to have different equity betas. Let us say this is 1.2, this is, let us say, 1.4, 1.5. Then this might be something between the two. uh, it should be 1. Let us say 25, and it should be slightly higher, 1.28. So these are different equity betas. Okay. Let us say this company is having altogether a different debt is to equity structure. Let us say it is having something around 65-35. Okay. So now, if you want to find out the equity beta of this company, what you need to do is you need two things. You need asset beta and you need the financial risk. Now, financial risk is something which we can get over here by using this formula. In this formula, we can figure out the financial risk. Okay. But asset beta is something that we need from the market data. So what will happen over here, we are going to follow a set of rules, a set of predefined steps, okay, in order to find out the equity beta of that company. First step will be, step number one will be to ungear all the companies, which means we will find out the risk in this company if in case there was no debt. So we technically are going to find out asset beta for each and every individual company, which let us say is something. Okay, just a minute, guys. I need to be back in a minute. I'll be back in a minute. Okay. Chalo. So the first step over here is to ungear it, which means you have to, this is the equity beta. You have to use the asset beta formula. Okay, this formula, apply it over here, and you have to find out the asset beta in this individual companies, which should be more or less the same. Okay, so let us say that it is coming around 1.15, 1.16, 1.16 over here, 1.165. Okay, 1.45 or 1.55. All right, more or less the equity beta, ungeared beta, which is your asset beta of all these companies, should be around the same, because that is the beta for the business only, no financial risk. And you are assuming, you are converting it to a company which is 100% equity finance. You have converted the asset equity betas into asset betas. Then you will find a weighted average, not a weighted average, but a simple average. Okay. You will have another step over here, will be, the next step over here will be to find a simple average over here of all these asset betas. Okay. Let us assume that that simple average is coming out to be 1.5. All right. sorry, 1.15. Oh, I have used it different. 1.145, 1.155. All right, so let us assume that it is 1.15. 1.15 is your simple average. This is your average risk, average asset beta in this particular industry. The third step over here will be to give the effect of the financial risk in this particular company, and then we will find out equity beta for this company which has a debt of 65 and 35 by using the same formula, and this will give us the equity beta of this particular company. This is known as regearing. A regearing. You are adding the effect of gearing again in the asset beta. Clear with these steps? Yes or no?
Yes, sir.
All right. So that is it about this chapter. Like that is the major concern over here, and all these sums are about that only. So you should start solving the questions now. So, Lakshita, we have covered like all the three sections so far. Okay, and you can go through the recordings. The recordings will be uploaded in a while, so that after watching the recordings, you can focus on the section C questions of these segments that we have covered today. Okay.
Uh, are you going to cover risk management tomorrow, like, or
Yeah,
today?
yeah, it will be covered tomorrow.
Okay.
Tomorrow we will be covering risk management and the last part, which is your working capital. These two things tomorrow we will cover. Okay.
Okay.
Other than
Okay.
that, all the areas are covered today.
Okay. Fine.
All right.
Yes.
Sure.
Yeah.
So, Sneha, any doubts in the entire session today in any of these areas?
No, sir.
Great. Chalo. So you can straight away start with the section C questions. And before tomorrow morning, try to just go through them. It's not possible to do all the questions, but just quickly go through the answers and the questions and figure out like what are the questions which you find are maybe something different, or maybe you're not able to recall them. Do only those questions. Other than that, just read all the questions. And Lakshita, same applies to you as well, but maybe just go through the recordings first and then do the questions. Okay.
Yes.
All right, guys. So that is it for today. See you guys tomorrow morning. I'll announce the time in the group and then we can continue tomorrow's session. Okay.
Yes. Thank you.
Okay, sir.
All right.
Thank you.
Thank you, guys. Bye bye. All right. Chalo. So let us begin with our third session of the revision. And today we are going to revise chapter 13 to 16, which is our working capital, and chapter number 17, our risk management. So basically, for working capital, I will directly open uh, the Excel that we had in chapter number 13. So, for understanding the working capital, it is required that we have this small model. So just look at the entire chapter is dependent on this. Let us say these are your payment dates. These are the date of the transaction. So on 1st January 2025, let us say we are selling a particular item. Like our selling on that date is 5,700. And on that date, we are receiving 5,420 from our customer, which is nothing but a like the amount coming from a previous transaction. So
So
over
can't see
here,
the screen.
oh, sorry, let me just reshare it. All right, chalo, I'm repeating it. So this is the model that I have created for chapter number 13, and the entire working capital cycle is like very easy. It becomes very easy with this model. So let us say this is the date of payment. Date of transaction. On 1st January 2025, let us say we are making a sales of 5,700, and on that same date, okay, we are going to receive 5,420, which is going to be a amount to be received from a customer based on the previous sale. So let us say this sales that we are making today on 1st of January, the payment for that we will receive after how many days over here? 40 days, I guess. What is the Okay, yeah, I guess the payment cycle is set to 35 days. Here it is, the credit period is 35 days. All right, so 35 days, after 35 days, we are going to receive the payment on 5th of February. And so that, now this receipt that we have, it is also something from, it is from the sales that we have made before 35 days. All right, so it is something, I don't know, like I cannot figure out because of this complex formula, but we can find out 5402 whatever it is. It was a sales made in the past. So this is my balance of debtors as on today. If you look at the balance of the debtors throughout the year, okay, there is going to be some amount outstanding. Whenever I will open my balance sheet, there is, like, on a daily basis, let us say I open my balance sheet on a daily basis, there is going to be some amount of debtors outstanding. And you see, the amount is fluctuating within a range itself. Over here it is 192 and the closing balance of debtors is 189. Okay, it is because the sales is ranging from this like sales is also between, over here you can see it is between 5,000 to 6,000. So whatever sales you are making today, that sales you will be receiving back on some other day. Over here you can see 5712, which is from 1st of January, right? So on an average, the debtors, there is going to be some outstanding balance of the debtors throughout the entire year. We cannot do anything about that. So that average debtors, right now over here you can see I have just applied the average formula over here. Okay, and this is your annual sales. Throughout the year you are going to make sales of around uh 17 lakh 71,599, and this is your average debtors. So there is a formula through which we can find out what is the credit period that we have given on an average, what is the credit period being taken by the customers, but that will come later on. Right now our focus is that when we have this, when we open the balance sheet on any random day, there is going to be a balance of debtors 1 point around 1.92 lakh rupees is tied up in the debtors. Okay, now because I am not, see, technically you are not going to recover this money in a short period of time in your business, because whenever you will make a new, whenever you will receive a money, right, you, whenever you will, let us say you received 5,000 today, against that you are selling of you are selling 5,000 goods worth of 5,600. Whenever you will receive 5,500, against that you are selling something else. So this is a business cycle, and as a result, this money, this average balance of debtors is always going to be there. This is the money tied in your business. When are you going to receive this money back? You are going to receive this money back when you stop doing the business. So at a later date, let us say when we stop selling, when you, let us see over here, when you see that you have stopped selling, in that case your debtors balance, the balance of your debtors keeps on decreasing, 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 and there will be a time period when you will receive the entire money from the debtors back. But that is something, an extraordinary event when you will stop doing the business. As far as you are doing the business, there is going to be some amount of debtors or inventory always, which is always going to be outstanding. Apart from that, cash is something also that you are going to keep in your business. Like you are going to have some amount of cash in your business always outstanding. So we need to finance this, because if your capital is tied in this, right, either you need a short term capital or a long term capital for these working capital assets. Okay, now there is one more item, which is your trade payables. The way we are having the outstanding debtors, the similar way we are going to have trade payables. Let us say against this 1.92 average balance of debtors, let us say we have on an average 1.5 lakhs of trade payables. So you see, trade payables is kind of a short term capital available to us. All right, so the remaining working capital, whatever is the amount, let us say this is so this is, let us say, around 2 lakhs. This is also around, let us say, 1.5 lakhs on an average. This is also, let us say, we are holding cash of around 1 lakh rupees on an average. So what is the total working capital? What is the working current assets in our business? Current assets is 3.5 and 4.5. So on an average, we are having a asset of 4.5 lakh rupees in our business on a daily basis. Like whenever you will open your balance sheet, you will see that on an average 4.5 lakh worth of current assets is there, against which 1.5 lakh worth of trade payables is that. So now you have to fund the remaining 3 lakh rupees, okay, from somewhere, right? Either it can be short-term capital or long-term capital. How to decide that? That we will be covering in a while. So that is the basically the fundamental of working capital. Now, what is the problem, sir? What's the issue in this? Like we can have 3 lakh rupees from short term or long term. The problem is that the more capital tied in the working capital, like the more you have short term loan or the long term loan, okay, for working capital, the more interest you will need to pay. Okay, let us say over here we decided, sir, it's okay, we can have, like, if the sales is increasing, right? If we give more credit days to the debtors, see it, by the way, it is directly proportionate to the credit period that you are giving. Right now the credit period is 35, you have allowed 35 days. On an average, still your debtors are taking around 39 to 40 days to pay you. This is the on an average outstanding period. But let us say you make your credit policy to be 45. If you make your credit policy to be 45 days, you see the average debtor balance has increased from 1.9 to 2.5. Okay, it has increased because you are giving more credit to your debtors now. But it can have a positive impact on your sales. Now the customers who were going to somewhere else, who were giving lesser credit, now they will come to you because you are giving a very good credit policy. So you have to do the analysis that if I am giving more credit, okay, what will happen? If you will give more credit, the more assets you will have, the debtors will increase over here, it will become 2.5. Now you will need to arrange more funds for it, more finance for it, short term or long term, because your money is tied up over here. This 2.5 is tied in that particular thing. You cannot, it is just like the fixed asset. The way you have the fixed asset in your business, the money is tied up in the fixed assets. Similarly, it will be tied in the current assets. So you will need to fund this through more finance, and as a result you will need to pay more interest. Okay, but the benefit over here will be higher sales. So your profit in that case will increase. So your contribution will increase, your interest will increase, and your contribution will also increase. But you have to compare whether the benefit received is more than whether the extra interest that we are paying. So the entire working capital segment is all about that. That proper utilization, proper figuring out the proper amount of working capital that we should have in the business. Now coming directly to this part of the PDF, let's see. High investment in working capital. If you have lot of investment in the working capital, right, you will have more liquidity in the business and you can have more sales and everything, right? More liquidity, but less profitable because you will have to pay more interest. Okay, right now I have given the example of debtors only, but other than that, there are other having more inventory, having more cash, right? So if you have all these things, it will give you more liquidity, but you will be less profitable because you will have to pay more interest. If you have less liquidity, sir, let us reduce it, let us pay less interest. Okay, we can pay less interest, we will be more profitable, we will be paying less interest over here, but the problem is that in that case we will be less liquid, right? If there is some, let us say we don't have working capital at all. Let us say we decided to have just 25,000 in cash. We decided to have very little inventory. We decided to have very little debtors. But in that case, if we have less liquidity, if there are some unfortunate circumstances, we won't be able to tackle that because liquidity is low. We need to sell our larger assets. We need to sell our investments. We need to sell our fixed assets. So that will create a problem for us. Or maybe we need to ask the bank for a short-term loan, but very quickly, because if you go to the bank as well, that will also take time to process the loan and everything. So in that case, it will be very risky. So we have to balance between the liquidity and the profitability. So the entire chapter is going to talk about that. All right. So for that, we are going to understand different ratios as well. First of all, we have seen the current ratio, current assets upon current liabilities. Very basic. This is something which you have seen many a times. Quick asset ratio is nothing but current assets minus inventory divided by current liabilities. Why we are doing this way, we will discuss in a while because that will be covered separately. So this question Example number 4, this question was about that different companies can have different requirements of working capital. All right, it's not necessary that you always have to follow a ratio of 2:1 for current assets or 1:1 for quick ratio. That is not compulsory. Different industries, different companies can have different requirements of working capital, and they can sustain even lower level of liquidity, but completely depending upon the industry of the business. Now, current investment policy, there are basically three types of policy. Okay, let me just see if it is written in a better way. Strategies for, yeah, here it is. Three policies for funding current assets. Okay, number one is aggressive policy. Aggressive policy is that you would be using short term finance. Okay, wait, this one is short term, long term policy. And this one is over here current assets investment policy. All right. So let us discuss this. If the management is highly risk averse, the first policy is conservative approach to the level of investment in the current assets. Okay, if you are very risk averse, what you will do is this is more appropriate if the cash flows are erratic and unpredictable. In that case, you will have a margin of safety and you will maintain high levels of inventory, generous credit terms to your debtors. As a result, your
So,
debtors will be very high. Yes, Sneha?
what do we mean by cash flows are erratic and unpredictable?
And like if you are in a business where you cannot know that what will be the sales today, right? If your sales are fluctuating a lot, in that case your recovery of the money will also fluctuate a lot, right? If your business is as such where you are not aware that what will be the cash flow, you don't have a predictable cash flow. Okay, in that case you need to have a higher margin of safety. If I know that predictable cash flow is there, tomorrow I'm going to receive 10,000 rupees, and I'm not going to have a reserve today if my cash flows are predictive. Okay, getting it?
Yes, sir.
All right. Chalo. Paying suppliers promptly to maintain good goodwill. See, the way we have it over here for the debtors, the same table, the same model applies to the creditors as well. Just for a while, just imagine that this is your purchases and these are your payments. Okay, this is what you are paying to your this suppliers. If your credit period, okay, right now what is the balance of your trade payables? 2.46. If you pay early, if you pay early to your creditors, in that case your trade payables balance, on an average trade payables balance will decrease to 1.64, which means over here, let us say on this side, on the asset side, on the current asset side, let us say your requirement is 5 lakh rupees on an average, right? If your trade payables are, let us say, on an average 2.5, the remaining amount has to be funded through a short term loan or the long term loan, okay, which will be 2.5. But if you start paying early, okay, paying early to the creditors is not good for you, because if you start paying early, your balance will decrease, okay, and it will become, let us say, 1.6. In that case you will need to fund more. Let us make is 1.5. In that case you will need to fund more, and in that case you will need to pay more interest if you start paying your creditors earlier. But if you are someone who is conservative, in the conservative approach, what you are going to do, in the conservative approach, you are going to have high levels of inventory, generous credit terms, which means high level of debtors, but you will pay your creditors promptly. As a result, the balance of your payables will be lower, okay, in the conservative approach. Now, the next approach is, the problems of such an approach include inventory obsolescence, right? If the inventory is there in your business for a long period of time, it will get obsolete, and a high financing cost for the high levels of asset. High financing cost means we need to pay high interest. Next approach is more tolerance to risk. Then we are going to have aggressive approach. In the aggressive approach, everything is reversed. You are going to have low levels of inventory, low levels of debtors, high levels of payables. You will not pay your creditors early. Okay, what will be the drawback for that? Why it is very risky? It is an aggressive approach. You have high tolerance for risk. What is the risk over here? Running out of inventory. You are having very low level of inventory, okay, in the fluctuating demand situation. losing customers to competitors who offer more generous credit terms, right? You are giving less credit terms to your customers. As a result, they may go towards the other suppliers. Being less able to meet unexpected expenses because you are maintaining very low level of working capital. Other than that, one more drawback is that if you pay your creditors very late, okay, in that case your creditors also might not want to deal with you. They may also shift to some other customers, like they will also start supplying to someone else. They will also stop supplying to you if you pay them very late. So that is your aggressive approach. So you have to have a balance between the two. Okay, a moderate approach falls between the conservative and the aggressive approach. Now this approaches, these three approaches were related to the current asset investment, that how much do we invest in the current asset. Now there is one more theory like this, the conservative, aggressive and the moderate, which is related to funding. Okay, strategies for funding the current assets. How do we fund the current assets? Now that funding strategy can also be either aggressive or conservative, or it can be matching policy. So let us understand what is this. So first of all, the matching policy, now let me just, okay, I'll add this sheet in the revision Excel. Chalo. So the matching policy says that whatever is your current liabilities, see, there is an argument that any permanent portion of current assets, okay, permanent portion of current asset, what does it mean? Out of your debtors, let us say on an average the balance of debtors is 190,000. Okay, let us say you are very sure that it is never going to go below 170. You are 100% sure that it is never going to go below 170. On an average your debtors will always be above 170. Then what you are going to do, you're going to have this in the form of fixed finance, like long term finance. What you are going to do, you are going to take a long term loan for funding this level of debtors, 170. And above that you are going to have short term level of funding, short term loan for that, maybe OD or anything you can take. Whatever is the excess balance beyond 170, that you will fund through your short term loan. This is known as matching policy. There is a component in the current assets which is just like a permanent asset. This is which is a permanent current asset. So funding the permanent current asset should be done through the long term loans. But whatever are the fluctuating current assets, whatever is the fluctuating portion of the current assets, that should be funded through the short term loan. This is known as matching policy. Understood the matching policy?
Yes.
Perfect. Chalo. Matching policy is basically accepting a moderate level of risk. Now, this moderate level is in terms of funding. How do we fund the current assets? Previously, we have studied the level of current assets. Deciding the level of current assets, there were three policies: conservative, aggressive, and moderate. Over here, we have moderate for funding, which is matching policy. Next one is aggressive. In aggressive, what you are going to have lot of short-term finances. What you are going to say that out of this 190, you know that 170 is just like a permanent asset. Still, you are going to have long-term loan for only 100,000, and the remaining 90,000 you are going to fund through short-term loan. Why would we do this? Because short-term loans are cheaper as compared to long-term loans. If you take a long-term loan, it is costlier as compared to the short-term loan. As a result, you would want to fund some portion of even the permanent current asset through short-term loan. What is the drawback of this? The drawback of this is that generally this short-term loan has to be uh, you have to renew these loans very often, like within 1 year, okay, or maybe after 1 year, right? Whether, let us say in the 1st January 2025 you took this loan, and 1st January 2026 you have to refinance this loan. Whereas long term loans are for like more than 3 to 5 years, right? So over here you are never worried that you will run out of money. But if you will take this, you will be charged lesser interest, but you will always have a constant risk of refinancing. That is the biggest risk for the aggressive approach. All right. But over here, you want to take that risk in order to save the interest. Okay. Now, moving on, if we talk about the conservative approach, in the conservative approach, what we are going to do, even though we know that we need only 170, what we are going to do, we are going to fund more than that. We are going to have, let us say, long-term loan of around 180 or 185, and a very small amount of the working capital assets are funded through the short-term loan. Let us say 5,000 only. Okay. So over here, what is going to be the drawback? The drawback is that we have to pay more interest. But what is going to be the benefit over here? We are very secured that we will never run out of money. We are always funded through long-term loans. This is something that we need to refinance after 3 to 5 years. So that is the difference between conservative approach of financing strategy and aggressive approach of financing strategy. Chalo, clear with this?
Yes, sir.
Perfect. Now we are moving forward, and over here, financing interest rates. What are the different sources of finance? You can just go through this: short term overdraft, short term loans, accounts payable. These are the sources of short term finances. And then you can see that what are the sources of long term equity and debt are the sources of long term. Permanent versus fluctuating. This we have discussed that there is some portion of the current assets which is going to be of the permanent nature. Now, working capital ratios, current ratio, very popular. We already know what is current ratio. If the current ratio falls below 1, it is going to create kind of chaos like situation. We will be very worried that what is happening, why our current assets are lower than current liabilities. This may indicate problems in meeting obligations as they fall due. Even if the current ratio is above 1, it does not guarantee liquidity, particularly if inventory is slow moving. Inventory is slow moving. See, in general, it takes a lot of time for the inventory, because let us say this is my working capital. Let us say my inventory days is 10. My debtor days is, let us say, 15. And my, okay, let us focus on these two things. So if I bought something on 1st January 2025, I'm a trader, I've bought something and now I'm going to sell it. So on an average, my inventory days is 10. It means it takes me 10 days to sell a particular item after I purchase it. Okay. So I'll be able to make the first sales on 11th January 2025. Okay. After that, it will take me 15 days to recover that money, which means I will be able to recover that money on 26th January 2025. It will take me 25 days to recover the money. So generally, it is considered that you cannot say that inventory is a liquid asset, because it is going to take time. Whenever you will sell the inventory, it will take you around like so many days. Whenever you bought something, whenever you have the inventory in your godown, then it is going to take 25 days for you to recover the inventory. So there is a new ratio for it, which we call the quick asset ratio, asset test ratio, where you are going to subtract the inventory from the current assets and are going to divide it by the current liabilities. Now, because the inventory is a slow, and especially this has to be done particularly relevant for an industry where the inventory is very slow moving, where the inventory days time period is very high, let us say 45 days, 30 days. In that case, you are going to use the quick asset ratio. A company with slow moving inventory should ideally have a quick ratio of at least 1. Okay. But as we have discussed earlier, it is not compulsory. There can be different industries with having a quick ratio or current ratio less than 1, and still they are doing good. That was the first example that we have seen. So efficiency ratio is the next ratio in order to figure out the working capital. Uh, so this ratio is inventory turnover, where you take the cost of sales divided by the average inventory. Now, average inventory is basically the opening inventory plus the closing inventory divided by 2. You do not have to calculate the average inventory the way I have done it over here, finding out the balance for the entire year and then taking average. No, this is your average inventory. So inventory turnover, it means that on an average how many times the average inventory is rotating in your business. Okay, let us say your cost of sales throughout the entire year is 100 and your average inventory is 10. It means that your average inventory, on an average, whatever is your inventory, it is rotating 10 times throughout the entire year. So that is your average inventory turnover.
Rotating
Similarly,
means it's purchased and sold, right? One
purchased
whole
and sold.
cycle of purchasing and selling.
Purchasing and selling, yes. Once it is, you have to, let us say there is some particular item to which we can give tag. Let us say there is some particular, like let us try to understand receivable turnover. That will be easier to understand. Let us say there is some customer, pick up one customer. Let us say he is buying something on this particular date. He will be making the next particular payment on 2nd of February. On 2nd of February, he will purchase again, and then again he will be repaying on some other day after 35 days, and then again he will be purchasing. So if a single customer is following this cycle, okay, purchase, see, this is not practically going to happen in the real world. Like purchase and sales are continuous process, purchase and payment. Okay, if someone has purchased today, it doesn't mean I won't give him any further goods until he make the payment. But we are just trying to find a cycle over here, that once he has made the purchase, then he will be paying on this date. And what if he purchases again on this date and make a payment on this date? How many cycles are possible? That is turnover. So that is the same case with the inventory as well. Once an inventory is purchased and it is sold, then let us assume that again it is purchased and then again it is sold at a later date. That is the turnover. That how many times on an average the inventory is being turning over and rotating in the entire year. Clear with this?
Yes, sir.
Perfect. Now, similarly, see, thus the way we had inventory turnover, you can have receivables turnover as well. Receivables turnover is credit sales divided by the average receivables. Okay, that formula is not written, but it is just the reverse of the collection period formula, which we are going to see in a while. And this one, accounts payable turnover is going to be credit purchases divided by the average accounts payable. So these are your turnover ratios. Now you can have period ratios, inventory holding period. On an average, for how many days you are holding the inventory in your business. So average inventory, whatever is your average inventory divided by the cost of sales multiplied by 365 is going to give you that on an average, how many days it takes for your inventory to be sold. Once you purchase it, after how many days you can sell that particular inventory. That is your inventory days. Average inventory divided by cost of sales multiplied by 365. Similarly, we can have a receivables collection period, receivable days. Okay, that is going to be your average sales. Let us come back to this particular ratio. What is your annual sales? This is your average debtors. So my receivable days is going to be, whatever is my average debtors multiplied by divided by this multiplied by 365. So this is going to be my uh, average receivable days. Okay, on an average I am receiving my money back from the debtors within 35 days. See, my credit period is 30 days. I am allowing a credit of 30 days only, but because the sales, I think the numbers will be higher on the end side. Okay, the debtors balance is higher on the during the around the end of the period, end of the year. The number of days is coming higher over here, but this is the formula. This is something that you have to use. And over here I have taken the average of the entire debtors, but you don't have to do that. Average debtors is opening debtors plus closing debtors minus divided by 2. That is your average debtors. So average debtors divided by the annual credit sales multiplied by 365. That will tell you how many days it takes for you to recover the money from the debtors. And similarly, payable days, how many days are you paying, after how many days are you paying your creditors. Now, one ratio is sales upon working capital. That whatever is your annual sales, divide that by your average working capital. See, once you have individual averages, okay, you can figure out what is your average working capital by this way. Like whatever is your working capital funding that you have done. Okay, so you have to figure out, like this ratio will tell you that whatever sales you are doing, how many times is it as compared to your working capital. So the higher is this ratio, it is better. Now if I say about payable, see, about receivable days, the higher is the receivable days, it is bad for my business, because then I am creating working capital assets over here, and it cannot be lower beyond a certain limit. But generally we would want it to be lower, we don't want it to be higher, because in that way we are receiving the money later from our debtors. Okay, we are, our money is stuck with the debtors. Similarly, inventory, if we have higher inventory days, it is not suitable for us because our money is stuck in the inventory. But for trade payables, we would want that our trade payable days is higher, because in that way we are getting finance from the trade payables indirectly, but we don't want it to be shorter. We don't want it to be shorter. But definitely any ratio beyond a certain limit, it is not suitable as well.
Sir,
Yes, Neha.
so we want the receivables turnover to be high and collection period to be low.
Exactly. We want the receivable turnover period, which means how many times the debtors are paying throughout the entire year. We want that ratio to be very high, and we want this payable receivable days to be very low. Clear? Chalo. So now let us move forward, and sales capital working sales upon working capital ratio should be increasing. So with this calculating and interpreting ratios, that you can just go through this working capital cycle, cash operating cycle. Now operating cycle is basically the entire cycle of your business, that from how many inventory days, how many days it takes you to like once you purchase a particular item, how many days will it take for you to sell the particular item. Once that particular item is sold, okay, after how many days you are going to make the payment. Let us say 15. So let me just create this example over here. 1st January 2025. So let us say your inventory days is 15. So your inventory days is 15, so you will be able to sell this inventory after 10 days. Okay, but let us say your receivables period, and right now let us assume that you have paid the cash over here only. You have paid over here whatever is the amount, no loss no profit, just right now just take a notional amount. Now you will be able to sell this particular item after 10 days, and after selling it for 10 days you will be able to receive the money from the customer after 15 days of it. You will be receiving the money after 15 days. So over here your operating cycle is of 25 days, right? From 1st January to 26th January, your money is stuck for 25 days. All right. But now if let us say the trade payables was there and there was some payable days, okay, you have got some credit. Let us say you have got a credit for 13 days, which means that you have not made any payment over here. You have just purchased on credit over here, and you are going to make the payment on 13th January 2025. All right. As a result, over here you are going to pay, and now your money is stuck for just these many days from 13th January to 26th January, which is this minus this. So your money is stuck for just 13 days. Now we could have calculated that directly by adding these two, inventory days plus receivable days, and subtracting the payable days. So that will also give us 25 minus 13. How much it is? 13 days, right? No, I think I've made some mistake. 13th January, I have calculated this manually. I should have done this plus 13. It is going to be 14th January. So 14th minus 26 minus 14 is going to be 12. And this 25 minus 13 is going to be 12. Chalo. So that is your operating cycle. This 12 days is basically your operating cycle. This is for how many days your money is stuck with your working capital. Now, factors affecting the cycle length, type of industry, industry norms, right? These are the theoretical points which you can just go through. Power of suppliers, efficiency of working capital management, terms of trade, all these things are going to affect your working capital cycle. Now, if you are a manufacturer, okay, apart from now, this inventory can be broken down. The inventory days can be broken down into raw material days, into working capital days, VIP days, into finished goods days. So when you buy the raw material from that day till the finished goods, like how many days is it going to for you to make a particular item and then sell that particular item? So that is going to be a new different ratio for that. So in the manufacturing, you are going to have receivables, payables, that is going to be normal, but the inventory ratios are going to be divided into WIP, finished goods, and raw materials. So for that, you have to take cost of goods in the denominator for finished goods, just like you were taking in the uh, sorry, for that we were taking credit purchases. For the normal for the normal inventory we were taking the cost of goods sold only. Okay, normal inventory receivable days. Over here for finished goods you are going to take cost of goods sold. Over here annual cost of goods sold, over here also you are going to use that only for WIP ratio in the denominator. Whatever is the WIP inventory divided by the annual cost of goods sold, whatever is the finished goods inventory divided by the annual cost of goods sold. But for raw materials, you are going to take raw material inventory divided by the raw material purchases. Okay, and that has to be credit. If in a question it is mentioned raw material is purchased in cash and credit, you have to take credit over here. Oh, sorry, no, for raw material, don't take credit. Yeah. That was the point. That over here we are taking credit purchases for payables, but for raw materials, if you are doing it for the inventory, don't distinguish between cash and the credit. Whatever is the total amount, take that amount as it is. Don't think that, sir, we generally take credit. Credit purchases is for payables only, payables payment period only. Over here, you have to take both cash and the credit. Chalo. Clear till here? Now, this question is a must solve question. So let us do one thing. I'm giving you 10 minutes. Okay, quickly solve this question. Quickly do this question. So that would be the perfect revision of this particular area. This is the complicated thing. The normal operating cycle is easy, but this one is slightly complicated. So this question is very nice. So quickly solve this. I'm giving you 10 minutes. It's 1:20. I'll be back at 1:30. All right, done.
So working on it, last few steps.
Okay, chalo. Let me know once you're done.
So can you show the answer solution? Not getting the answer, sir.
So what's the issue? Like which ratio you are not
Getting
getting
it
correct?
as
Sorry,
inventory.
all three?
Yeah, because I'm getting the final answer as 118.3. Number of days, my final.
No, but you would have calculated uh, all
Yeah.
the ratios individually, right? So raw material is correct. अच्छा, raw material क्या आ रहा है आपका?
Raw material 42.25.
Okay,
Raw material and work in progress is different. Rest all are same.
okay, all right, chalo. So over here, raw material, just check whether you have taken correct figure in the numerator.
Yes.
Now, cost of sales, just focus on this. In the denominator, you should have 2.7 multiplied by 60 percentage, because see, cost of sales is 2.7. Let me just read this. WIP is 80% complete. Purchase represents 60% of the production cost. So whatever is the cost of sales, see, cost of sales is profit margin is given in the question. Over here, profit margin is here 25 percentage. So your cost of sales is 75 percentage, which is 2.7. Right, out of this 2.7 there are going to be a lot of things. It is going to be raw material, it is going to be labor, it is going to be like other overheads and so many other things. Okay, production overheads and everything. We are concerned with just the raw material. So it is given that purchases represent 60% of the production cost. Okay, so whatever is the production cost, this is the production cost 2.7. Out of that, purchase, which means the raw materials,
Got
is
it.
60%. Right, now this one,
Got it,
WIP,
sir.
that also you got.
Yes, sir.
Perfect. Chalo. So now let us move forward and we are going to talk about how to do the managing of the working capital. So we will talk about inventory in detail. Like, the general idea is that the more inventory you have, it is good liquidity. You can tackle the fluctuating demand and everything. But the more you have the inventory, the more storage cost, the more security cost, all those things, theft, obsolescence, perishing, all those things can happen. So we have a separate chapter. The entire chapter 14 is going to talk about inventory. Then we can talk about, and chapter number 15, receivables and payables. Sorry, chapter number 15 is about cash management, and chapter number 16 is about trade payables and receivables. So the general idea for all the items is, the more you have that item, it is good. For the assets, it is just this. The more you have this is good. But if you have it more, there are going to be some cons for it. And for payables also, the more payables is better. But again, the thing is that it is going to be like, maybe your credit rating will decrease and all those things. So those are the general ideologies. Everything is going to have two sides of the coin. Now, problems for the small business, working capital problems for the small business. Uh, they are going to face the working. See, what happens is, okay, let me just directly cover these two topics in a single explanation. Okay, and let me just see what is left in this chapter. Summary of the entire chapter. Okay, we are already doing a summary, and then there is a working capital question. All right, chalo. So last point of this chapter, which is, I'm going to do this on this Excel sheet only so that I can just transfer it later on. Chalo. So the last point is that when you start a business, okay, when a small business just gets started, okay, at that particular point of time, what is going to happen is that their sales is going to increase rapidly if the product is good, okay, and if their pricing is good, if their location is good and everything is good, then what is going to happen, their sales is going to increase tremendously. Okay, they are going to grow a lot. But again, if the sales is growing a lot, just think over here that now what I will do is, in this particular table itself, in this model itself, let me just make some tweaks. Let me just have a copy of it. So I'll just create a copy, not here. I can create a copy over here so that original file stays. So here is the copy. Now let us say my sales keeps on increasing. Whatever is the previous sales, let me just say that the next sale is, let us say tomorrow I'm going to sell 5% more than that. Copy and paste. You see my sale keeps on increasing, and as a result, my debtors, now just look at my balance of my debtors. Okay, whatever payments, like, I am going to receive that payments after 35 days, 45 days, I will definitely receive that payment. There is no problem in that. But on an average, just look at the balance of the debtors. It keeps on increasing, 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 and on an average, the balance is going to be huge. Now, if the asset side is increasing a lot, it has to be funded by something on the liability side. Okay, every asset has to be funded by something on the liability side. And over here, if you are selling a lot, you cannot get too much credit supply, right? You can give sale, you can do the sales on credit, that is fine. You can give credit to the debtors, that is fine. But against that, you cannot receive the same amount of credit in the market from the suppliers, because you are new in the business. So the trade payables are not going to trust you, and there is going to be a certain level for that. So beyond that, you will need the short term loan or the long term loan, but that also is not going to be available beyond a certain limit. As a result, if you sell more than a particular, like a particular range, then that will also create problem for your business. You will start facing the working capital crunch. Okay, so even though growth in sales is a good thing, but beyond a certain limit, if your growth cannot be funded by some short term capital or any type of capital, then that growth is not sustainable. That is the problem with the small businesses. That is discussed over here in detail. You can just read it to get a better understanding. Now, with this, we are done with chapter number 13. So, what we will do is, now let us take a break. It is chapter number 14. Okay, we can discuss chapter number 14 very quickly, and then we can have a break. Chalo. So, chapter number 14 talks about inventory management. So bottom line is that if you have too much inventory, you are going to have too much fund attached to the inventory, like too much money is going to be stuck with the inventory. And if you don't have enough inventory, you may have stock out cost, right? You may have like these are the reasons for holding the inventory. You may not be able to meet the demand, your production may not be continuous. So in that case, you need to have the inventory. So both the things are there. Now, in order to understand, like the entire chapter is mostly focusing on the EOQ model, which is a optimum level of inventory. So first of all, let me just transfer these two files to our FM full revision Excel sheet. This is uh, receivables model, and other than that, this one is going to be my receivables model 2. Chalo. Now I am going to create a new sheet for inventory. So we need to understand few things about inventory. Chalo. Now, inventory, for understanding the entire chapter, we need to understand two things. That whenever we are going to have an inventory in our warehouse, let us say this is our warehouse. Okay. Whenever you have inventory in your warehouse, there is going to be storage cost. Okay. You have to bear the storage cost. Now, storage cost can be cost of a supervisor, or maybe rent you have to pay, security guard you are having over there. So many different storage cost is going to be there. And whenever you order something, so this is, let us have a broader picture, that whenever you are ordering something, this is my warehouse. Let me bring my warehouse somewhat over here. And now let us say this is supplier is standing over here. Okay. So whenever we will have the goods coming from the supplier to us, let me use a different pen. This, there is going to be a order cost. Order cost. Now order cost can include transportation cost. Okay, it can include your let us say the supplier is charging some kind of cost for placing an order. He's a very big supplier, and he's like, if you want to place an order, you have to pay, let us say, $5 every time you place an order with me. There can be different order cost. In our syllabus, we are not going to calculate this. We are not supposed to calculate this. What will be available to us? We will be provided with the storage cost per unit, okay, per unit per annum. That will be available to us. That if you, and what we have to do, let us say on it, so this is the storage cost per unit per annum. Okay, that is known as, that is indicated by CH. That will be given to us in majority of the questions. Now, storage cost is basically the type of cost, like the storage cost given to us is talking about the per unit per annum, which means in this storage, in this warehouse, if I have, let us say on an average throughout the year, let us say 5,000 units are outstanding. Okay, whenever I place an order, let us say I place an order of 10,000 units, every day 1,000 units is getting consumed. Okay, over here 1,000 unit is consumed. What is the balance? 9,000 is the balance. 1,000 unit is consumed. What is the balance? 8,000 is the balance. All right, if I just create this in Excel, if I can have 10,000, all right, consuming on a daily basis, let us say we are consuming 1,000 on a daily basis, 10,000. Then I can say these are the consumption on a daily basis. What is the balance? This plus this. What is the balance on this date? This previous day plus this. Okay, let me just zoom in a little. So over here, uh, it will go to around 3,000. Let us stretch it further and array. Chalo. Over here it is becoming 0. So what is the average? Average is coming 4500. So let me just order over here. When this is this, I'll just order again, copy and paste. So again my balance is 9000. So you see what is the average over here? 5000 is the average. Balance keeps on decreasing. I ordered 10,000 units. I started consuming 1000 units on an average daily basis. This is the outstanding balance. Okay, inventory is depleting every day. Day 1, day 2, day 3, day 4. At last, when I was having 1000 units, I again ordered 10,000 units, out of which 1000 will be consumed, and this cycle will go on. I can just copy this and paste it. If you want to do this cycle for 100 number of times, you can do it 100 number of times, but the average over here, average inventory is going to be 5000. All right, some days it was 9000, some days it was 1000, some days 7000, some days 3000, but on an average, what is the outstanding amount in my warehouse, outstanding inventory in my warehouse? On an average, it is going to be 5000. Right, so this storage cost which is given to us, right, which is per unit per annum, which means I can say, let us say the storage cost per unit per annum is 10. Okay, ch is 10. So I can say that 5000 units are outstanding on an average. 5000 units are outstanding throughout the year, because my order quantity is 10,000. So your average inventory is basically your order quantity, whatever is your order quantity, divided by 2. This is the formula for average inventory. Now average inventory, we are saying this is the inventory which is outstanding on an average throughout the entire year. How many number of times you repeat the cycle, the average is going to be 5000. So as a result, this is the units outstanding throughout the entire year, and my annual storage cost is over here 5000 multiplied by 10, 50,000. Okay, sir, how do we got this if we were not having 50,000, if we are not aware about 50,000? That is not our concern as of now. Technically, in real life, you will have the annual storage cost for the entire year, and then you will divide it by the average inventory, and that will give you the storage cost per unit. But right now, storage cost per unit is already given to us in the question. Okay, and now we will be using it to find out the annual storage cost, and then we'll be using it to figure out best order quantity. So that is one part, that is one important aspect for inventory, which is the storage cost. Now focusing on the order cost. Order cost is very easy. Let us say we need 100,000 units for the entire year. Okay, 100,000 units entire year, and every time we are going to place an order of 10,000, which means what will be the number of orders that I will be placing throughout the entire year? I will be placing 10 orders throughout the entire year. If each order is costing me 100 units, now this is also going to remain fixed. It is also not going to fluctuate in our syllabus. Okay, so in our syllabus, it is going to be very simple thing, that we will be provided with an order cost, and it will be mentioned like CO, cost per order, cost per order. Now, cost per order, you just have to do, what do you have to do? You just have to multiply cost per order by the number of orders that you are going to have throughout the entire year. And that will give you the annual order cost. Annual order cost. Now, these two are the most important aspects in this chapter, and this is something that we are going to focus on for the rest of the chapter. Now, that will be annual order cost will be 100,000. Okay, no, not 100,000, just 1,000. All right. So now we are going to understand the concept of annual equivalent order quantity. Clear till here? Any doubt so far? All right. Chalo. So let me just have one sheet over here, which is this one. So now I'm going to have this sheet. So over here in this sheet, we can see that, let us say there is an annual demand. This is a question from the PDF. There is a annual demand of, let us say 40,000. Cost of placing per order is 2 per order. and cost of holding per unit per annum is 1. So in that case, let us say that our reorder quantity, every time we are going to place a order, we are going to place an order for 100 units. In that case, what will be the number of orders throughout the entire year? It will be this, the 40,000, which is the annual demand, divided by 100. So we'll be placing 400 orders throughout the entire year, and our annual order cost will be 400 orders multiplied by the cost of ordering. Similarly, annual holding cost will be, now, over here, our reorder quantity is 100, which means we are ordering 100 units every time, which means our average inventory, the average inventory which is going to be outstanding throughout the entire year, is going to be only 50. In that case, our annual holding cost is just 50, which is cost of holding a single unit per annum multiplied by 50. That is our annual holding cost. Now, this too, total cost over here. Now, total cost, by total cost, we are not including the purchase price. EOQ is going to focus on the cost of holding, annual cost of holding plus annual cost of ordering. So over here, the total cost of these two items is 850. Now, if I increase the reorder quantity, you see the cost is decreasing, decreasing, decreasing. But beyond a certain point, right, beyond a certain point, again the cost will start increasing. This is demonstrated through this gray line. Okay, through this gray line over here, we can see that line on the PDF. If I just scroll it downwards, and over here you can see this line, this is the cost, total cost line. Over here there is some level in the middle where the total cost is going to be the lowest. Total cost, by total cost we are talking about right now these two costs, annual cost of holding and annual cost of ordering. So at this level, you see at 400, the total cost is the lowest. So our objective is to find out this level where both of them are equal. You see, both of them are meeting each other. This is holding cost. Holding cost, you see, is a very straight line. It is increasing on a linear way. And this, you see, it is decreasing. Order cost, in the beginning it was 800, but as you keep on increasing the number of units in a reorder quantity, the number of orders is going to decrease because it is inversely proportionate to the reorder quantity. And as a result, your annual cost of ordering keeps on decreasing, 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 and there is going to be a point when both of them are going to be equal. And when both of them are equal, the total cost is the lowest. Okay, now, how do we find out that point directly by without having this graph? For that, this point is known as, by the way, this number of quantity, this reorder quantity is known as EOQ, economic order quantity. Economic order quantity. We can say economic reorder quantity as well, but the actual word which is widely used is economic order quantity. Now, how do we find out economic order quantity? We have to use this formula for that, which is 2 multiplied by, which is 2 multiplied by cost of ordering multiplied by the demand divided by the cost of holding, divided by the cost of holding. 2 multiplied by cost of order multiplied by demand by the cost of holding. So over here it will
So,
give us, now let, yes Neha.
so at times there's a finance cost that is mentioned separately. So we put that in cost of holding when we calculate the EOQ.
If it is mentioned separately, and if it is mentioned that it is additional to the cost of holding, then do add it. Okay, but generally think about it, storage cost includes the finance cost. Okay, because if you are storing the inventories, like you are completely focusing on the inventory, if you store high amount of inventory, there is going to be high amount of finance attached to it. Okay, so finance cost is generally considered to be a part of the storage cost.
But if it says that excluding the finance cost, we do
Yeah,
add
in
it, right?
that
Okay.
yeah, in that case we will have to add it, and in that case we have to calculate it separately.
So
Okay,
that's calculated on the purchase price, right? If it's 10%, so it's calculated on the purchase price per unit
can
and
you
then
show
added
me a
to the.
question if you have?
I don't have a question right now, but it mentioned like the cost of holding is this, excluding the finance cost, and then the finance
Hmm.
cost was 10%.
Okay, so it can be the 10% of the cost of holding of the average inventory. Okay, whatever is the average inventory, number of units multiplied by the purchase price of that particular inventory. Okay, and then multiply it with the percentage. Don't directly do it with the demand and the percentage, because the finance cost will be tied to the outstanding inventory. Whatever is there in your asset side, whatever inventory amount you are having, on that you will be paying the finance cost. Getting it? But see, like while after this session, when you are practicing, if you come across that question, do send me that, and then we can discuss that question in detail. Okay.
Can you repeat what you said? Purchase price into?
So that would be average inventory multiplied by the purchase price. Okay. And we can add the storage cost as well. So average inventory, because storage cost has to be, okay, chalo, I'm not making it more complicated. Right now, let us have this simple assumption. This multiplied by whatever is the rate of interest. Okay. Let us say if it is 10% multiplied by 10%. And that will be for the entire year. So you do not need to do not need to divide it by the number of days or something like that, because it is going to be outstanding throughout the entire year. Average inventory is going to be outstanding throughout the entire year. Understood?
Yes.
Perfect. Chalo. So this one is done. Now, EOQ is basically this, right? As simple as that. 2 multiplied by cost of order divided by multiplied by demand divided by cost of holding. The entire thing you have to find out the square root. So, as simple as that. Now you can solve these questions. Now, this complication, there is a complication. What is the complication? So the thing is that over here we are saying that we can change the demand. Okay, we can change the reorder quantity. But if I talk about the warehouse that we are having, let us say this is the warehouse that we have, and that warehouse uh, is having, let us say, a capacity. We have rented a warehouse who has a capacity of, let us say, average inventory of 50 units. Okay, or I can say, let us say, what was the highest order quantity over here? Highest reorder quantity was 1000. Chalo. So let us say average inventory of 500. Okay, so this warehouse has a capacity of 500 units. It can store 500 units, not 500 units, 1000 units at max. Okay, chalo. No, I don't need to take that. All right. We have done our calculation and we have figured out that the EOQ, best EOQ is 400 units. Okay, now let us say we are purchasing a warehouse. Okay, but over here, average inventory throughout the entire year is going to be, average inventory is going to be 200. Right, average inventory is going to be 200. 400 divided by 2 is going to be our average inventory. Now, I cannot purchase a warehouse which can store only 200 units. Right? I have to purchase a warehouse which can store 400 units throughout the entire year. Because my inventory level is going to start from 400, it is going to deplete, right? Over the period of time, on a daily basis, it will be depleting. So it will be depleting on a daily basis, and when it will be close to zero or whatever is my reorder level, after that level I will just I would have already ordered and I will then receive my goods were of 400 units. So my average inventory is 200 units, no doubt about that, but my storage capacity should be 400, it cannot be 200. Right, so the rent that I am paying through the entire year, that rent is for 400 units, it is not for 200 units. So whenever you will have a question where the rent is mentioned separately, just look at this question. The holding cost is 3.3 per unit, okay, and plus the rental of the warehouse. Okay, so in this case, what are we supposed to do while calculating the uh, cost of holding per unit? What we are going to do, whatever is the cost of holding for 200 units, okay, like cost of holding per unit for 200, like it is based, generally the cost of holding is based on an average inventory of 200 units, okay, an average inventory of 200 units for the entire year. But what we are going to do, the rental we want it to be based on the average inventory of 400 units. We have to be, that has to be based on the average inventory of 400 units. So what we are going to do over here, just look at this, 3.33 per unit plus the rental of the warehouse. Okay, that is my cost of holding. So each unit occupies 3 square meter. Each unit occupies 3 square meter. Annual rental of the warehouse cost is 5 per square meter. 5 per square meter. So we have to assume that over here we are going to have 400 units outstanding throughout the entire year. Each unit is going to consume 3 square meter per unit multiplied by 5. Okay. So over here my cost of holding 400 multiplied by 3 multiplied by 5 is equals to 6000, and that, sorry, yes Neha.
Here 400 is the total annual demand, right? Or just the EOQ?
No, no. Annual. Oh, sorry. That is a different question. Okay, it has nothing to do with this. That 400 has nothing to do with this. This is the not the annual demand, but this is the reorder quantity. This is how much quantity I'm going to order every time. This is not the annual demand. This is the maximum capacity of the warehouse that we should have.
So what do we use in this case? The total or
Total for what? Okay, in this case, what are we supposed to do? Whatever is this rental of warehouse per unit, okay, see, this one is given 3 multiplied by 5, $15 per square, $15 per unit is the rent of a warehouse. Okay, we are just going to multiply it by 2. Over here, see this 3.33 per unit, it is given to us. Okay, that is based on a average inventory. Whatever is the average inventory right now in this example, it is 200. So annual holding cost, okay, is calculated. Annual holding cost, whatever is the annual holding cost, is generally based on the inventory level of 200, but the annual rent is going to be based on the inventory of 400. So whatever annual holding holding cost is provided to us, okay, that we know that it is for 200 units, but this one right now, 3 multiplied by 5, it is calculated for 200. This average is coming for 200 units. Okay, whatever is holding cost, this holding cost is given to us. This is the average, 3.33 plus 15. Right now 3.33 is given in the question. That apart from rent, 3.33 is the holding cost per unit. And we are provided with this 3 and 15. Okay, this is the holding cost of us rent for a single unit. So total holding cost is 3.33 plus 15. Okay, my total holding cost for this for a single inventory for the per annum is going to be 18.33. Okay, clear with this? You got yes or no?
yes, sir.
Okay. Now, if I multiply this by the whatever is the average inventory. In this case, average inventory is 15. Okay. In that case, I would get the annual holding cost based on the average inventory. But in actually, this is not the case. This is incorrect because the rent that we are talking about over here is based on 400 units. Okay, so what we have to do right now from the exams perspective, what you need to do is you have to take this 3.33 as it is, that will be as it is in your cost of holding per unit, but this rental part which is $15, that has to be multiplied by 2. Okay, just think, like, for a short quick explanation, that average inventory is basically whatever is the reorder quantity divided by 2. Average inventory is reorder quantity divided by 2, while now we are trying to find out the rent for the entire like not just the average inventory but the reorder quantity, we have to multiply it by 2. So you just have to remember this, that whenever rent is provided in the holding cost, you have to multiply the rent part by 2 in order to get the cost of holding per unit. Your cost of holding per unit should be this, 15 multiplied by 2 plus 3.33. Clear with this?
Yes, sir.
Perfect. So cost of order, cost of holding, and then you can easily find out the EOQ in the regular manner. Now, cost of capital, inventory like any other assets must be matched by a liability. Therefore, there must be a cost of financing inventory, which is a holding cost. Generally, it is the part of your holding cost, but if it is mentioned separately, this is in addition. Right now, it is just an example, but generally, it is the part of your holding cost. Now comes the quantity discount questions. See, EOQ is the level. Now, this is slightly complicated. Chalo, let us understand. EOQ is the level at which the annual holding cost plus the annual ordering cost. These two are the lowest. But it is not necessary that this is the quantity at which the purchase price can be the lowest. If we buy in bulk, if we have a bulk quantity which may be higher than EOQ, then our purchase price can be lower. Okay, as a result, the total cost can become lower. So we have to find out whenever you are provided with the option of bulk discount. Just look at this. Your annual demand is 5,000 and your discount of 3% is available on orders above 300 units or more. So in this question, what are you supposed to do? First of all, find out the EOQ. Determine whether the discount is worthwhile. At EOQ, what is the EOQ in this question? 200 units is the EOQ. Okay. See, if in a question your EOQ is greater than the quantity mentioned for the bulk discount, right? If let us say EOQ over here would have been 400, then there is no question. Okay, bulk discount, for bulk discount you need what's happening? For bulk discount, you need minimum 300 units. Okay, in that case, it's a no-brainer that you should go for EOQ, because in that case, you will definitely get the bulk discount. But if your EOQ, and that will be the majority of the cases in your exam question, your EOQ will be lower than the bulk discount quantity, which is over here it is 300. So in that case, what you need to do, you need to figure out the total cost at 200, where you are not going to get the discount. Okay, where your purchase cost will be 1.1, which by the way has to be applied for the annual demand. This is the quantity that you are going to purchase throughout the entire year, and this is the cost and holding cost and reorder cost. Like, this will be the total annual cost. You have to compare the annual cost for the both. So over here 300 units, at 300 units you are also going to calculate the annual cost of holding, annual cost of ordering, but this is where you are going to get the discount because your order quantity is 300 units. Sir, why cannot we have more than 300 units? Because the discount is available for more than 300 units. Because if you go more than 300 units, you know that your annual holding cost and reorder cost, the total of this two is going to increase. If you focus back on this table, any inventory level apart from this, above EOQ or below EOQ, is going to result at a higher total cost of both. So you don't want to move too much away from the EOQ. You are just trying to find out how much discount are we getting at bulk discount, what will be the total cost. So in this case, if you take the bulk discount, the total cost will be 6960. Over here, the total cost will be 7,000. Okay, over here, just look at the total of this two. 1125 plus 500, it is 1625. Over here, the total is 1500. Annual holding cost plus annual ordering cost is just 1500. Over here, it is higher, but this is set off by the bulk discount. As a result, you can go for the bulk discount in this particular case. Understood the concept of bulk discounting?
Yes, sir.
Perfect. Chalo. So now comes the last part over here. But let us break this session and let us continue after the lunch. All right, chalo. So let us continue with our revision of chapter number 14. Just give me a minute. Am I audible properly?
Yes, sir.
Okay. Chalo. So let me just open the Excel file and then we shall continue. All right. So now we have to discuss about the reorder level, which is also known as ROL. ROL. So far we have seen that there is a economic order quantity, which is the reorder quantity. There are two things. One is reorder quantity, one is reorder level. So let us say your annual demand throughout the entire year is 10,000 units. Okay. Out of which we have decided that every time we are going to place an order, let us say EOQ is uh, out of this 100 units. Chalo. So we are going to place number of orders throughout the entire year is going to be 100. But now we have to decide that what will be our reorder level, which means that in our warehouse, what is the level at which we are going to place a new order. When do we have to place a new order so that the goods arrive in our warehouse at our warehouse in such a way that we do not have to stop our trading or our production, right? If so, for that the best method is known as, like, we calculate the reorder level through this method, through this formula, which is lead time multiplied by lead consumption. Okay. Lead consumption is basically the lead time consumption, okay, multiplied by the lead time. So lead time consumption is the number of units that we are going to consume per day, or whatever is the lead consumption thing. See over here, demand per day, lead time multiplied by demand per day. So over here, if we are going to receive, let us say it is going to take around 10 days for the goods to reach to our store, and every day let us say we are consuming 10 units, or let us say 20 units. If we are consuming 20 units every day, and it will take around 10 days for the goods to reach to our warehouse, which means by the time the goods will reach to our warehouse, we will be consuming 200 units. We will be consuming 200 units. So whenever our inventory level reaches to 200, okay, at that time we will place a new order. This is known as reorder level. Many a time students do confuse between reorder level and reorder quantity. ROQ is the number of units that we are going to order, and ROL is the level at which we are going to place the order. That is the distinction between the two. Now, over here, whenever there is, now we have to learn this situation which we have talked about is a situation this reorder level formula we can use only when there is a constant demand. Okay, we are highly certain that it will take only 10 days and we will be able to only consume 20 units in a single day. We are so short about this. As a result, we are it becomes very easy for us to compute the ROL. But if in case the demand is uncertain, we don't know what will be the demand in the upcoming days. If the demand is fluctuating, in that case we have to follow a complicated process. Okay, so this process, entire process, is very tricky and very important. Maybe there can be a question related to this in the section C as well. Okay, so the process is that, just look at this question, that holding cost per unit is given 8 per unit, and stock out cost. Now stock out cost is a new thing for us. Stock out cost is basically what is the cost that we have to bear if in case we run out of goods. So over here what we have to do is we need to take this into consideration. With this we need to take this into consideration: stock out cost and holding cost. So lead time is basically the time it will take for the goods to reach to our store. Over here in this particular question, it is given that the lead time is 1 week. EOQ is basically 150 units. 150 units. So I have a very nice question. Apart from this, there was another question which a student has shared with me recently. Let me see if I have that question, because this is something which we have already done in the class. So I would want if we can do level of gearing receivable days revision session. No, I'm not able to find it. Chalo, let it be. It was there in the MCQs, one of the MCQs which is there on the portal. So in that one question, one student has solved it, and like we had prepared their Excel file. So what we have to do, see, in this question EOQ is already given, which is the order quantity that we will, whenever we will place order, we will order 150 units. So over here average inventory is going to be 75. It is not needed in the question, but I am just calculating it so that we remember that average inventory is half the order quantity. So now demand is available to us. These are the different demands. Either the demand can be 40, either it can be 50, 60, right? And these are the probabilities of the demand. That demand can be sometimes 10, 20, 40, 40 percentage, 20 percentage, 10 percentage. So assume 50 working weeks in a year. So calculate the optimum reorder level. So first step that we need to do is we have to calculate the average weekly demand. We have to calculate the lead time demand. The first step is expected demand in the lead time. Okay. What will be the consumption that will be happening in the lead time? In the lead time. In this question, the lead time is a week. So first of all, we have to calculate. Now this is the weekly demand. It is given in the question that these are the weekly demand. So we can just calculate the expected value over here, and that will give us the expected weekly demand. So we know that on an average throughout the entire year the demand will be around 60 units per week. This is the average demand throughout the entire year. Okay, what is the expected value? Expected value is nothing but telling us the average if something happens repetitively. So if we talk about the entire year, if we talk about 50 weeks then in the entire year, out of 50, on an average, like what will be the average? 60 units will be the demand every week. So if I will order, let us say, if I will well, I have to create the table first of all. So since the annual demand over here is 3000 units, okay, we are going to have 50 weeks, and the average demand is 60 per week. We are expecting that there will be an annual demand of 3000 units. And since the EOQ is 150, EOQ is 150, every time we are going to order 150, there will be 20 orders in the entire year. 20 orders in the entire year. Now, what we have to do is we have to prepare a table like this. We have to pick up all the possible ROL above the expected demand that we have figured out. Expected demand right now that we have got was 60. So we have to take all the demands above 60. Okay, it was these are the possible demands 60, 70, and 80. All right, so now definitely we are not going to have a reorder level less than this, because we know that the weekly consumption, weekly demand is 60 on an average. So we should have at least 60 units. We are not going to have our reorder level below 60. So we can have a reorder level of either 60, 70, or 80. Now we are going to see what would happen in all these three scenarios. If we have a reorder level of 60, okay, and let us say the demand is 60, exactly 60, in that case we have no problem. There will be no stock out and there will be no buffer. We are concerned with two things right now. We are concerned with the buffer stock, extra stock that we will be having in the inventory, and we are concerned with the stock out. These two are the major concerns while we are trying to figure out the ROL in an uncertain demand. Okay, in certain demand, we don't have to do this kind of a question, kind of a calculation. So when the demand is uncertain, we are concerned with buffer cost and we are concerned with stock out cost. So first one, talking about the buffer cost. If we have a reorder level of exactly 60, okay, and if the demand is 50 or 40, in that case there can be a extra buffer. All right, but if the demand is, let us say, 70 or 80, if the actual demand is 70 or 80, in that case there is going to be a shortfall. There is going to be a shortfall. And what is the probability of this demand? The probability of this demand is 0. 0.2 and 0.1. Okay, as a result, the average shortfall throughout the entire year, is going to be 2. And as a result, the stock out cost, annual stock out cost, will be 2 multiplied by 3. Okay, just a minute. Why do you multiply average unit cost multiply stock out cost per unit with number of orders per year? All right. So this is the probability. Like out of the entire year, it is not going to happen. It is not going to happen throughout the entire year. If you multiply this short units, okay, multiplied by the number of total orders, like let us say throughout the entire year, this can be the shortfall. If let us say in the entire year the demand is 70, this can be the shortfall throughout the entire year. But probability of that happening is 0.2. So actually, on an average, the stock out cost, like because of the demand being 70, could have been this. All right. So this is the stock out cost, which is around like okay, we got two shortfall cost. Yeah. Any
So
doubts?
can you explain this part again?
Okay. Let me do this
Annual
in the
stock.
Excel itself. Let me do that in the Excel. Chalo. So let us say the ROL is right now we have decided an ROL of 60. So there are two possible demands. Either the demand can be, let us say we are concerned with the higher demand. Okay, we are concerned with 70 and 80. So over here, what will happen? Chalo. Shortfall in the entire year will be, chalo, this is, let us say, this will be the shortfall. Okay, 10 will be the shortfall in a single week. Okay, and how many weeks will be there in the entire year? There will be 50 weeks in the entire year. But what is the probability? Like out of the 50 times, how many times is it going to happen? It is going to happen hardly like 50 multiplied by 0.2, 10 times. Okay, hardly 10 times. And then every time, if there is a shortfall of 10 units, then there can be 100 units of shortfall in the entire year because if the demand is 70. Getting it? This is going to remain constant throughout the entire year. 60. We are going to have a ROL of 60. Every time, every week, if the like whenever the level of stock reaches to 60, we will place a new order. Okay. So when we place the order, right, in the upcoming week, if the demand is 70, there will be a shortfall of 10 units. And in the entire year, now let us say if it is done, if it is happening in the entire year, every week there is a shortfall of 10 units, then in the entire year there will be a shortfall of, oh, it's not 50, it's 20. It's 20. 20 weeks in the entire, 20 times we are going to place the order in the entire year. Okay, we are going to place the order 20 times. So what will happen? There will be a shortfall of 200 units in the entire, like we will face the loss of sales 200 units in the entire year. But probability of this demand is 0.2. So it will be, there will be shortfall of 40 units in the entire year. Getting it?
Yes, sir.
All right. And now the cost of a single shortfall is, single unit of a shortfall is $3. So that will be the total shortfall. Total shortfall will be this multiplied by this 120. Okay. Over here, similarly, if the shortfall happens over here, all right, 60 minus 80. Now that is going to be 20 units in a single cycle. And there will be how many cycles throughout the entire year? There are going to be 20 cycles. But probability of this happening out of 20 cycles, how many times is it going to happen? This is going to happen, I think 0.1, 0.1%, 0.1 times. So the probability of that happening, like the probable shortfall in the entire year because of demand of 80 is 40. So in that case, the cost of shortfall is this. Now, since we are just comparing the cost only, I'm not putting the negative sign. We can have a positive sign. I can multiply this by -1 and this also. Chalo. So this is the total shortfall cost if the ROL is 60. Okay. Now we are going to see what will be the shortfall cost if the ROL is 70. If the ROL is 70, if the demand is 70 or less than that, then there will be no shortfall cost. Okay, in that case, the shortfall can happen only if the demand is 80. In that case, the shortfall will be 70 minus 80, this one. All right, this I would do it otherwise, 80 minus 70, then it won't give me negative, and the shortfall cost is 3, and as a result, I need to multiply it by the probability, right? This one, what is the probability of like by how many times this can happen in a year? It can happen, like there are going to be 20 rounds, 20 cycles in the entire year, and the probability of this happening is 0.1. In a single cycle, it will happen. In a single cycle, we are going to have a shortfall of 10, and there are going to be, out of 20 cycles, there can be 2 cycles in the entire year in which we are having a shortfall. So there can be 20 shortfall in the entire year because the demand is 80. So the shortfall cost in that case would be this multiplied by this. So here the shortfall cost is lower. And now if we have a ROL of 80, okay, and then there will be no shortfall cost. If the demand is 80, we are not concerned about it, right? The shortfall cost will be 0. And sir, this is the best one. We should have a reorder level of 80. No, the problem over here is that if we have a reorder level of 80, then there will be a buffer stock. Okay. Now see, the way we have done the probability calculation for the shortfall, the similar way we could have done it for the buffer stock as well. But for us right now, buffer stock, they have said that it is simple for you. Don't do the probability calculation for that. For buffer stock, just say that on an average, the demand is 60. So over here, there will be no buffer stock because you have taken a ROL of 60. On an average throughout the entire year, the buffer stock will be 0. Over here, if the demand is on an average, the demand throughout the entire year is 60, uh, and you have a ROL of 70, right? So when the inventory is depleting, right, over here it is going down. You are placing an order at 70. Over here you placed an order and it is still depleting. And by the time it reaches 10, it will the stock will be again piled up. You will again have a stock from the supplier. Again it will go down. At 70 you will place the order. Okay, but at 10, by the time it reaches 10, you will again have the new units. So your stock is never going to be below 10. There is always going to be a buffer stock of 10 in your inventory. Okay, this is not average inventory. This is the lowest. This is the outstanding inventory which is going to be there throughout the entire
This
year.
is
Sorry,
this is mentioned in the question. The
what?
buffer stock.
No, buffer stock
Buffer.
we have to figure out, like because we have the demand probability given to us, we are saying that the average demand throughout the entire year is 60. Okay, average
Yes.
demand throughout the entire is 60. But against that, we are having a ROL of 70. Okay, as a result, the buffer stock will be 10. Getting it?
Yes. Sir.
Okay. Chalo. If the demand is if the ROL is 80, in that case, the buffer stock will be 20. Now, buffer stock is something beyond the average inventory. If your reorder level is 70, your average inventory is going to be 35. If your reorder level is 80, your average inventory is 40. That is something that is totally different. Like in EOQ, you can figure out at EOQ, you have figured out the lowest holding cost. So that is already figured out by the EOQ. So you are not concerned with the holding cost of average inventory. You are concerned about the holding cost of the buffer stock over here. So what you are going to say, we are holding extra inventory throughout the entire year. What is the holding cost? Is it given in the question? Holding cost given in the question is this, $8 a unit, $8 a unit. So over here, 8. Now this is going to be there for the entire year, right? We have taken the buffer stock for the entire year. Otherwise, you can also do a probability thing like this also. That if the demand is 70, there is this is the probable shortfall throughout the entire year. You can do it for the individual other demands as well. If the demand is 40, in that case, the probable buffer stock is this much. If the demand is 50, probable buffer stock is this much, right? That could have been done over here, but for buffer stock we don't have to make such a complicated calculation. Okay, but for shortfall we have to do it. All right, so that is there in our curriculum. Otherwise in real life the calculation should be like this only. You should have done the complicated part for buffer stock as well, but for buffer stock we are not going to do that. And over here, total buffer cost, or I can say buffer cost will be whatever is the buffer stock multiplied by 8. Okay, copy, paste, copy and paste. Now over here, what I will do is I will bring the total buffer cost is 0 in this case, and it is 80 in this. Chalo. So the total cost, buffer plus the stock out cost over here in this particular case is 240 plus 0. In this case it is 80 plus 160, and in this case it is 160 plus 0. All right, getting this one, yes or no?
Yes.
So what should be the reorder level? Obviously 70, right? So this is a
Yes.
tricky one, so it was worth doing this question right now in the revision. Chalo. So that is your reorder level in case of uncertain demand. There are two types of reorder level. One is in the certain demand, one is in the uncertain demand. Certain demand is very simple. Whatever is the lead time multiplied by the demand per day in that lead time. Okay, and if the demand is uncertain, then you have this entire probability distribution, and then you can do the calculation in this way. Other inventory system, just in time is you just have to bring the inventory whenever it is needed, whether you are trading or manufacturing. I can just go through the theory part of this. All right, with this, chapter number 14 is over. Now we are moving towards chapter number 15. All right, chalo, so let us continue. Yeah, hi Lakshita, how are you?
Yeah, hello, I'm good. I'm good.
Great. Chalo. So we are starting with cash management of the working capital part. I'm not able to close this. Chalo, anyway, let us continue. So now we are starting with the chapter number 15, which is cash management. In the cash management, the first part of the chapter, there is a discussion about the centralized treasury management. So there is this theory related to that. Over here, we are given the importance of having a centralized treasury, because if you have a centralized treasury, let me just open the Excel file, and we have chapter number 15 now. So, if a multinational company is having a centralized treasury, so let us say it is having subsidiaries in all these different countries, all right, India, let us say China, let us say Pakistan, let us say UK, and let us say Cambodia, right? So all these different countries, they are having offices. So what they will do is, instead of having individual treasury manager at each office, what they are going to do, they are going to have a common treasury management department, and that department will be able to manage the cash on behalf of all of them individually. One of the major benefit of this is, let us say India is having a surplus of $50 million, and let us say Pakistani this company is having a deficit of, let us say, $30 million. Okay, if they go to borrow from someone in their local region, right? If they try to borrow in their local region, let us say they are being charged over here 8 percentage per annum interest rate. And let us say if this Indian company tries to invest somewhere else, okay, this Indian subsidiary, let us say if it tries to invest in India, let us say it is getting a rate of only 5 percentage over here, okay, in India, for investment. Then in that case, what they can do is, they can, like, the central manager, the central treasury management authority, what they will do is, they will ask the Indian subsidiary to give the money to them, and they will then give the loan to this particular subsidiary. And as a result, maybe they can pay a interest to 6% to this, and maybe charge an interest of 7% to this. So in that way, both of them are benefited. Or maybe internally, if they don't want, they cannot have, like, they can have a system of charging no interest to internal departments. But this can be undertaken only if you have a central treasury department. So that is the major benefit of this. You can just go through the central treasury part, and treasurer's role, and everything. Cash management, now we are talking about cash management, liquidity management. So over here, transactions motto, precautionary motive. See, liquidity management is necessary, right, in order to carry on the day-to-day activities of your business. And how do you do it? You can prepare cash. A company must be profitable to continue in existence. However, profitability is not enough, right? If you're not able to meet your day-to-day expenditure, the company can go bankrupt. So this is all okay. It is cash flow statement is given to us. Is this a cash flow statement or cash flow budgeting? It is cash flow budgeting. So cash flow budgeting is as such easy. Risk and uncertainty in the forecast, what if analysis. See, sensitivity analysis we have seen in the NPV chapter. Okay, that was about the sensitivity analysis about the NPV variables related to NPV. But that same thing, the same sensitivity analysis can be done by for cash as well in the cash budgeting. What if fixed overheads are increased by this much percentage? What if cash sales is increased by this much percentage? How it will impact the total cash balance? So that is the part in the cash budgeting part. Now this question related to cash forecasting, we have solved a similar question today morning in the probability chapter, right? So Sneha, you should now be aware. Just look at this. Okay. Zombie company is worried about exceeding its overdraft limit of $5 million. Company has used Monte Carlo analysis to produce the following forecast of next net cash flows for the next two periods, and their associated probabilities are these. Okay, in the period 1, the cash flow can be any of the three. Okay, and in the period 2, the cash flow can be any of these three, and these are their associated probabilities in the respective years. Zombie company expects to be overdrawn at the start of the period 1 by $1.5 million. All right. So now calculate the expected value of the period 2 closing balance. First of all, you need a expected value of the closing balance and the probability of a negative cash balance at the end of the period 2. Okay, what is the probability that the cash balance will be negative? So can you tell me, Sneha, that how many outcomes are possible over here?
9.
9, exactly. You just have to take this variable. Okay, Lakshita, for you, I'm just repeating. So whenever you have two or more different years of outcome, or maybe two or more different outcomes for any given event, okay, what you have to do is pick up all the possible outcomes in a particular period or a particular event. Okay, and you have to multiply with the number of events in the second event or in the second period. Over here, three possible outcomes over here, three possible outcomes over here. So you have to create 9 combinations. Combination 1 will be 6K, and in the second year 8K. Combination 2 is 6K in the first year, 4K in the second year. And you have to take the probabilities, individual probabilities, 20% over here, 35% over here, and then you can calculate a joint probability over here, 20% multiplied by 30%. That will be the joint probability of total cash flow of 14,000 in these 2 years. So this way there are 9 possible outcomes. Okay, and there can be the joint probabilities. Remember one thing, that the joint probabilities, the total of all the joint probabilities should be 100 percentage. It should be always 1 in numeric sense. So in that way you can find out this. So this is the table over here. You can just have a look at this. These are the various possible outcomes: 1, 2, 3, 4, 5, 6, 7, 8, 9. All right, and these are their combined probabilities, just the multiplication of the probabilities of the individual outcomes, and that will be your closing balance. And then what you have done is expected value is closing balance in this particular outcome. If let us say you have a total cash inflow of 14,000. Okay, this was the beginning. This is the beginning balance. It is given in the question, 1.5 overdrawn. Now, the closing balance will be 12,500 in this particular case. What is the probability of this happening? 0.07. So, what is the expected value? This is the expected value. So, over here, this is the expected value of the closing balance. Right, that was the first question. Second question over here is probability of a negative cash balance. So in order to calculate that, what you have to do is just look at all the negative cash balances, this, These three are the negative cash balances. So what we will do is we will just add up their probabilities. This plus this. All right. That will tell us that the probability of having a negative cash balance is 20 percentage. 0.125 points. Sorry, this one. 0.05, 0.125, 0.075. Or they can say probability of exceeding the overdraft limit. Overdraft limit given in the question is, what is the overdraft limit?
5
Exceeding the
million.
overdraft. Okay, 5 million. So what are the probabilities that we will exceed? Overdraft will exceed 5 million. See, this one is exceeding 5 million, this one is exceeding 5 million. So the probability that it will exceed 5 million is these two, this plus this, 1.95, almost 20 percentage. All right. So comment on the financial health of the company. So you have to comment that, see, there can be severe consequences. Now see, probability of having a negative cash balance is 25 percentage. Probability of exceeding the overdraft limit is 20 percentage. If you exceed the overdraft limit, there are going to be penalties, right? There are going to be higher interest rates, right? And that will be very not in the interest of the company. So it is a high chance, right? 20% is not a small thing. Okay, so you can there is a 20% chance of this outcome. To guard against this, management must find additional finance up to $7 million. Now, if you remember, we had discussed in the working capital chapter that if you are certain about like if you know that certain assets are going to be there in your business for a long period of time, then you can fund those current assets through the long term liability. So that is that point also you can add over here, that if the company should think about having a long term finances over here. This can also increase the chances of company not going exceeding the overdraft limit over here. All right. So now you have to interconnect all the points, different chapters also you should be able to interconnect. And you can, if some point is coming from another chapter, and if you are sure that it is actually correct, then you can have that kind of comment also. So, borrowing short term, what are the potential sources of borrowing short term? You can have debt factoring. Debt factoring is invoice discounting. It's just like invoice discounting. Invoice discounting is single invoices. Debt factoring is having multiple discounting, giving a contract that I'll be coming up with so many. This portion is covered in detail in this chapter later on, but we are just discussing this right now, or maybe I think it will be covered in chapter 16. But what is invoice? Yeah, here it is, chapter 16. So invoice discounting is basically discounting a single invoice against which debt factoring is giving a contract to a particular debt factor that I will be giving you the entire ledger itself. You have to only look after my debtors and everything. You have to only give the credit sales and everything. You have to manage my books for the debtors, books for the receivables. That is debt factoring. You can have multiple invoices over there. Bank overdraft is a source of funding, and both of them are going to give you some advances. Like if you have made a sale of, let us say, $50 million, then you can go for invoice discounting, and you can ask them that please discount 60% of the, give an advance against the 60% of the invoice, and they can give it. So it is generally around 80 to 85% of the discounting you can get. Now, bank overdraft, definitely nothing to explain. Short term loans, right? You short term loans, but this may require security, can have fixed or variable interest rates. Investment short term, where can you invest? Sources of surplus. You have done, like, what are the sources of short term funds? Overfunding, disposal of surplus assets or divisions, operating surpluses. So that can be this. Where to invest? Factors to consider. Cash surpluses should not simply be held in the bank account, while which provides low returns. Long-term surpluses should be invested in the positive NPV projects. Okay, this is something that we have studied and now we are pro at, right? If you have long-term surpluses, you should be investing in the positive NPV projects or used to pay dividend. If you are not investing in the project, don't say, sir, I will be investing in the long term, I will be investing in the mutual funds, I will be investing in the shares, I will figure out shares. No, you are a analyst, you are a businessman, right? You are not a stock broker or a stock agent. If you have long term funds, either invest in NPV projects in your own business, you can figure out some other business opportunities, or give it back to the shareholders, or the repayment of the debt or something like that. Don't think that we can do investments. Businesses, corporates don't invest in mutual funds in that way. Okay, we as an individual invests in mutual funds or shares or something like long term investments, because we have a goal that we want our funds to tackle the inflation and all those things. They have only short term funds because this is cost is very high. Like investors are expecting 15-20% return from you. Okay, mutual funds may or may not be able to generate that much return. If you have short term surpluses, you wanted to keep it over there for running your businesses. In that case, you can invest in short term in low risk high liquid investments like treasury bills. All right, don't risk investors fund. Don't say that I will invest in some securities. If there is a tricky question like this, be mindful of that. Most businesses will look for a variety of investments to achieve following objectives: minimize risks involved, ensure that some cash is available at short notice to obtain higher returns. Factors to take into consideration for investing surplus funds: amounts of funds, required liquidity, risk tolerance, expected return. Chalo. So all that is some simple theory. Short term investments: what are different short term investments? Money market, certificates of deposit, treasury bills. Just go through them. Like, I know you have already gone through them. If there are any other questions related to this, you can let me know. These are different investments that you can make. Now comes the most important part of this chapter. We have to figure out that what is the optimum cash balance, right? What is the optimum transfer amount? So this concept, let me just give you a chart and diagram we will prepare, and we will understand both these models: Baumol model and Miller and Orr model. These are the two models related to having a deciding how much cash to withdraw from our investments and how much cash to put in the investment. How much cash balance should we have? Chalo. So this, first of all, we have Baumol model. My spelling might be wrong. Baumol model. Okay, which is nothing but just like EOQ. Okay, how it is just like EOQ, we will understand in a minute. So let us say, oh, I have drawn it very big. Let us say this is the pool of our funds in our business, and this is some investment that we have done, investments that we have made. Okay, short term investments. Okay, no long term investments, right? Because long term investments, in long term we are going to give it to the shareholders, or maybe we will invest in the positive NPV projects. So this is our short term investments. We have made so many short term investments in our business, and this is the cash on hand. Okay, now every time I will need fund, let us say I need funds to pay someone. Okay, so I am going to have, let us say I have a cash of around 500,000 in my business. I have kept that much cash. Now every time I will make some payment, let us say I have made a payment of $100,000 to a supplier. So I will say, chalo, withdraw $100,000 from this. All right, withdraw $100,000 from the short-term investment, sell short-term investments worth $100,000. But that will cost me something. Every time I'm selling my investment, there is going to be brokerage, right, transaction cost. So all this is just like the cost of order that we have discussed in the EOQ model. All right. Now, if I am holding the money over here, if I am having cash on hand of $500,000, right, here I was earning a interest. Let us say I'm earning a interest, short-term interest of 5% per annum. But if, let us say, my on an average, okay, on an average, now average word, I think you should be familiar with, like thoroughly you should understand what is the average word over here. Average cash balance, right, which is the balance through the entire year. On an average, sometimes it is 400,000, sometimes it is 600,000, but on an average, whenever I open my balance sheet, because I have decided to keep this level of fund in my business, I see my cash is always something around near 500,000. All right, as a result, what is happening throughout the entire year, this 500,000 is going to be outstanding, as we have seen in the receivables chapter and the inventory chapter, that there is going to be some level of inventory outstanding, and as a result your on an average inventory is just sitting on the balance sheet throughout the anytime you open your balance sheet. So similarly, cash is going to be sitting on your balance sheet anytime you open your balance sheet. As a result, what is happening throughout the entire year, you have missed an income, right, interest income Okay, on this 500,000. Otherwise, you could have earned 5% on that as well. What should be the missed opportunity? That is 5 percentage, right? Since the money is sitting over here, $25,000 you have missed, right? Since the money is sitting over here in the business, in the cash on hand, right? Maybe current account or something, and it is not there in the short term investment, you are losing 25,000 over here, which is your opportunity cost, which, by the way, is just cost of holding the cash, right? Indirectly, it is the cost of holding the cash, this 25,000. So what do you want? You want, and now if you keep the balance very low, sir, then let us keep the balance as 10,000 only. So, right, we will keep only 10,000. Whenever we have to make a payment to the supplier, what we will do, we will sell our investments and we will then give it to the supplier. But in that case, your transaction cost will increase. The number of orders that you are processing throughout the entire year will increase. As a result, your annual cost of transfer will increase. Okay, over here, if you have lot of money, then your annual holding cost of the money, or I can say annual holding opportunity cost, is increasing. So you want to minimize these two, you want to find out a balance between these two, and for this we are going to again use the economic order quantity. Now over here the formula is going to be like this: 2 multiplied by the cost of order. Now cost of order over here is nothing but the transaction cost, which is in our syllabus will be given as a fixed cost of processing a single transaction, right? Don't use your brain, sir. In real life brokerage charges fluctuates as per the order size and everything, I know, but in our syllabus it is very simple that the transaction cost is going to remain fixed. Okay, and that is the assumption of this model. If you read the assumptions and everything, that is written over there. Now over here, demand, annual demand, how much money will you need throughout the entire year? Okay, that will be given in the question, that you have your treasury manager or someone has assumed that like has predicted that you will need this much cash throughout the entire year. All right, that will be the demand for the cash divided by cost of holding, which
So,
is nothing but your interest cost. Yes, Neha?
if they give the monthly, you convert it into the yearly, right? The demand.
Yeah, demand
If
we can
like,
convert into yearly, or maybe yeah, it is better to convert into yearly, because in the formula it is written that we should be taking annual requirement of cash.
okay, so
Yeah. So over here, just a minute. Yeah, just look at this example. A company has large deposits which currently earns interest of 15 percentage. It has cash needs of 300,000 in the next year. Transaction costs are 120. So what you need to do is you have to do it like this: 2 multiplied by what is the transaction cost, 120, multiplied by the annual demand of 300,000, divided by divided by 15 percentage. See the 1.5. Okay, or you can do 15 percentage. In Excel it can be calculated very easily. We are not doing this. Other than that, we are asked about the average cash balance, average cash balance, average cash balance. Now it should strike in your mind that whenever you will have, like the way we had this in the inventory chapter, that whatever is your order quantity in inventory or EOQ is also an order quantity, nothing else. Then your average inventory was order quantity divided by 2. If your EOQ over here is 21,909, your average balance is going to be this divided by 2. Okay. So with this, we are done with the Baumol model. All right. I don't know whether I'm pronouncing it correctly or not. Baumol sounds a little strange. Baumol model. Chalo.
So,
Yeah.
can you please explain why did we compute average balance? Like,
It
because
was
a lot of
asked in the question.
the last, yeah. So, I mean, most questions it was not there. I thought average cash balance is like you know, basically the average
On an average throughout, how much is outstanding throughout the entire year, right?
yeah, that's what I
Yeah,
thought.
generally that is the cash balance, but this is average balance as per Baumol model, because the Baumol model is having one of the biggest assumption over here, and that is the weakness of this model, is that there is going to be a constant demand for the cash which is going to be satisfied by your short term investments. You will keep on selling your short term investments, and it is ignoring that sometimes you will be depositing the money as well. You will be generating the money from your business as well. That is ignored over here. In that case, if your business is generating money, if your business is giving you money back, and that if you are putting back in the short term investment, then this does not hold true. But as per the Baumol model, whenever this word is used, economic transfer, and you are given details like this, cost of order or cost of holding, and if this is asked, then you have to assume that they are asking the average cash balance using the Baumol model, and then you have to use this formula at that time. Okay?
Okay, yeah. Thank you.
Yeah. So, a cash management model which can accommodate variable demand for a cash, such as Miller or model, is more relevant. See, they are saying that there is going to be a constant demand, one thing, and in reality, interest rate and transaction costs are not constant. That is also a weakness of this. The major weakness over here is over here. The model assumes a constant use of cash financed by selling investments. Right? We are never saying that we will receive the money back from the business. At some point, the business will generate money, and in that case, we will have to deposit the money back in the short term investment. However, any worthwhile business must at some point generate cash rather than burn it. So this model is practically not usable. So what is practically usable is a Miller or model. Miller or model is very simple. Okay, it's very Miller or model. Miller or model. Chalo. So this model says that you are going to figure out a bottom point. Okay, this bottom point is something that you will decide that this is the minimum cash that I want to have. Minimum cash balance. Okay, that is something subjective. You have to decide that how much minimum cash do you want in your business. So this model says that over here, let us just directly come to this formula. This model says that there is a return point, and there is a spread. What I want to show you is this chart. Chalo. So this lower limit is something that we are going to decide, and based on other elements like spread. Okay, now spread is dependent on your transaction cost, variance of cash flows, interest rates. Will come on all of these things, but the point is that once you have your all these items given in the question, transaction cost, variance, interest rate, okay, this will give you spread. Okay, spread is basically over here is going to give you a range that from your lower limit you are going to have a spread. Spread means the gap between the upper point, upper limit. So once you have the minimum limit and once you are able to find out the spread, then you can find out an upper limit. Upper limit is basically spread plus the lower limit. Where is it? No definition for upper limit. Chalo, no worries. All right. And now at the 1/3 point, whatever is the spread, let us say the spread is 100. Let us say the lower limit, let us say is 50. Okay. And let us say the spread is 100, which means your upper limit will be 150. Okay. So let us say you have decided that you want at least $50 million in your bank account, like in your current account as a cash on hand. And this is the spread. $100 million is the spread. How to calculate the spread? We'll just check the formula. And then this will be your upper limit, 150. So between the lower limit and the upper limit, at one third of the spread is going to be a return point. Over here, somewhat over here, is going to be a return point. Return point is return point is basically a point at which you will always come back. Which means, let us say we have started from here. Let me use another color. Okay. So let us say we have started from here. and we are receiving cash. We are receiving, as we have discussed, the Miller or Baumol model was not talking about what if we receive the cash. So we keep on receiving the cash. We started with somewhat in the middle, like what should that be? One third means it should be 133, something around 130. This is the return point, 133. Okay, we started with a cash of $133 million, and we kept on receiving, not 133, sorry, 83. It is one third the spread. Spread is 100, so one third will be 33. So 50 plus 33 will be 83. 83. 83 is the spread. So at 83 we started, and the cash kept on coming, and as a result we have reached to a level that now we have $150 million in our bank. As soon as we reach 150, we will just drop the cash. Okay, we will just make the investments. When we touch the upper limit, we make the investment. We shift the cash from the business to the short term investments. And once we reach to the return point, again it can either go up, sometimes it can go up, sometimes it can go down. As soon as it touches the lower point, okay, lower point over here, which is 50 over here, as soon as it touches 50, we will again, now we will, what we will do, we will sell our investments. Okay, this is the concept at which the students are making mistakes. Even if a slightest change is there in the question, even if it is slightly tricky, they are not able to recall that when you touch the lower point, you have to sell the investments. Okay, students feel that, sir, we have touch the lower point, now we should be investing. No, you should be selling. You are talking about cash. Cash is lower, not the investment. So as soon as the cash is lower, you're going to sell your investment and you will bring the cash back into the business, and now you're again, the balance will be 83. So this is the concept of Miller or model. So return point is very simple: lower limit plus one third the spread. Whatever is the spread, one third of the spread has to be added to the lower limit, and you will reach the return point. Which means this gap between the upper limit and the return point is two-third the spread. All right. Now spread is three times the three-fourth of the transaction cost multiplied by variance of cash flow divided by the interest rate raised to 1 by 3. Now over here the interest rate is a daily interest rate. Okay, this is very important, because in the EOQ model which we have studied just right now, in the Baumol model, the interest rate was annual interest rate. We directly divided that by 0.15. There we are talking annually, here we are talking daily. Variance available is a daily cash variance. Okay, transaction cost is the fixed cost, like whenever you will sell or purchase, it will be the transaction, the fixed cost of buying or selling marketable securities. This is similar to cost of ordering in the Baumol model. Spread is the difference between the upper limit and the lower limit, and daily opportunity cost of holding. Note that upper limit is the
Sir,
lower limit plus the spread. Yes, Neha?
sir, if they have given an annual rate, how do you make it a daily rate? 365?
Yeah, we can divide it by 365. Miller,
Okay.
let us see. Here is the question. Okay, it is given per day. Let me see if there is another question. No, it is not. But you can go through any other question. If the annual rate is given, you can divide it by 365. Unless 360 is mentioned in the question.
So can you explain, graph thing again? Like
Okay.
when you were explaining buy and sell, so I have a little confusion there. I did not understand that.
Okay. Okay.
Because
Okay.
sometimes they ask us like, test your understanding questions like, what will you do in this situation?
Hmm. So we will, okay, chal, I'm repeating. First of all, let us say this is the lower limit and this is the upper limit. And this is the return point. Okay. Now what you have to do, as soon as it touches the lower limit, you have to sell your investment, short term investments, and then you have to bring that money back to your business. As I have said, we have cash in hand and we have short term investments. So we'll sell the short term investments and we will bring back the cash in the business, because now the cash is just 50 million. Okay, and you want it to come back to 83 million. As soon as it reaches, this is the minimum cash that you want to have in your business. So you will sell your securities, whatever proceeds you will receive, you will bring it back to the business. As soon as it touches the upper part, okay, what you will do is you will make investments. You will put the cash back in the short term investments and you will come back to the return point. Clear, Lakshita?
But sir, I had a question. Okay.
Hmm.
So, um, otherwise, we always sell something when it is at the highest, right? When the value is the highest.
This is not value, this is the cash balance in your business, cash on hand in your business. When the cash on hand reaches 150 million dollars in your bank account, current account, okay, you are not
Hmm.
going to earn any interest on this, you are not going to get any return on this, right? This is the,
Yeah.
just think about we have a cash in on hand. So once it
Hmm.
reaches to 150, we want the surplus to go to the short term investments, because over here we are earning something. If the money is sitting with the short term investments, we will earn something over there. So as soon as it goes to 150, we will bring it back to 83.
Oh. Hmm. Okay.
Clear?
Yes, yes. Thank you.
All right. Chalo. So now we are done with the Miller Orr model, and with this, chapter number 15 is over. So in the inventory chapter, we learned about EOQ, that is mostly talking about the management of inventory best, and we learned about ROL. ROL, there is this certain demand and uncertain demand, right? Over here in the cash management chapter, the major part was about the economic order quantity again, which is Baumol model and the Miller Orr model. So that is about chapter number 15. Now we are starting with chapter number 16, which is going to talk about the management of receivables and payables. So that we will start in just next. Do you guys need a break? We started at 3:40, right? It's 1 hour. So let us have a 5 minutes break and then we will start at 4:47.
Sir, we are there.
All right. So Lakshita is ready. Sneha, you are
Yes, sir.
there. Chalo, both of you are ready. Let me remove this and let us begin. So now we are starting with chapter number 16, which is your management of receivables and payables. So at the beginning of this chapter, there is a discussion, there is a theory about like how, what are the things you should be taking care of. First of all, whatever is the, like, two things you need to fix. One is your credit period, okay, how much credit period you are going to give, and the settlement discount. These two things should be written everywhere on the order forms whenever someone is placing an order, sales invoice, monthly statements, everywhere. So, and then comes the setting the credit terms. Okay, now how do you decide that what should be the credit policy, how many days should we be giving? First of all, we have to find out the credit limits, right? You have to have a like you have to do the credit check of all the customers that to whom you are supplying the goods, and you have to figure out that what should be the credit limit that you should be allowing them, that how much goods can they take from us on credit. Now, credit customers should be informed in writing about following the normal credit period, the discount for prompt payment, right? If there is any discount that you are offering for prompt payment, that also you should mention. Any interest that will be charged on late payments, and all these things, they should be told clearly about your credit policy. And then you have to do the monitoring, that must maintain accurate records of detailing all customers transactions and amounts owning to each customer, right? If need be, you have to chase your customers, right? You have these are the two useful reports. One is aged receivables gives you a list that who all are the customers who have not paid beyond these days, are past due certain days. right? And credit utilization report, that how much credit has been utilized by different customers. If you have set a limit for, let us say, $100 million for a particular customer, and he has not, like, he has already utilized $90 million, you are not going to give any goods worth more than $10 million to that particular customers. Okay. How do we do the credit assessment of a customer? Bank reference, trade reference, right? Then you can have credit reference, like through credit rating agencies, latest available financial statements, information from financial media, right? See, major listed public companies and all those things can be there, like information about them will be available on the media as well, financial media as well. So if someone is telling, if someone is giving you the news about the Kingfisher, and they're saying that they're not able to pay the dues of their employees, then you should not be giving goods on credit to credit to Kingfisher. And maybe you can have a visit to the client's place, that will give you a feel about that, how the business is going on, is the client trustworthy or not, right? Now, collection procedure, how do you collect the money from the client? You can give them monthly settlement, monthly statements, you can give them chasing letters if they're not paying on time, you can give them phone calls, you can have a personal approach, right? Just reach out to the CEO or someone. Okay, stopping supplies, legal action, external debt collection. Now, this is very important for us. This is the major part of the chapter that we'll be discussing: external debt collection facilities, which involves debt factoring and invoice discounting. So that we'll be discussing in detail in a while. But meanwhile, charging interest on overdue invoices, that is something that you should be doing. Foreign overseas receivables, how do you collect the, so first of all, default risk is very high. Whenever you are doing exports, default risks are going to be higher as compared to the domestic sales, okay, in exports. So what are the different payment methods? We have discussed bills of exchange in detail. Bills of exchange is nothing but a signed contract by the customer, that I will be paying the supplier on time. Okay, they are just signing the contract. Then comes the forfeiting. So forfeiting is just like bill discounting, but over here there is going to be a series of bills of exchange which is discounted. Bill of exchange can be discounted. Okay, so forfeiting is basically discounting a series of bills of exchange, but over here there can be a non-recourse. See, recourse and non-recourse are very important aspects over here in the receivables management. Non-recourse means that the bank, once I have done the discounting with the bank, if the customer is not paying, the bank cannot come to me, right, and can ask me to pay on behalf of the customer. Once I have taken the money from the bank, now the responsibilities of the bank if the customer is not paying. So that is non-recourse. Okay, non-recourse, but it is going to be more costly as compared to the bill discounting if non-recourse option is chosen. So it is usually only available to large receivable amounts, right? Over 250,000. Nobody is going
So
to be interested in. Yes, Neha.
bills of exchange is recourse, right? There's no option of
No, no,
non-recourse.
no, no, no. If you do the discounting in bills of exchange, there are, once the bills of exchange is received, bills of exchange is basically a signed contract that I'll be paying this to the supplier. Once you have the signed agreement from the supplier, from the customer, you can go and, like, maybe hold the bill till the maturity, or maybe get the bill discounted from a bank. When the bank discounts a bills of exchange, mostly it is a recourse recourse discounting, which means the default risk stays with the exporter. Okay,
Okay.
bills of exchange is not discounting. Okay, you can discount the bills of exchange. All right, so next comes the letter of credit. Letter of credit is a very complicated mode of payment. So let me just see if there are other payments left, then we will discuss letter of credit quickly. Chalo, so letter of credit, I'm quickly telling you this. This is a person. This is a importer. He is an importer in USA. All right, and I am an exporter over here, sitting in exporter in India. Chalo. So what will happen? I have to give. Let us say I have to supply the goods to him. but I will not directly supply the goods to him. I will ask him to send me a letter of credit. So what happens is they first of all negotiate with each other on call, Zoom call, or anything, and then they are going to write a contract. So this person is going to write an entire contract, and he is going to give this contract. This person is going to give this contract to his bank. So the bank in the US. All right, this bank will give the contract to my bank in India. All right, and this bank is going to give me the contract, and they will ask me to sign it. Once I do this, then I will sign this contract. I will sign this contract, and then this contract will be given back to the US bank. All right, and this was already signed by this person. So ultimately both of us has agreed a contract which was created by keeping the banks in between. Now I will send the goods, and as you, if you remember, there is once I load the goods on the shipping in the okay, let me just draw a ship over here. So where is the ship? This is the ship. So this is a ship. Once I load the goods on the ship, this guy on the ship is going to give me a bill of lading. Bill of lading. Bill of lading is different from bill of exchange. It is different from LC. LC is letter of credit. So bill of lading is given. I will give this bill of lading to my bank. Okay, and that bank will give the bill of lading to the US bank, and that bank will give the bill of lading to the importer over there. But as soon as he checks the bill of he will give a copy of the bill of lading to this guy. Okay, you need the bill of lading in order to access the goods from the shipping company. And then he will check the bill of lading, and he will say everything is okay. When he will say everything is okay, he will give a green flag that everything is okay. Once he says that the documents are correct, right, in that case the bank will give the payment. In that case the payment will flow from this bank, okay, to my bank, and then my bank will give me the payment then and only then. All right, whatever is the credit term, 60 days, for 30 days, 40 days, and then this person is responsible to make the payment to his bank. All right, now we are not concerned, we are not afraid that whether he will make the payment or not, because his bank has given the guarantee that if the goods are proper, if the documents are proper, in that case we will make the payment no matter what happens. Clear with this, guys? Yes or no, quickly?
Sir, bill of lading is same as the title of goods.
Yeah, it is the title of goods. Like if you have the bill of lading, then and only then the shipping industry will give you the bill of the goods. Okay.
Yes, sir.
Chalo. So that is one of the modes of payment, letter of credit. Now, disadvantages, advantages, disadvantages, you can just go through. Other modes you can just see. Open trading is no security, nothing. Both of them are trusting each other. That can happen only if both of the parties are known to each other, or maybe you are the only supplier and importer, and you are dealing with different party with different names in different countries. Cash against document, it's just like this only, that I have loaded the goods. I will give you the documents. Okay, I will give this party the documents only if he gives me the cash. Once he see, I have loaded the goods, I have the proof that I have the bill of lading. I will send him the photo of bill of lading, that see, I have the bill of lading. This is the scan copy. Just check if you find this proper. You send me the cash, and then I will send you the original bill of lading. So cash against document. Export credit houses. Export credit houses are basically the organizations that give credit to overseas customers and guarantee payment to the exporter. Right, if India wants to increase its export, what the Indian government will do, Indian government will tell me, okay, that whosoever is your customer, this is the Indian government, okay, and there is some importer, let us say this importer is in Kenya. Okay, let us assume that this importer from Kenya wants to import something from India, but he is not having all the funds right now. He needs a loan for it. So the Indian government is going to give him the loan, that okay, you have the funds, and you then pay to my exporter, okay, exporter from our country. As a result, our country's export is going to be boosted. So why do we need to do like this? Why the government need to give loans like this? It is called balance of payment. Now, balance of payment probably is there in our syllabus, so we'll see if it is there. Otherwise, we are not going to enter into that detail. Export merchants. Okay, export merchants are basically the intermediaries. There is going to be one party in the between. In between, I have to deal with this. Him only, he's going to have an office in India, and he is easily reachable in India. So I'll be trusting him, and I will be giving him the goods to him, and he'll be giving me the money, and he will be having an office in Kenya as well, and he'll be the middle party. And this guy is trusting him, so no issues over here. So this is going to be a merchant exporter who is going to have his commission or something like that. Export credit insurance. Government is going to give me insurance that you do the export. If the party is not paying you, we will pay you, right? In order to increase the exports. Exports factoring, right? Just like the bill discounting and factoring, export factoring is also available. UK export finance, finance given by the government that you do the export, we will take care of it. In India, it is there. In India, ECGC is there, Export Credit Guarantee Corporation, which gives me the funds. Okay, this is not a mode of payment. This is a mode of finance. It gives me as an exporter the funds. I have to use this fund in order to let us say I've got a very big contract of making a machinery, but I don't have the funds. So I will take a loan from the government. I will use those funds in order to make the machinery, and then I will export and give the money back to the government. That is ECGC. So counter trade, right? Barter system, nothing to be explained over there. Now starts the main chapter: invoice discounting and factoring. So invoice discounting, you guys know what is invoice discounting. Debt factoring is one step beyond invoice discounting. So invoice discounting is going to discount one or two invoices at maybe 80%, 85%. And whenever you receive the money, you will give back the money to the, so this is a supplier, this is a customer, and this is the bank or any other intermediary who is doing the invoice discounting. I have supplied the goods, he has not given me the cash, so I will take this invoice and I'll give it to the bank, and the bank will give me the money. Okay, but this money will not be full amount, this will be around 85 percentage. All right, whenever the customer pays back, in that case I will give this money back, return this money back to the bank, right? Or there can be a setup where the customer directly pays to the bank, and the remaining 15% the bank can give me later on, and maybe they will charge a fees and the interest on this advance that they have given. But if the customer is not paying, in that case I have to pay the bank over here. That is known as recourse. So that was invoice discounting. And the debt factoring over here, we are buying a package from some debt
So,
factors. Okay, yes, Neha.
can you please explain this part again? Became confusing in between.
Discounting.
So,
Yeah.
so I had a question. In invoice discounting, do we take money from the bank or like agencies? Like, because
Okay. Chalo. I'm repeating it again. I got your question. Both of you are a little confused in this. Chalo. So this is a customer. This is a supplier. Okay. Now what happens is we have given the goods on credit. Goods are delivered. Now they are supposed to give us the money, but let us say the money will be received
So,
after 30 days. Yes, Neha?
can you explain it in form of amount, like taking some amount?
All right, chalo. So goods, let us say we have sent, not exported, sent goods worth of, let us say, $100,000. Okay, $100,000. And now the customer is going to pay us $100,000 after, but after 30 days. He will be making us the payment after 30 days. So what will happen over here? Over here, what I will do is I have given him the invoice. He has signed the invoice. Now I will have this invoice with me, and I will go to the bank. Okay, bank or any other agencies who are doing the discounting. All right, so this bank, I'm just writing bank over here. It can be any other intermediary as well. It can be done by any bank or any other financial intermediary. There can be businesses doing just the bill discounting. It's not necessary that it can be done by certain parties only. I think that answers your question, Lakshita, right? Chalo. So over here, I will give this discount to the bank. I'll show that discount, this invoice to the bank, and I'll say that I am going to receive $100,000 in a month. Okay. So the bank will say that I'll give you $85,000 as of now. So I will receive $85,000 from the bank. Okay, because of the discounting. Now after a month, this customer, okay, the bank will go with the invoice to the customer that please pay us this $100,000 which you owe to Mr. Supplier. So the customer will pay $100,000 to the bank. Okay. And once the bank receives $100,000, the bank is going to pay the remaining $15,000 to the supplier. All right. But over here, they can deduct interest for this 1 month on this $85,000, and they can deduct a fees over here for arranging this discounting. These two things can be deducted, and whatever is the leftover amount, that, let us say the leftover amount is 12,000, that will be given back to the supplier. That is bill discounting. Clear with this?
Yes.
Okay. Lakshita, done?
Yes, sir.
Perfect. Chalo. So now we are going to talk about, after bill discounting, now we are going to talk about factoring. So factoring is almost the same thing, but instead of one customer, okay, this is a factor. So factor is just like an extended body. Okay, it is a third party who is going to take care of my credit. Okay, whosoever I am giving, let us say these are different customers, right? Whenever I give goods on credit to him, any customer, okay, the factor is going to maintain my books of accounts for that entire receivables. Okay, he will take note of who was the customer to whom I am giving goods worth $100,000. We have to receive this from the customer after 30 days. He is responsible for collecting the money from the customer. Right now, as soon as I sold goods worth $100,000 to a customer, okay, factor will give me 85% of that money immediately. Not compulsorily 85, but any amount of money he will give me. And whenever the customer will pay, okay, factor will receive that amount and he will give me the remaining 15 percentage, or whatsoever is the amount left over after the interest and the fees and everything. So factor is responsible. And over here, after the credit days, no matter whether the factor has received the money from the customer or not, he has to pay us the remaining 50% or whatsoever is the leftover. Okay, because we have a non-recourse agreement. Now there can be non-recourse or recourse agreement with the factor. If there is a non-recourse agreement, the factor cannot ask us to pay the uh, remaining amount. Okay, like factor cannot ask us that I have not received the remaining amount, right? You have said that you have taken 85% from me, and you said that the customer will pay 100% to me, but customer has not paid me the 100%. You have to give my money back. Then in that case we will have to, if we have a recourse agreement, then in that case we will have to give the money back. But if it is a non recourse agreement, we don't have to give the money back. So that is factoring. Now our syllabus is going to give us different situations for factoring. Okay, these were the questions, and over here the major chunk of calculation, like what we have to do is we have to do the cost versus cost versus benefit analysis. If we hire a factor, we have to pay, let us say him, the whatever is the fees on the annual credit sales, right? There can be different costs associated with, and there are going to be different benefits, like the 600,000 reduction in admin cost. Okay, and the most complex calculation over here is the finance cost. All right, so what I'm going to do is, let us pick up any question from this. All right, let us do it right now. And then what you are supposed to do is, as soon as the lecture gets over, start revising this chapter from factoring part, and solve all the questions related to factoring. Yesterday also we saw one of the chapter, and some areas were the most complicated one. Those are the areas you should be focusing after revising everything else. Those are the areas you should be solving more questions on the last day. Because other things are you have done multiple times and you have solved it multiple times and you are confident in that. So this is, I believe, is one of the areas, factoring and questions related to factoring, especially the finance cost, which is complicated, which you should be solving today after the lecture. So I'm coming back in 2 minutes. Meanwhile, you can just go through all these questions and let me know if there's any specific question that you would want me to do. That will solve right now. The rest of the others you can do after the session. Yeah, Sneha, you have any doubt?
So
Yeah.
so
Okay. So what?
which PDF is this? I mean, is it cash management? What is it like?
Yeah, management of accounts receivable and payables, chapter number 16.
Okay.
Yeah. Yes, Neha.
No, sir, nothing.
Okay. All right. Chalo. So I'm coming in 1 or 2 minutes, and meanwhile, just decide which question would you like me to do out of the three which you feel is the toughest. We will do that. The rest you can practice on your own. Okay, chalo. So I'm back. Have you guys decided any question? S-
So,
Yeah.
so usually when I'm solving questions related to accounts receivables and payables, I usually get
Mhm.
confused with the amounts to take in early settlement discount.
Yeah, that we are going to cover early settlement discount. This part we are going to take in a while. Any like, do you think this is complicated? Do you want me to solve any one of the three questions, or shall we move on right now?
So I just wanted to understand when there's a bad debt saving, that's just for the non-recourse agreement, right?
Bad debt saving. Yeah, if you have a non-recourse agreement, right? If it is mentioned in the question, just look at this in this question over here. Yeah, see this one. Customers take 60 days and bad debts are 1% of the sales. Okay, bad debts are 1% of the sales. The factor would charge a service fee of 2%. Okay, this is not mentioned in this question. Let me just read this question. Yeah, here it is. See, bad debts are 3% of the revenue. Bad debts are 3% of the revenue. Over here, factors expect to reduce the receivable collections period and the bad debts will be reduced to 2%. Okay, now this is to confuse you because this is a non-recourse agreement. In a non-recourse agreement, this entire 3%, okay, this entire 3% is not at all your concern. Okay, bad debts saved over here will be entire 3%. You don't have to just say only 1% we are saving, entire 3% you are saving. Clear?
And in recourse, it would just be 1%.
Yeah, in recourse it would be just 1%. 1%. So that is something that is overlooked by the students, right? Because this is no specific highlight or something like it. It is very easily casually written. Factor would charge 2% of revenue for a non-recourse agreement. But if you don't read this properly, instead of non-recourse, if recourse would have been written, in that case you would have a bad debt savings of 1%. Chalo, so if you guys are not having any problem with these questions, let us move forward. Okay.
So,
Yeah, Lakshita.
could you explain, um, question number, example 3, settlement discount and extended credit?
Okay, I'm coming to that only.
Okay, fine.
Chalo. So let us, since both of you want me to do this only, settlement discount. Chalo. So let us start with the settlement discount. All right. So what happens is we are going to give early settlement discounts to the customers. Now, how do we calculate this? All right. Over here, we got two questions. Okay. Example one, example two, and question number three. And let me see if there, yeah, here it is. Example three, annual cost benefit. Chalo. So, first of all, let us take a simple example of early settlement discount. What happens is company offers its customers 30 days credit, but the customers are taking 45 days credit on average. So this is irrelevant information for us. No matter what you are giving, what matters is what the customers are taking. Right now, the customers are taking on an average 45 days to make the payment. To speed up the collection, the company is considering introducing a 1.5% discount for the payment within 15 days. You have to make the payment within 15 days. In that case, you can get a discount of 15%. The company's working capital requirement is financed with an overdraft at an annual cost of 10%. So over here, what are you? You are the supplier. Okay. So right now, I'm just early settlement discount, ESD. Chalo. So what is the discount rate? Discount rate is 30 discount rate is okay. This discount rate is not the usual discount rate that we use for NPV calculation. So I would use the word array. Early settlement discount rate is 1.5 percentage. If I get a discount and payment has to be made within 15 days. All right. Now, if someone is making the early payment, okay, what is the amount they need to pay? Payment will be, the remaining amount will be 98.5 percentage, right? So over here, if someone pays 98.5 percentage early, right? This is the time line over here. This is 0. This is 45 days. Generally, he was paying after 45 days. But now, if he is paying early, if the customer is paying early within 50 days, he will need to arrange. So far for 45 days, we were kind of a uh, source of finance for him, right? He was able to fund his whatever working capital assets, right, through trade payables. We are his trade payables. We are the supplier. So now if he makes the early payment, okay, over here of 98.5 percentage of the amount, right, over here for the remaining 30 days, for the remaining 30 days, he will need to fund this 98.5 percentage, right? He will need to fund this 98.5 percentage. Now, what is the benefit that he is getting over here? He is getting a benefit of 1.5 percentage, right? So he is able to use this. He is, sorry, over here, this is the, like, whatever fund that now he is going to bring in the business, like he will have to bring it for someone from the short term capital or something like that, right? What is the fund cost for that fund? The cost for that fund, annual cost is 10 percentage. 10% is the annual cost. Okay, what is the cost over here? Either what I can do is convert this into an annual thing. So over here, me as a supplier, I will receive this 98.5% 5% of the amount, right? And I will be able to use it for an extra 30 days over here. Okay, I will be able to use it for an extra 30 days over here. Otherwise I have to use this bank loan for funding my uh, whatever are the invoices for 30 days, right? So over here I can use this 98.5 for 30 days. What is the cost of using that for 30 days? 1.5 percentage. So technically, what is the effective interest rate over here? 1.5 percentage, right? What is the amount that is available for using 98.5 percentage? So this should be the first step. Step number 1, calculate the effective interest rate. Okay, calculate the effective discount rate. Okay, this should be your first step, no matter what. Okay, whether it is the early settlement discount from the supplier's point or customer's point, okay, this is the effective discount rate for both the parties. Okay, now how many days are you able to use this funds for? You are able to use this funds for 30 days. So this is actually the cost that you are bearing over here for using these funds for 30 days, right? So what is the effective annual interest rate over here? If this is the interest that you are paying, technically this is the interest that you are paying, right? He is paying you early and he is getting a discount. You are the supplier, you are getting 1.5% less. So effectively this is the discount that you have given, this is the interest that you are paying to use this 98.5 for this 30 days. Okay, so if I say that this is the discount rate for 30 days, okay, what will be the discount rate for 365? You can just directly do it like this. But this is the case of simple interest. In the case of simple interest, it would have been that simple. Okay, just proportionate it. All right. Now, in the case of compounding interest rate, what we have to do is this is uh, this into the bracket 1 plus this. All right, this one I can raise to and divide by 130. That will give me the rate for a single day. I'm not subtracting -1 over here, right? But what I can do is raise to 365, whatever is the rate for a daily daily interest. Okay, I can raise that to 365 and that will give me an annual interest rate. But over here I need to subtract 1. So this is the interest rate for the entire year if I take compounding interest rate. Clear, guys? Yes or no? Easy.
So here we have to take the number of days we can use the money, right?
We can use the money as a supplier. If we get the discount, if we are giving the discount as a supplier, for how many days we will be able to use the money. Okay. Now that same logic, that same exact logic apply. Now you can use this to do a kind calculation for any of this. Question 3. Okay, or early settlement discount over here. This is a complicated question. I would say that if you are able to do this question after this session, that is enough. You don't need to do another questions from this chapter, especially for receivables. So do this question. This is nice. So settlement discount, again the same thing. You can just calculate this. Now I am moving towards the payables. I'm not repeating the same thing. I'm not solving other questions. But now if you look at a question which was related to payables. Okay. Now the thing is, sir, how to, like, we have understood receivables. Now how to do the part from the payables? Like, we are the customer, then what do we do? Same logic, same story. Okay. This was easy to understand from the supplier's perspective, that supplier is going to use this money for 30 days, right? This 98.5 percentage, and this is his cost, and this is his effective interest rate. Same story, same logic. Chalo, let us look this for a different person. A company currently takes 40 days credit from its suppliers. Okay, we are now a customer. We are taking 40 days credit to pay our supplier, believing this to be free finance. Annual purchases are 100,000 and the company pays overdraft interest of 13 percentage. Overdraft interest of 13 percentage. Okay. Payment within 15 days would attract 1.5% quick settlement discount. If we pay within 15 days, it will give us a discount of 1.5 percentage. Calculate the effect on the profit or loss of accepting the discount. Okay, this is a slightly different question. You have to calculate numbers over here. This is easy for you. What is difficult is effective annual interest rate. This one will be difficult. A supplier offers 2% discount if the invoice is paid within 10 days, okay, of received, but offers no discount if the payment is delayed further 20 days. So calculate the annual effective cost of refusing the discount. Calculate the annual effective cost of refusing the discount. So the same thing, all right, I'm going to write the same thing over here. Okay, this is 20, this is 10. Okay, and over here the discount rate is how much? 2 percentage. All right, so step 1, same process. Okay, nothing is different for supplier or the uh, buyer or the payable or receivable. Nothing is different. Same step, 2 percentage divided by whatever is the amount that you're going to receive, 98 percentage. This is the effective interest rate. This is the effective cost. Okay, now let us calculate step 2. Step 2 will be calculating the effective annual interest rate. Effective annual interest rate, this is for how many days? Days over here is 10 days. Okay, if just think from the perspective of the supplier, that supplier will be able to use this money for 10 days. Okay, so supplier will be able to use this money for 10 days. So over here, the effective annual interest rate will be,
So,
yeah,
why are we not looking at the customer in this case?
I'm coming to that. But right now, just think from the perspective of the supplier. That supplier will be able to use this for 10 days. So this multiplied by, okay, let us directly calculate the compounding thing only. 1 plus this raised to into the bracket 365 divided by 10 minus 1. All right, it is, I made some mistake. Raised to 365 divided by 1 plus the interest rate only I have taken. Do you see any mistake over here? What happened? This is for 10 days. Further delayed for 90. Acha, further delayed. It is further delayed. Okay, further 20 days. I I thought beyond 20 days. So further 20 days means the entire time duration available is 20 days. This is 30 days. Further 20 days. So I can say this is for 20 days. I can just change this to 20, and now I can change this. This is available for 20 days. All right, 44 point, this is the interest. Chalo, now see, calculation is same, logic is same. If the supplier, okay, if the supplier is able to use these funds for 20 days, right, and it is the effective interest rate for him, okay, then exactly that is the effective cost for the, because it doesn't change, the cost doesn't change whether it is for supplier or whether it is for the buyer. Okay, if we are the customer, okay, if we give away this cost, see, this is away. If the supplier gets this money for 1.2 percentage and is able to use it for 20 days, for him the effective interest cost is 44 percentage. Okay, banks are giving loan for 10 percentage, but if we give away this, okay, if we see, if we grab this, right, it is a benefit for us. If we give away this as a customer, if we give away this discount, we lost this opportunity over here, right? Supplier was get like paying over here an interest of 44 percentage. If supplier is paying 44 percentage, would you get the benefit or not? If someone is paying, someone is getting the benefit, right? Yes or no?
Yes.
Yes,
Chalo.
sir.
So over here,
But sir,
calculate
the
the annual.
question mentioned that we refused the discount, right?
Yeah. Refuse. That is the cost of refusing the discounting. Annual effective cost is 44.6% of refusing the discounting. Right? If we would have taken the discount, this would have been the cost to the, this would have been the cost to the supplier. Right? If we would have taken the discount, this would have been, so if it is a cost for him, it is indirectly beneficial to us. Now let us read the explanation over here. If a company receives an invoice of 100,000 and decides to pay after 30 days, it will lose 2% discount. If you refuse, then that is the cost for you. Okay. This is an equivalent compound rate of 44.6%. This should be compared with the cost of financing working capital. If it exceeds the cost of financing working capital, refusing the discount is expensive and the discount should be accepted. Trade credit can be costly from an financing when a cash discount is offered but refused. However, the cost of trade credit decreases. Okay, chalo. I'm repeating this again. It's not explained very well over there. If right now think from the perspective of the supplier. If I am the supplier, if I am giving this discount, okay, if I am giving this discount, okay, this is the cost to me. Cost to supplier. If it is executed, okay, if it is taken, if the discount is taken, right? If the discount is not taken, Okay, cost to refuse the discount. If the discount is not taken, then who is suffering over here? Customer. Then it will be a cost to the customer. If it is taken, then it will be cost to the supplier. If it is not taken, then it will be cost to the customer. Okay. If you're not taking the discount, and if you are still like you're thinking that you are using the funds of the supplier, you're not. If you would have taken the discount, okay, this would have been a cost to the supplier, but since you have not taken the discount, this is a cost to you. Getting it clear?
Sir, everything else remaining the same, what would it be if it was accepted? Like, what
If
was
it
the
was
cost of accepting the discount?
if it is
Benefit of
accepted, it is not a cost to the customer.
benefit.
Okay. Yeah, it is a benefit to the customer, because kind of just look at the interest that he has received. Customer has received the interest, na? Indirectly he has received the interest over here. Whatever 2% is the interest that he has received, right? He's got the discount. If he's taking the discount, he's got the discount over here, and this 2% over here, he will be what is the amount he has to pay? 98%. He will be paying 98%. That 98% he can easily sponsor through the bank, and that the rate of interest over there is 10% only. And that 10% multiplied by whatever is the number of days, 20 divided by 365, what is the cost to him? Very negligible, against which he is getting a discount of 2%. Are you getting the point? What is the cost over here? 10 multiplied by 20 divided by 365. The customer is getting a, what have I done over here? 10 percentage, man, 10 percentage, that would be 0.55. That is the cost of this financing. Okay, I'm getting 2% off over here, and whatever amount I have to fund, I have to fund just 0.55 at a cost of 0.55%. So as a customer, I should be taking the discount, right? It
So, sir,
becomes
either
very
of the cases, if the question
hmm.
says key, what would be the benefit of taking the discount? We would do the same calculation.
Yeah, see, if amounts are mentioned, it will be very simple for you. Okay, if you will just after this session just do this question, this question would look very
I got this
simple.
one.
Yeah, if
I get
amounts are
confused with the
not mentioned, there you will face the problem. So the problem is that if you refuse the discount, what is the cost? So this that you are calculating, okay, it is the effective interest rate if it is the cost if the discount is taken. First of all, think from the perspective of the supplier. I am the supplier. If I am giving this discount, okay, this is the effective annual interest rate cost for me. Now, whatever is the
Yes.
cost for the supplier, that is the cost for the customer if the discount is not taken. As simple as that. Clear?
Yes, but a lot of questions mention key. What is the benefit of taking the discount? What is the
That is the benefit of taking the discount. If you are taking the discount, you are getting 2% of interest, right? You are saving 2% over here. So that is the benefit of taking the discount. And now, if they are asking net benefit, then you can say 2% minus whatever is the effective interest rate, 2.04 minus 0.55. This is the benefit you have received. Okay, you have received the discount. You are paying just 98.5, 98 rupees over 98% over here. So the net benefit is this to you right now within 20 days.
Can you repeat it again? This
See,
part.
if I pay early, what will I get? I will get discount, 2%
Yeah.
discount. Yeah. So that 2% effective interest rate is like 2.04% over here. Okay. That is the benefit that I've got. What is the
Okay.
cost of
Yes.
paying early? Cost of paying early is 0.55. Net benefit is this. Clear?
How did we get this?
Which one?
1.5.
0.5?
Yeah, 0.5.
0.5 is nothing. 10% multiplied by 20 divided by 365. That is the cost. Because if I pay early, I have to fund this. through a loan. Earlier, the supplier was giving me the
This
credit
is
till
the
30
amount
days.
you have assumed for loan, yeah? This
No, it is
10% was
given in
the
the
assumed.
question. Okay, in
Okay,
this question, it
okay.
is not there. Okay, okay. Yeah, here it somewhere I read 10%. I just taken like 10%. If the cost is 10%, in that case, it would have been this. Clear?
Got got it.
Chalo. Lakshita, you are clear with this settlement discount?
Yes, sir.
Perfect. Chalo.
10% into, can you just show that calculation once?
10% into
20 by 365. Okay.
yeah, yeah. Chalo. So now we are done with the early settlement discount part, and with this, one major chunk of this chapter is over. Okay, and coming, okay, then accounts payable, there is just theory part. Other than that, this is something that we have already discussed. Accounts payable
So
also. Yes, Neha,
there's also first example in the suppliers part,
this one.
like the accounts payable part. Yeah,
Okay, so you want me to do this?
yeah.
This is simple. Chalo, is the cash discount beneficial to Alanis? Purchase 5,000 goods. Let me just have the pen. Celine offers all customers the option of either 30 days credit or 1.5% discount if the cash is received in 5 days. If Alanis takes the cash discount, she will incur an overdraft on which interest is charges 20% per annum. Is the cash discount beneficial to Alanis? Okay. Again, the same thing without taking the amounts in picture. Okay, we will directly do this. Discount rate over here. Discount rate over here is 1.5% discount. Okay. What is the days? What are the days for which the funds will be available to be used by the supplier? Okay, supplier will be able to use the funds if the early payment is made. If the 5 days within 5 days, so generally it is paid either 30 days. No, no, yeah, either 30 days. Chalo. So 25 days will be the time period for which the supplier will be able to use the funds, right? So over here, uh, what will happen, what will be the effective interest, first of all, effective discount rate is, or I can say the interest rate over here is this divided by 98.5 percentage. All right, so this is the effective discount rate, which is 1.52 percentage. Now I will calculate the effective annual interest rate. It will be 1 plus this raised to 365 divided by 25. So if and minus 1, if the supplier gives this discount, the and if the discount is accepted, then this is the cost of this interest discount rate to the supplier. Okay, if this is accepted, then this is a cost to the supplier. Accepted, cost to the supplier.
So how did we find the effective discount rate?
That
The
is just
the
the
one
amount
point.
that we are receiving. 98.5% is the amount that we are receiving. Whatever is the discount rate divided by the amount that we are receiving.
Okay.
Okay. Accepted, then that will be the cost to the supplier. If it is rejected, if the discount is rejected, then it is the cost to the customer. Okay, this should be as simple as that. 24.69% is the cost to the customer if the discount is rejected. Now go back to the question and just see, incur an overdraft on which the interest is charged at 20% a year. If the interest on overdraft, okay, interest on overdraft is 20% and cost to reject is 24.69%, what you should do? If you should you reject it? The answer is no, right? If you will reject this, you will suffer a cost of 24.69%. So it is better you accept the discount, because if you will accept the discount, you will have to pay the interest at the rate of 20%. Right? You will have to, because you have to pay early. If the customer pays early, in that case, he will have to arrange the funds, and that interest will be charged at 20%. Okay. And if he pays early, right? In that case, he is getting a discount which is worth 24.69%. Indirectly, he is getting this much interest over here. Getting it, Sneha?
Yes, sir. Clear now.
Okay. If let us say this rate would have been coming, let us say 19.89 percentage. Okay. In that 19 point, let us say 39 percentage. Let us have a good gap. And your bank is charging 20 percentage. If you take the discount, if you accept the discount, okay, this is the benefit that you are getting. Okay, 19.39% is the benefit that you are getting, and against which, just assume that this is the interest that you are earning as a customer. If you accept this is the interest that you are earning and this is the interest that you are paying, then in that case we will reject it, because the cost, this is the uh, getting it. Are you getting the point over here?
Yes, sir.
Perfect. Chalo. So with this chapter is over, and now, as per the tradition, we will have a break of 5 minutes or maybe 10 minutes, 5:50 it is. So let us begin. Now we are starting with chapter number 17, the last part of our syllabus. All right. So risk management. Now, basically, this chapter is focusing, the entire chapter is talking about two types of risks. Okay, we have, as a financial manager, we have to take care of different types of risks. But over here in our syllabus, the risks that we have to manage, the risk management that we have to do is one for the Forex risk, okay, foreign exchange transactions risk, and another one is the interest rate risk. Now, the beauty is that they both are interconnected to each other. Okay. So, but definitely we will be studying them individually. And what is the relationship between them? We will understand through four-way equivalence model. Okay. Four-way equivalence model tells us the relationship between the foreign exchange and the interest rates. So, first of all, a quick revision about spot exchange rate. What is a spot exchange rate? It is basically the exchange rate for a given two currencies. Okay, the exchange rate between two currencies. And what is forward exchange rate? Forward exchange rate is basically the exchange rate after a certain number of days. Okay, so now the most important part, okay, this is very important for the entire chapter, especially the forex part. Whenever you are provided with a rate, foreign exchange rate, okay, let us say 80 rupees per dollar. For us over here, the dollar is the base currency, and this one rupee is the uh, I can say there are multiple, like, different words we can use, but let me just have a look at the word used in our syllabus, which is variable currency. Okay, you can say variable currency. Okay, base currency, variable currency. All right, so if we are provided with 1.2 pound per dollars, over here dollar will be the base currency, this will be the variable currency, fluctuating currency. Chalo. So first of all, in this chapter, we are going to study the four-way equivalence model. According to this model, the expected difference in the inflation rate in two economies, okay, the expected difference in the inflation rate in two economies is going to affect the spot exchange rate of the two economies, which is given by the formula that the spot rate in the future will be changing. Okay, so you have to multiply the current spot rate by the 1 plus the inflation in the variable currency, and divided by the 1 plus the inflation in the for inflation H is used generally, inflation in the base currency. So that is the formula for purchasing power parity, HC upon HB. HC is used for the variable currency. That is the first relationship. The second relationship in the four-way equivalence model is between the differences in the interest rates, and the spot and the forward exchange rate. So basically, this one says that the forward exchange rate, Right now, whatever is the forward exchange rate, right now, whatever is the forward exchange rate, that forward exchange rate is decided based on the interest. You just multiply the spot rate with 1 plus the I of the variable currency divided by I interest of the base currency. All right. Always remember in these two formulas are almost identical. Over here, we are taking the inflation. Over here, we are taking the inflation in account. Over here, we are taking the interest in account. All right. And over here, we are finding the future spot rate. And over here, we are finding the forward rate. But technically, forward rate is almost equal to the future spot rate. There is one more relationship in the model which says expectations theory. This theory says that the forward rate as on today is more or less the same as the spot rate after whatever is the number of period. Like generally, let us consider 1 year. All right. So that is the third relationship in the model. This was the first, this was the second, this was the third. Now,
So,
talking about the yes, Neha.
certain questions related to IRP,
Hmm.
like can you show the formula that you had wrote on Excel?
Okay. So over here, let me just open IRP, interest rate parity. Over here, the question, just a minute. Yes, will be this one. Spot exchange rate is $1.78 per euro, or sorry, pound. And the dollar and the sterling 1 year interest rate is 3.25 percentage and 4.5 percentage. So what I can say that the forward exchange rate is going to be, what is the spot rate over here? Spot rate is 1.78. So 1.78 is the spot rate. So dollar is the variable currency over here and pound is the base currency. So 1.78, okay, this multiplied by into the bracket 1 plus the interest rate in the a variable currency. So dollar interest rate is 3.25 percentage. So that would be 3.25 percentage divided by into the bracket 1 plus the base rate. Okay, interest rate in the base currency 4.5 percentage. 4.5 percentage. Bracket close, press enter. You got the forward rate for the dollar per pound. Clear with this?
Yes, sir. Yes, sir.
All right.
But my
Okay.
doubt was that if they ask for 6 months rate, like here they've asked for one year forward rate, right?
Hmm.
If they ask for 6 months, then we just divide the 3.25% by 2 and take that amount, right?
Yes, 3.25 divided by 2 and 4.5 divided by 2. 6 months forward rate.
And everything else remains the same in the formula, right?
Spot rate remains the same.
Okay.
Yeah. Chalo. So that is your interest rate parity expectations theory. Okay, purchasing power parity, and last one is the Fisher effect. Fisher effect we have already studied in the chapter where we were studying the nominal interest rate and that other real interest rate. All right. So basically, the nominal interest rate, which is basically the interest rate overall in the economy at which the everyone is giving loans and taking deposits, is equal to whatever is the real interest rate, the actual expectations of the investors, actual expectation from the economy, that this is how much the economy should be generating, but that has to be multiplied by 1 plus the inflation rate. This is known as the uh, Fisher's effect. Okay, so over here you see inflation is connected with the interest rate, right? As a result, we can say that since inflation and spot exchange rate are connected, we can say the interest rate and the spot exchange rate are also connected, and this is known as international Fisher effect. International Fisher effect. So let us directly jump into the international Fisher effect. And the international Fisher effect says over here, yeah. International Fisher's effect says, according to International Fisher effect, the spot exchange rate will change to offset nominal interest rate differences between the countries. See, calculations are same for the interest rate parity theory. So over here, whatever is the, if I go back to this, so this theory says that not only the inflation rate, but spot exchange rate will take care of the nominal interest rate. So same thing is done by the forward exchange rate. So forward and the spot both are, as we have already discussed, are same only, and both of them are going to take care of the nominal interest rate. Chalo, clear till here? Any questions, guys, so far? Shall I move forward? Now we need to understand about this arbitrage. Okay, let me see if I have that example ready over here. Otherwise, we will create a new one. Chapter number 17. Chapter number 17. Chalo, this example, I'm bringing the sheet on our file. So this is a nice example which says that, let us say interest rate parity doesn't hold true. Okay, if the interest rate parity is not there, spot exchange rate and forward rate. Right now there is forward rate is found out using the interest rate parity. If the interest rate parity doesn't hold true, let us say the forward exchange rate is slightly different. Let us say it is 1.76. Okay, so over here, okay, let me just make it 1.7, 1.8980. Over here, interest rate provided in UK interest rate in UK is 4.5 and interest rate in USA is 3.5. Since the interest rate between the two currencies is different, what I can do is I can borrow in USA because it is cheaper over here, right? Fund is cheaper over here, finance is cheaper over here. So I'll borrow in US, and what I will do is I will invest in UK. Okay, from US to UK, I will borrow, and then I will invest that money in UK. Now, what I will do is, I know that my money will return back in, let us say, 3 months, 6 months, 7 months, 8 months, whatever is the time frame for which I have invested. Let us say I have invested for 6 months. So after 6 months, I will be getting my money back, right? And what I will do is that I know that I will be getting my money back after 6 months. But right now, what I will do is I will borrow. I will book a forward contract at F0, right? F0 is slightly different over here, and I am able to book a contract, and I am able to use this arbitrage opportunity over here, right? We are not going into exact numbers right now, but I'm just showing you this example that in US, if I would have invested, I would have got a interest of 3,500. But since I have invested in UK and I have again converted it back to the US dollars, okay, I had booked a forward contract for the return on the investments, and I am able to make an extra profit over here of 2174. Right? If the interest rate parity does not hold true, there is an arbitrage opportunity. People will borrow from the country with the lower interest rate and will invest in the country with the higher interest rate. But because the interest rate and the this foreign exchange rates are interconnected, as a result, nobody is able to utilize this. It is erasing this. So I don't know why it's not happening. What will happen over here? I can calculate the forward exchange rate, spot rate multiplied by the country in the 1 plus the interest rate in the variable currency, which is 3.5, divided by 1 plus the currency in the base. So that is the forward exchange rate. Now, since this is the forward exchange rate, now you see I'm not able to earn extra. If I will book the forward contract, ultimately my profit will be 3,500 only. And if I would have invested in US, then also my profit would have been 3.5 only. Overall, there is no arbitrage opportunity. That is something that you need to remember from this. This is an important theory, that because of the interest rate parity, nobody can have an arbitrage opportunity. If there is an arbitrage opportunity, right? Everybody will be buying the forward contracts, and because of the demand and supply shift over here of the forward contracts, it will come back to this rate. As a result, the arbitrage opportunity will be again gone. Chalo. So Fisher effect we have seen, international Fisher effect we have seen, expected theory we have understood. Now balance of payment effects on the exchange rate. Yes, I was waiting for this. Balance of payment, current account, capital account. Chalo. So let us understand this. Okay. So what happens is, when I over here, let me create an, yeah, this one is for 17. Now we are going to talk about balance of payment. Chalo, are you guys with me? Yes or no? I need to know.
Yes, sir.
Balance of payment. All right, chalo. So let us say we in India, okay, are importing, let us say, something from USA, and our imports are, let us say, $50 million, $50 million, and against which our exports are, let us say, $30 million. Okay, $30 million. So this is our export, this is our import. Okay, if our import is higher than our export, then there is a trade deficit. This situation is known as a trade deficit. If import is greater than export, then this is known as trade deficit. Should use another pen. This is known as trade deficit. And if vice versa, export is greater than import, then that is known as a trade surplus. Trade surplus. Now, whatever is the amount of trade deficit or trade surplus, okay, whatever is the amount of trade deficit or trade surplus, that amount should be set off by the capital account. This is known as a current account transaction. This is known as a current account transaction. Okay, import and export deficiency and whatever it is being created, this is known as current account transaction. This has to be balanced by an equivalent amount by the capital account. So in the capital account, what we are going to do, in the capital account, we are going to, in India, we are going to, so over here what is happening, we are importing goods worth this, but what's happening, when I am importing, my dollars are going out. Okay, my payment of $50 million is happening from India. $15 million worth of currency, foreign currency is going out, and what is coming in, 30 million worth of currency is coming in India, foreign currency is coming in India. As a result, since the outflow of the foreign currency is higher, we need a higher inflow of the currency. And in order to have higher inflow of the currency, we are going to borrow over here. And how much are we going to borrow? We are going to borrow net $20 million. Or let us say we are investing somewhere else. Okay, let us say we have some deal with some other developing countries, and over here, let us say we are investing $100 million in some another currency, in another country. Then in that case, we have to borrow. Over here, we need to cover a deficit of $20 million. So in that case, we need to borrow a amount of $120 million so that we can eradicate this difference of $20 million. We need to borrow $20 million extra from whatever is our investment or whatever kind of capital outflow is there. This is known as capital account. This account always needs to take care of this current account. Otherwise, what will happen? The reserve, the foreign currency reserve in a country will change, and as a result, the country's currency will not remain stable. Okay, as I have already told you that, let us say right now 80 rupees per dollar is the price of a single dollar. If this becomes, let us say, 70 rupees per dollar, over here earlier you were able to buy a single dollar for 80 rupees, now you are able to buy a single dollar for 70 rupees. So rupee has become stronger and dollar has become weaker over here. But that doesn't mean that as uh, an Indian, you should always wish that your currency becomes stronger. Any haphazard change in a currency is not acceptable. Like, it is not advisory, it is not fruitful for that company. Okay, why, we are going to discuss in a while. But I hope you guys understood this. Trade current account has to be set off by the capital account. Clear with this? Chalo, yes or no, quickly.
Yes, sir.
Quickly. Perfect. Now we are going to discuss about foreign currency. So, current account, capital account, we have discussed. A rise in the value of a nation currency. Now we have to focus on this. See, if you are not maintaining it, okay, then either the value of your currency can fall or the value of your currency can rise. If the value of a currency rises, the rise in the value of a nation's currency makes its exports less competitive, makes its exports less competitive. So over here, when, let us say, Indian rupee becomes stronger, earlier if someone was exporting something, let us say there was this person from US, okay, and he was buying something from India, and this particular item was costing him 80,000 rupees. Okay, this is the cost of that particular item. All right, how much he had to pay? He had to pay $1,000 for this particular item because it was costing him, this is the price of that particular item, 80,000 rupees. So earlier he had to pay $1,000, but now since the price of a dollar in India, right, Indian currency has become stronger over here, how much will he need to pay now? He will need to pay 80,000, which is the price of that particular item, divided by 70. He will need to pay $114 over here. Earlier he used to pay only $1,000. As a result, what will happen? The exports will decrease. Exports will decrease. So I'm trying to create a chart over here. All right, now what you need to do is, you need to focus that when I'm just using Indian rupee, currency increases, Indian rupee becomes stronger. What will happen? Exports, exports will become, uh, like, exports will decrease. If the exports will decrease, what will happen? Okay, if in a country exports decreases, what will happen? Trade deficit, trade deficit, export will become lesser as compared to import. As a result, trade deficit would happen. As a result, it will result into trade deficit, trade deficit. Okay, now when the trade deficit is going to happen, okay, when the trade deficit is going to happen, what will happen? Our currency will fall. Our currency, domestic currency, okay, will fall. Domestic currency will fall. Once the domestic currency falls, okay, once the domestic currency falls, what will happen? Again, the exports will increase. Exports will increase. Exports will increase. Okay, and once the exports increases, what it will result into? It will result into, can anyone tell me?
It will result into the currency rate increasing. I mean, the value
Yeah,
of the rupee
increasing.
increasing.
Yeah, but there is going to be something like exports decreases, trade deficit, exports increases, it will result into trade
Trade surplus.
surplus. Yes. So once there is a trade surplus, our rupee will again become stronger. Now you see, now it will become very easy to understand all these lines. Rise in the value of a currency, nation's currency makes it exports less competitive. Rise in the currency, exports less competitive. Okay, and imports cheaper. Okay, I am going to add this, that exports will decrease and imports will increase over here. Imports will increase over here. Okay, and when your imports are higher than your exports, when your imports are higher than your exports, it is going to result into trade deficit over here. So it is going to result into trade deficit. Okay, with these effects tending to correct a current account surplus. You had a surplus, as a result your exports, as a result your rupee become stronger. There was a surplus because of which your rupee becomes stronger. Now because of that your exports is going to decrease and your imports is going to increase, and as a result again there is going to be trade deficit. Over the period of time it is going to keep on balancing itself. Okay, now read the other line. A fall in the value of a nation's currency, fall in the value of a nation's currency starting from here, okay, will makes its imports more expensive. Imports more expensive. Now it will be very difficult for you to import in this country because now imports are very expensive. As a result, what will happen? The imports will decrease. Imports will decrease and the exports will increase, and the increases competitiveness of the exports, and so helps to correct a deficit. As a result, there was a deficit because of which the rupee decreased, and as a result the exports has increased, imports has decreased, and it has resulted into trade surplus. So this is a cycle. If you remember this graph, you will be easily able to tackle any questions related to balance of payment, deficit, surplus, any kind of twisted question from this. What you need to do is just click a photograph of this, read this after the session like 2 3 times, just go through this, just read the lines again and again, and then you will be very good to go with this. Let me know once you guys are ready. Okay, when we can move forward once you click the photograph.
So can you show the text material again one more time? Yes, sir.
Done. Lakshita, you are done.
Yes, sir.
Perfect. Now let us read the further lines. Now everything is going to be very smooth. Exchange rates tend to change in the direction which will restore balance. When a country exports more than it imports, when a country exports more than it imports, okay, the demand for its currency will tend to increase. The extra demand tends to cause a rise in the currency's price relative to others. Okay, so the demand is increased because of the trade surplus, and as a result the rupee is going to increase. When a country imports more than it exports, the supply of its currency on the international market tends to increase. Okay, when you imports more than it exports, okay, the supply decreases, trade deficit is there as it tries to exchange for foreign currency to pay its imports. This extra supply tends to cause the price to fall. That will result in a fall of the currency. So that is the relationship of the balance of payment and foreign currency. Now, exchange rate risk. What are the different exchange rate risk? One is the translation risk. Translation is risk is basically we are talking about the closing interest rate. If someone has invested in some another current country, at the end of the year, when you like, even though you have not actually made any profit or loss, but there is going to be a translation risk, right? And when you will consolidate your financial statements, you will be showing the translation risk over here. So that is the translation risk. Economic risk is basically a single economic risk will come back again, but before that, transaction is a single transaction risk. If I have imported something in the USA and I'm waiting for the payment is going to come after 3 months, but if before that, if the interest rate changes, I'm going to suffer losses. So that is a transaction risk, single transaction. And now if the rate keeps on increasing day by day, it is going to cause me economic risk. Economic risk means it is going to hamper the entire economy. I'm not going to have a sustainable business over here. right? I was worried about a single transaction, but what if the rate keeps on increasing and over the period of time, I cannot export anymore? Okay, the importers who were importing from me, now they're importing from China because our country is appreciating. So these are the three major risks for the currency. Now, just look at this translation risk. Okay, how can we hedge the translation risk? There are hedging techniques for the translation risk. Okay, we will have an entire discussion on the hedging techniques, internal technique. Okay, we will have an entire discussion on the hedging techniques, on the translation risk, and all those things. But translation risk is still simple. Point is, economic risk is something that cannot be long term exchange rate, like it is the risk because of the long term exchange rate. Okay, this is not something which cannot be which can be hedged through the hedging techniques. Okay, we cannot hedge the economic risk, but we can do hedge the transaction risk because it is a single transaction. So we can hedge the transaction risk through internal or external hedging techniques, but we cannot hedge the economic risk. Now, moving on over here, what are the currency risk management, foreign currency risk management techniques? Internal techniques, invoicing in the company's domestic currency, right? If I raise the invoice as 80,000 rupees, I am not worried whether the exchange rate changes or not. Whosoever is importing from me, he will be worried to make the payment of 80,000 rupees, right? He has to arrange the dollars. So I am not worried over here. Invoicing in the domestic currency. Leading and lagging. Leading means paying early. Leading means paying early. Right? I have to make a payment of, let us say, $5 million after 3 months. So what I will do, I will make the payment right now immediately. I'm worried that the rate will change in the future. So that is leading. Lagging is paying late. Okay, paying late. Now paying late is not a effective way of hedging, because let us say I had to pay someone and 3 months are over and I'm still not paying him, right? I am worried. Like right now the rate has increased and I'm thinking that if I keep on delaying this payment, the rate will decrease over the period of time. That is what is I am assuming. But what will happen? What if the rate actually increases? Okay, I was waiting for the rate to decrease, but what if in this case the rate actually increases? So this is not hedging. You are speculating over here. So lagging is not an effective way of hedging. It is just given over here, but it is written over here. Although taking longer than the agreed credit period is questionable business practice. That is also another risk. Okay, and here is the note. Only leading will reduce exposure to risk. Lagging does not mitigate the risk, as if domestic currency depreciates, the cost of settling foreign currency liability will increase. Cannot be delayed indefinitely. Right? Next one is netting. Netting means if you have creditors and debtors, okay, both the things in the foreign currency, you can ask them to pay each other, all right? Or maybe you will, like they will be paying close to each other. As a result, you will be able to set off the transaction. So that is like netting. You just have to arrange the funds for the net exposure, what you have in that currency. Next one is matching of assets and liabilities. Now, matching of assets and liabilities and asset and liability management, these two are mostly confused with, like students are confused between the two. So, we are talking about internal hedging techniques. Okay. In that, now I am going to talking about matching of assets and liabilities. Basically what I am going to do, I am someone who is investing in some another currency. Let us say I am over here in India, I am the parent company, and I am investing in, let us say, Bangladesh, which is my subsidiary company. Chalo, over here I have a subsidiary company in Bangladesh. Okay, so I don't know what is the currency of, chalo, let it be. So what will happen? Anyone knows what is the currency of Bangladesh? I think that is also rupee only. They also called rupiah only. Let it be. Chalo, I am assuming that the parent company is in US. Okay, parent company is in US.
Takas.
So it
Sorry,
is,
TA.
yeah, Bangladeshi Taka.
Taka.
Yeah.
Nice, Taka. Okay, India, and India is a subsidiary company. Okay, so if the parent over here is investing in India, parent over here is investing in India, he will show in his books, assets, okay, investments of whatever is the amount. Let us say he is invested $1,000, and against which, let us say he has got 80,000 rupees. So I can show share capital of 80,000 rupees in this books. So matching of asset and liability says that what we are going to do when we are investing in India, we are going to borrow a loan from India. The parent will borrow a loan from India, and he will borrow exactly of 80,000 rupees. As a result, he will show a loan of $1,000 in his books of accounts. Okay. Now what happens if the rate changes is, let us say, the Indian rupee becomes stronger. If the Indian rupee becomes stronger, he's going to make a profit. He's going to make a loss over here. Loss or profit, I don't know. We have to calculate that. But whatever it is, if he makes a profit over here, right, that is going to be a loss over here. If he makes a loss over here, that is going to be a profit over here, because one is liability, one is asset, right? So this is known as matching of asset and liability. He will go to an Indian currency, like he will go to an Indian bank, and the parent is going to borrow the funds over here. The parent is going to borrow the funds over here on his own name. The funds will be borrowed by the parents. That is known as matching of assets and liabilities. The next technique, which generally is confused with this, is the asset and liability management. I think that is the name, right? Names are almost same. Matching of assets and liabilities,
Yes.
asset and liability management. Sorry.
Can you explain the
So
previous one time, sir?
over here, see the parent, the US company, they are investing in India. Okay. So they are going to show this $1,000 as an investment in their books of accounts, in their on the asset side, and they are going to borrow funds from India. This Indian bank is going to give the loan to the parent itself, and over here they will show a liability in their balance sheet as well. Clear? Hello?
So the asset is the subsidiary, right?
Yeah. Subsidiary is its asset.
Okay.
Okay. Now, asset and liability management. Over here, what the parent company is going to do, the parent over here in the USA, what he will do, he will invest very small amount. Instead of putting the entire $1,000, he will invest, let us say, $100. Okay. So the subsidiary, let us say the subsidiary needed a fund, subsidiary in India needed a fund of, let us say, capital of 80,000. Okay, same capital. But right now it will receive only 8,000 from the parent. Okay, 8,000 rupees from the parent. And the parent will ask the Indian subsidiary to go to the Indian bank. Okay, any Indian bank, ICICI, HDFC, SBI, and they will say that borrow a loan over there in Indian rupees. You yourself borrow the loan. So parent can be doing the backing and everything, but this subsidiary will be financed by the Indian bank. Indian bank will be giving the loan to the subsidiary itself. As a result, it will get its 80,000, and the exposure that the parent is having in the foreign currency right now is reduced from $1,000 to just $100. Okay, this is known as asset and liability management. This was your matching of asset and liability. You are trying to match in your balance sheet the asset and the liability side. Okay, over here you are managing the asset and the liability. All right. Now, one more thing, matching of receipts and payments. All right, whatever receipts you are having in the foreign currency, try to have it as close as to the payments. Okay, this is slightly different as netting. Netting, we are asking them to do the set off. Okay, they pay each other. This one over here, we will receive receipt, we will receive the payments, we will put it in our bank, but within a small amount of time, we'll be paying it to someone else, right? So over here, matching of receipts and payments. You are again over here exposed to the net exposure only. So these are the internal techniques. Any questions so far? All right, chalo. So now let us move forward to the external techniques. Okay, now we have these many external techniques which the students are generally afraid of. Forward exchange rate. Okay, forward exchange rate, money market hedges, currency options, currency futures, currency contracts, and currency swaps. So let us discuss them one by one. But in your exam, you are not going to be examined. You just have to have the knowledge of this and this for practical calculations. You just have to have a theory knowledge for these three concepts. Okay, practical questions can be coming from these two areas only. So first of all, forward exchange contract. Forward exchange contract are very simple. Let me see if there is an example directly. Let us directly take this example. So today is 1st January 2021. A UK-based company expects to receive a dividend income of 200,000 from its US subsidiary on 31st March 2021. Spot exchange rate is available to us and 3 months forward rate is available to us. Now forward rate is basically a fixed rate. Okay. Right now, whatever is the rate in the spot market, but after 3 months, if you are going to receive the money, you can book this exchange rate for yourself. Okay, that is basically the forward exchange rate, right? You don't have to worry about what is the actual rate on the future. In the future, on 31st March, this is the actual interest, this is the actual exchange rate. But now, since you have agreed with the bank or whatsoever is the financial institution, right, you have fixed this particular rate for yourself, you have to undertake the transaction at this rate. No matter what happens, you have to complete the transaction. If you have entered into a transaction that I will be giving you the dollars, then you have to give them the dollars, even if, let us say, your actual contract is cancelled, the supplier has not made the payment, and in that case you will have to buy the dollars from the open market and give it to the bank. Okay, so over here we are supposed to calculate how much sterling will be received if a forward contract is entered into. Okay, and how much sterling would be received if without a forward contract, if the actual spot rate on 31st March is this. So over here what will happen, see, I'm giving you the simplest, easiest trick, but this is something you have to repeat for like 3-4 times. Okay, then you will be able to remember how to tackle the foreign exchange questions. So let us find out what should be the amount that we are going to receive. We are a UK based company. Currency, home currency is UK pound, and we are going to receive $200,000 from the subsidiary on 31st March. Let us try to convert at the spot rate first of all. So first of all, what is your home currency? Your home currency is GBP, or I can say pound. Okay, so GBP. All right, so let me just do this in the Excel instead of doing it. Question number 3. So over here, what is the home currency? Home currency is GBP. GBP. And what are we going to receive? Like, do we have to make a payment or do we have to receive? So if we are going to receive the dollars, we are going to sell the dollars. All right. If, let us say, we have to make the payment of dollars, okay, if we have to make the payment of dollars in the future or right now or whatever, then in that case we would have to buy the dollars. Right now we are going to receive the dollars in the future, which means we will be selling those dollars and we will be buying the home currency, which is GBP. Okay, now over here, what is the spot rate after 3 months? Spot 1, which is given to us, is this 1.5247 dash 1.5361. 1.5247 dash 1.5367. Okay, 5247 5361 61, it should be 61. 5247 1.5361. This is the spot rate. Now this spot rate is dollar per GBP, right? Or is it otherwise? It is dollar per pound. You see, dollar per pound. Okay, now what you need to do is just create this base. Okay, every time, just every time you have a transaction related to foreign exchange, just create this base kind of a chart or something. And what you need to do is, what is the base currency over here? What is the base currency over here? GBP is the base currency. Just write GBP. Whatever is the base currency, just write that first. Okay. Now think about, what do you have to do with the base currency? You have to buy the base currency. You have to buy the base currency. Okay. Now, if I want to buy 1 GBP, if I want to buy 1 GBP, I have to sell some dollars. Now, this rate is always not in our favor. It is always in the favor of the bank. Okay. So if I have to buy the GBP, do I need to pay more or do I need to pay less? If it is unfavorable to me, okay, I need to pay more. Which of the two rates will I be paying more dollars? Which one is the higher one? This one? Yes or no?
Yes.
Chalo. So if this one is the higher rate, right?
So,
And if I have,
uh,
yes, Lakshita.
no, I didn't understand what were you asking.
Yeah, I was saying, which of the two is higher?
Like in spot rate, for the spot rate, or the currency you are asking.
No, this numbers. Which of the two of these numbers is higher? This
Ah,
and
okay,
this.
okay. Yeah. Okay. Yeah.
All right. So if you are buying the GBP, okay, you you are buying the GBP, you will be giving the dollars. If you are giving to the bank, you have to give more. If you are receiving from the bank, you will be receiving less. Okay. So over here you are buying GBP and giving dollars. So if you are giving dollars, you have to give more. So you have to give more. You have to give this one. So if you have to buy 1 GBP, you have to give $5.361. Now, how many dollars are you going to receive? You are going to receive dollar 200,000. Okay. So when you will receive 200,000, when you will be giving $200,000, how many GBPs are you going to receive? As simple as that. $200,000 divided by 1.5361, cross multiplication, nothing else. So that will make your life very easy over here. Then this is something which you can do in a rough paper. And then over here directly on the Excel, you can say that since we are going to receive the dollars, the GBP that we are going to get, it will be this divided by 1.5361. Okay, you don't need to give an explanation why you pick up this rate or why you pick up that rate. If you want to give, you can write a small line that this is the ask rate for the, this is the selling rate, this is the buying rate for GBP. Let it be. There are chances that you can make mistake in that. So what you need to do right now, you just have to do the cross multiplication and press enter. Okay. So the GBP over here that you are going to receive will be this much. Okay. In this particular case, let me just make it like I also need to have conformity. Okay. So 130, 200 at the spot rate in the future. Okay. Now let us do this again. I'm repeating the entire process at the forward rate as on today. Forward rate as on today is 1.53, 1.5123, 1.5245. Chalo, I'm repeating the forward rate. 1.5123 and 1.5245. Okay. This rate again is your dollar per GBP, dollar per GBP. So again the same story, I'm repeating it again. Please focus 100%. Okay, tomorrow there can be a question related to foreign exchange. So whenever you have to, what do we have to do with the base currency over? First of all, write the base currency as it is in a rough paper. GBP. What do we have to do with the GBP? We have to buy GBP. We have to buy GBP. So if I have to buy GBP, I'll just write 1 over here. What I need to give is I need to give dollars. If I'm buying the GBP, just look at these two rates. Okay. If I have to give to the bank, I need to give more. I have to give the variable currency. Whatever is in the numerator, I have to give that. If I'm buying, I have to give. If I'm giving, I have to give more to the bank. So over here, this is the rate that I will be giving, 1.525. So 1.5245. This is something that I will be giving the bank, and against which now I will be receiving $200,000. So if I give $200,000, how many GBPs will I get from the bank? As simple as that. The GBP that you are going to receive, don't write GBP in exam, okay? I'm just telling you that this is the GBP that you will be receiving. You can write the uh, proceeds after amount after translating it to GBP or something like that. There is no strict rule of what you can write in exam unless your numbers are correct. Chalo, 131, 190, 131. Oh, have I made a mistake? Oh, I took these rates. I took forward rates instead, spot rates instead of forward rates. So 1.5323, 1.5459, 1.5323, 1.5459, 5459. Okay, and over here I will do 1.5459. Chalo, 123, 123, 129,374. Clear, guys? Yes or no? Want to try one question on your own?
No, sir, it's clear.
Okay. Chalo, so let us move forward. Now money market hedge, as simple. I'm just explaining the structure over here. I'm not going to do the sum because it is, chalo, we can do this. This one is a small sum. We can do it this very quickly, and it will just, we can revise the entire money market hedge very quickly. So it is a revision of money market hedge. Money market hedge. So money market hedge, you are going to, what is the question over here? A UK based company expects to receive 300,000 in 3 months. So home currency is UK. What we are going to do? We are going to receive 300,000 in 3 months. 300,000 in 3 months. So whenever you are going to receive in money market hedge, what you need to do is whatever is going to happen in the future, make that happen right now. Okay, make that happen right now. So if you are going to receive in the future, receive right now. In order to receive right now, what you need to do is you need to borrow right now. Okay, so what you are going to do, you are going to borrow dollars right now. You are going to borrow dollars right now. How much? We will figure out. Okay, spot rate is this as on today. 1 year sterling interest rate is 4.9 percentage borrowing. 1 year sterling, this one is 4.6. Investing is this, borrowing is this. Dollars borrowing rate, investing rate. Set up a money market hedge. So if you are going to receive dollars in the future, what you need to do is you need to borrow dollars right now. How much dollars do you have to borrow? You have to borrow an amount in such a way that your investment, sorry, your liability, the amount that you are going to borrow should become exactly $300,000. Okay, whatever is this amount, whatever you are going to receive, that your borrowing should become this. If you are investing, right, if you are, let us say you have to make a payment in the future, you have to invest right now. Payment, invest. Okay, in that case you will invest in such a way that your investment will become equivalent to the amount you have to pay. All right, so over here, how much are we going to borrow? What is the borrowing rate in US dollar? Borrowing rate in US dollar is 5.4, 5.4 percentage. Now it is to be done within 3 months. So what we are going to do, $300,000 divided by 1 plus into the bracket 5.4 percentage multiplied by 3 divided by 12, bracket close. Okay, this bracket close. So this is exactly the amount that I am going to borrow as on today. These are the dollars that I am going to borrow as on today. Okay, now in order to borrow this much dollars, what do we need? We need GBP. Okay, so what is the spot rate available to us? Spot rate that is available as on today is 1.7818 dash 1.7822. All right. So over here, what is going to be the how much do I need to borrow over here? Sorry, the GBP that I have to pay over here. Right now, what I have to do, I have to borrow dollar. Sorry, I have to borrow dollars. In order to borrow dollars, I have to once I borrowed. Sorry. I've confused it. Once I will borrow the dollars, what I will do is I will convert it to GBP. Okay, once I will borrow the dollars, I will have the dollars with me. Now, what do I do with these dollars? I will convert them to GBP. Okay, so now in this particular spot rate, what is the base currency? Dollar per pound. So it will be dollar per pound. Now, pound is the base currency and dollar is the variable currency. Again, the same story. 1, and over here the higher amount is this 1.7822. All right, so question mark 1.7822, a question mark over here, and that will tell me that I will. All right, just a minute guys, I have to come in a minute. 1.788. Chalo, this is the I'm coming in a minute guys. All right, guys. So once I have the dollars, I will convert it into GBP. This is how much GBP I will receive. Once I have the GBP, okay, what I will do is with this GBP, I will invest this GBP. What is the investing rate? 1 year sterling investing rate is 4.6. So what I will do is at maturity, I will get this multiplied by 1 plus, what is the interest rate? 4.6. So into the bracket 4.6 percentage multiplied by 3 divided by 12. Any confusion in this? At maturity, this will be the GBP that I will have. All right. And at maturity, what will happen? At maturity, this loan, as we have borrowed it in such a way that it will become $300,000. And once we will receive $300,000, we will repay this entire loan. Once we will receive the payment from the supplier, we will repay this entire loan of $300,000. And at maturity, we will have this much amount with ourselves. Indirectly, we have made a forward exchange rate for ourselves, right? This divided by, I can do like this, $300,000. $300,000 divided by this amount. Indirectly, we have made a forward exchange rate for ourselves of 1.79, whatsoever it is, but it doesn't matter. It is basically it will complicate things, but this is the way we have to create the money market hedge. Please don't forget the investment value at the end of maturity. This is important. Okay, don't say that, sir, this is the GBP that will receive. This is the GBP you will receive, but you have to invest it. All right. So this is the money market hedge. Any doubts in money market hedge, or shall I move forward?
So,
Yes, Neha.
will the question mention that we have to
What?
convert it? Like we have to invest it for 3 months more? Or is it
No,
just for
nothing.
this question?
No, nothing is
The
mentioned, right,
last
over
step.
here. Set up a money
The
market
last
hedge.
step that we are doing.
Okay, this one. Will the question mention it? No, the question is not mentioned in here also. And I would recommend, even if it is not mentioned, do make it, right? The value of the sterling in 3 months deposit, that is the complete step. Okay, don't skip that step. In real life, you are at the discretion of what you want to do with this amount once you have received it. But theoretically, right now, for our syllabus purpose, we are going to assume that you are going to invest it anyhow. Okay.
Okay, sir.
Perfect. Chalo. So now, currency options. Currency option gives us the right but not the obligation to enter into a transaction at a particular rate. I will just go through currency option, currency futures, and currency swaps. Chalo. So currency options, it is give okay. Options, the simplest way, understand this, right? You don't have to do any kind of calculations related to options. It is as simple as that. Now I'm telling you the just like the summary over here, and that will be enough. Okay, options basically is just like an insurance. Okay, okay. Now if you are worried that the rate will increase in the future, then you are going to buy the call option, okay, of a particular currency. That US dollars rate will increase in the future, I will buy the call option for the US dollar. If the rate is going to decrease, okay, you are going to buy the put option. Put option is basically the insurance for a decreasing price. Call option is basically the insurance for a increasing price. So that is basically the call option for you. All right, calculations will not be required. More complex derivatives like options. So this is just useless for you. All right, you just have to, and everything will be like specified quantity, specified currency, specified date, exchange rate, agreed as on today, and everything. Right, the owner of the option, can either exercise the right or allow it to lapse. Right. Similarly, in insurance, okay, if anyone has purchased an accidental insurance, if there is an accident, then and only then they are going to ask for the money, right? If they have actually suffered the loss, then and only then you are going to ask for the money. But if there is no accident, you cannot say the insurance company to give you the claim. Okay, so it's just like that. If you have taken a call option and the prices has increased, you have suffered a loss, then you are going to exercise it. If you have taken a put option, prices have decreased, you have suffered a loss, then you are going to exercise this, and they are going to compensate you for your loss. That is basically the options for you. Now comes the futures contract. Now futures contract is just like the forward contract. Okay, in forward contract, you decided the rate was fixed. Okay, the rate was fixed by the bank for a specified quantity. It was customized, and there was a specific quantity, specific time, specific rate, everything was specified. In the futures contract, what happens is that the contracts are standardized. Okay, that is the difference. You can just fix a particular rate, but over here you need to enter into a standardized contract instead of a customized contract. So you have to buy the number of contracts in such a way that it can match your total whatsoever is the exposure. If the future contract is available for $500 and your exposure is of $5,000, you need to buy 10 contracts over here. Okay, you are not going to have a customized contract with the bank over here. And in futures option, you can
So,
exit.
sir,
Yeah.
in that the price is given by the bank. Here also it is given by the bank only.
No, it is decided by the market over here. Like futures contract are being traded on the stock exchange. Okay, and the price is decided by the demand and supply over here. It is not decided by the bank. Mostly it
And
is
in
going to,
forward,
yeah.
in
Mostly it is going to
forwards,
fluctuate. Sorry, in
in forwards the bank gives the rate, right?
exactly. Banks decide the rates in the forward contract. Over here, the market decides the rate, and over here, the rate is going to move as per the actual spot rate. Okay, whatever is the actual spot rate, and that happens in the forward contract as well. Like mostly, the rate will be moving around the spot rate only, but slightly up and down. All right, so that is your currency futures. Now basically you need margin. All right, your profit and loss is going to be booked on a daily basis. Right, you have to enter into a futures contract, you have to give a margin over here. That, right, let us say you have an initial margin of $100,000, and let us say you have made a loss of 10,000, okay, in a single day. Like it is, the value of your futures contract is decreasing. So if there is a loss, that will be deducted from your margin, and let us say the minimum margin required is, let us say, $25,000. Okay, so they will keep on decreasing the margin, and until, let us say, you have reached to a $25,000, and maybe if it goes beyond that, let us say it becomes $24,000, then the broker will ask you to put extra money in your account, because you need to have a minimum margin in your account. So forward contracts, you are going to have margin accounts are daily settled. It is called as mark to market. Losses and profits are booked on a daily basis. Okay, and you have
Sir,
to keep on add. Yes.
So if we are making losses in this, so how is it hedging then?
No, see, loss you are making in a future contract. Okay, right now price is 80 rupees per dollar. Okay, and let us say I am going to buy this, I am going to receive, let us say, $1,000 in the future. Okay, and I will be selling dollars. So what am I afraid of? The rate going downwards. Okay, rupee becoming stronger, the dollar rate going downwards. So I would enter into a futures contract. If let us say the rate becomes, if let us say the rate becomes, actually it becomes 70. Okay, if actually it becomes 70, I would hedge it in such a way, I would hedge, now I'm not entering into the entire calculation of the transaction. What will happen? Let us say here I have made a loss, notional loss. At the day of this transaction, the price was 80, now the price is 70. So I have made a loss over here of 10, which is 10,000 rupees. Okay, I made a loss of 10,000 rupees. But in the futures contract that I have entered, I will make a profit of 10,000. All right, that will be setting off my loss. Now, opposite is also true. If let us say this becomes 80 to 90, I will make a notional profit of 10,000 over here in real world. Like, this is not a real profit. Earlier the transaction could have been entered into 80, but now the transaction is entered at 90. But since I have booked a rate of 80 over here through the futures contract, okay, so what will happen when the rate becomes 90? I've hedged it in such a way that I will suffer a loss of 10,000 rupees over here. Now, my this profit, notional profit of 10,000 is set off by the loss over here. So you are going to have profit or loss in the futures contract separately, and you are going to have profit or loss in the notional profit or loss in the real world, and they both are going to set off against each other. Clear?
Yes, sir.
Perfect. Now, in futures contract, physical delivery is not going to happen. In forwards contract, there is a physical delivery, right? As I have told you, you have to complete the transaction anyhow. But over here, the transaction can be closed out, which means if you have bought a futures contract, now you can sell a futures contract. If you have sold the futures contract, now you can buy the futures contract. So you can always exit the futures transaction, and there is no guarantee that the basis in the futures. Now, what is basis? Basis is basically the difference between the actual price and the difference between the futures price and the spot exchange rate is known as basis. Okay, if the, let us say, dollar is being traded at 80 rupees in the spot market, dollar would be trading at 80.20 in the futures market. So this difference between the spot price and the futures price is known as basis. This basis is going to become zero in the future. And the expiry of the futures contract, both the prices will be same. So basis will become zero. But how this basis will be decreasing? Right now the basis is, the gap between the two is 0.2. Okay, this will decrease and become zero, but there is no linear relationship, like there is no linear movement of basis. Basis can decrease in this way. Sometimes it will decrease and ultimately it will become zero. But how it will decrease, there's no one knows. So that is known as basis. There is no guarantee that basis in the futures contract will be amortized at a linear rate. Therefore, the result of a futures hedge cannot be known in advance. This is known as basis risk. Sir, what is the knowing the result of the futures hedge? That is trying to predict what will happen in the contract. Okay, that is something that you will be doing in the AFM, not in this syllabus. So that is futures contract. Currency swap. Currency swap, it is very simple. Okay, let us say I am in US and there is someone in UK. In US right now, whatever is like I want UK loan. Okay, for my company, I want a UK loan. If I go in my own country and try to have a UK loan, it is going to be very costly for me. It will be costing me 8%. Whereas if this particular guy, if he goes in his country and if he gets the UK loan, he can get the UK loan for just, let us say, 7%. Okay, or let us say 6%. Okay, and he wants a US loan. If he goes in his country for getting a US loan, let us say they are charging him 10%. But if I go to my country, and if I get a US dollar loan, I can get a US dollar loan at, let us say, 8%. Okay. So what we are going to do, okay, what we are going to do, I'm going to ask him that you borrow the UK dollars, okay, sorry, not UK dollars, but you borrow the GBP over here, And let us say he borrows 500,000 GBP and I borrows equivalent amount of US dollars for him. Let us, right now I'm assuming a ratio of 1:1, rate of 1:1, okay, GBP and dollar equally, so that you can understand better. So I'm going to borrow $500,000 for this particular guy, and I will transfer this $500,000 to him, and he will transfer the 500,000 pounds to me. Okay, as a result, what will happen? He will, I will pay whatever is the interest on this pound to him, and he will pay me the US dollar interest, and I will pay that interest to the bank, and he will pay the interest, UK interest, to the bank. As a result, both of us are able to get a cheaper loan as compared to what we were able to get in the market. This is known as currency swap for the Forex. Clear with this, guys? With this, we are done with all the hedging
So,
techniques for Forex. Yes, Neha?
if we are paying the interest, then how is it hedging? We have to still pay the interest that would move up or down, right?
We are hedging the Forex over here. You are confusing it with the interest rate hedging.
Principal and exchange both, it's written, right? Principal and the
Yeah.
interest of one
Principal,
currency.
we are, see, the loan we are going to exchange. But what are we afraid of? We are afraid of, see, what will happen? We have decided this ratio. Okay, right now this is the ratio. In the future, what happens is over here in when I am in US and I have borrowed a UK loan, all right. Right now, I have borrowed a, let us say, 500,000 GBP of worth of loan. In the future, right now, what is the exchange rate? 1:1. In the future, what if the exchange rate changes? Let us say the exchange rate becomes something like 2:1, means not in our favor, right? In that case, we will be afraid, like we are afraid with this borrowing the GBP. So what we'll do, we will hedge this particular thing by a currency swap, and we both have decided that I will give you the US dollar loan, you give me this loan, this is the rate as on today, and at the future date we will again exchange the capital. Okay, I will give you back your UK dollars, you give it to your UK bank, you give me back my US dollars, and I will give it back to my US bank. And we will, at that point of time also, we will enter into the transaction at the same exchange rate, and all the interests will be exchanged at the same exchange rate. Clear? This is how you are hedging the
Okay,
foreign
so even
exchange
the
risk over here.
interest ka exchange will fix.
Yeah, both will be fixed. Interest ka exchange
Okay,
will be also fixed at this rate only,
okay.
right? And in this way, they are hedging, like they are able to decrease their interest rate also, and they are able to hedge their position also, foreign exchange risk also. Clear?
Yes, sir.
Perfect. Chalo. So with this, we are done with the foreign exchange part. Lakshita, you are clear till here? Any questions?
No, sir, I'm fine.
Perfect. So right now, let me just start with the interest rate risks. Now that is the last part of this chapter in the syllabus, interest rate risk management. So first of all, we need to understand what are the risks actually. Okay, here directly I can see internal techniques. But why don't I see the actual interest rate risks? Yeah, here it is. Interest rate risks. All right. So first of all, if you are someone, let me just bring a nice Excel file which I had created in the last batch. Interest rate risk. Here it is. Just a minute. So I created this small chart in the last batch about the interest rate risk. See, it's very nice that if let us say we are someone, okay, who has borrowed, we are someone who has borrowed at floating interest rate. Okay, if we are someone who has borrowed at floating interest rate, and if now the rate increases, right, since we have borrowed, so we are unhappy about it. But if we would have borrowed at a fixed interest rate, then we would be happy with the increase in the interest rate. Increase means overall increase in the market. Okay, so same goes with the investments. If we would have invested at a floating interest rate, and if the interest rates in the market increases, we would be very happy about it. But if we would have made the investment, okay, if we would have made the investment at a fixed interest rate, right, and the market interest rates are increasing, we would be unhappy about it, right? So this unhappiness is nothing but the risk over here that we are talking about, right? If you are someone who has invested at a fixed interest rate, you are going to have the risk that the interest rate in the market is increasing, but your investments are not increasing at the same rate. Okay, so over here you see, if and over here, if I talk about the decrease, it's vice versa. Okay, I'm not going through the all the scenarios. Now, how do you mitigate this risk? What you could have done over here, that if you are borrowing, at a floating interest rate, you should have done the investments also at the floating interest rate. This is the way you could have created a balanced portfolio. Okay, whatever if borrowings are needed. If you are borrowing, at a fixed interest rate, you could have invested at a fixed interest rate as well. This could have created a balanced portfolio as well. Now, if I talk about only investments, like in order to have a proper balance, what could I have done is, if I have to do only investment, let us say I don't need any kind of borrowings, then some of the borrowings I should have done at floating interest rate, and some of the borrowings I should have done, investments I should have done at fixed interest rates. It should be a balanced portfolio, whether it is of your investments or whether it is of your borrowings. So that is the case. That is first of all the interest rate. Now, if you will read this entire paragraph, okay, exposure to falling interest rate, exposure to rising interest rate, right? This you can read while keeping this chart open. It will make it very, very, very easy. Now, another risk. This was increase and decrease in the floating risk, the floating rate. That was the risk basically. Now, another risk over here is the gap exposure, that you are not having maturities tied up. Okay, if today, okay, chalo, I will continue. By the way, I was sharing another sheet. Okay, chalo. Now let us continue back over here. Gap risk. We will understand the gap risk. Okay. Whenever my liability is, this is, let us say my liability is expiring at 30th June, and this is a floating rate liability. Floating rate liability. Okay. And there is a floating rate investment. I have kept a floating rate investment also. But now this floating rate investment, okay, floating rate investment is expiring at some another interest rate, is expiring at some another date, let us say 30th July. So over here, there is a gap between the fixed floating rate liability and the floating rate investment. As a result, again, there can be a risk. Okay, like it can be any side. Like if sometimes my investments are expiring, maturing early as compared to my liability, in that case, I am exposed to the increase in the rate of liability. In this particular case, my assets are exposed over here for the risk. So I am afraid if the interest rate will fall after this particular date, it's till this date, I am not afraid of the changes in the interest rate, because I have both liability as well as the asset in the floating interest rate. But as soon as after this date, if the interest rate falls over here, I have the exposure to the floating rate investments for a one entire month. This is known as gap risk. Okay, now moving on. The next, so negative gap is basically arises when the amounts of liabilities maturing at a specific time exceeds the assets maturing simultaneously. Okay, the amount of liabilities maturing at a particular point of time. Okay, this liabilities are expiring early. Okay, maturing early as compared to the assets. This results in a net exposure if the interest rates rise by the time of maturity. Over here, we are afraid that the interest rate will increase. No, in this case, liabilities would have been, this would have been otherwise, like the situation would have been otherwise. if your liabilities are expiring late as compared to liabilities maturing at a specific time exceeds the assets maturing simultaneously, okay, yeah, this result is a net exposure of interest rate lab. Okay, if I talk about a same timeline, okay, both of them are expiring at 30th June. Okay, let us say both of them are expiring at 30th June, but over here I had a liability of $500 million and I had assets worth of $500 million. Okay. But out of this, the liabilities maturing over here on 30th June is, let us say, $300 million. And over here, the assets maturing over here is, let us say, only $200. Okay. In this case, my liabilities are the liabilities mature at a specific time exceeds the assets maturing simultaneously. This result in a net exposure if the interest rates rise by the time of maturity. Acha, okay, they are talking about the quantum of this only. This is 300, this is 200. Over here, this is, in this case, I'm afraid that the interest rate will increase. If this would have been otherwise, assets are more than liabilities, then I'm afraid that the interest rate will decrease. Negative gap, liabilities are more than assets. Positive gap, assets are more than liabilities. Over here, you are afraid of decrease in the interest rate. Over here, you
In
are afraid of
value, right?
in
The
value.
time stays the same.
Time stays the same.
Time
At a
is same.
given
Okay.
and a specific time exceeds. As a specific time, if this exceeds, then this is known as negative gap, and this one is known as positive gap. All right. Chalo. So basis risk, if one of your like your liabilities, whatever liabilities you have, those liabilities, let us say you have taken at SOFR, and your assets, let us say you have taken at Sonia. In that case, you are again exposed to risk over here, variable interest rate, even though both of them are fluctuating interest rate, but they are going to change differently at different interval of time. Okay, they both are not going to change in the same manner. So that is known as basis risk. So there are three types of risks, right? Changing interest rate. One is changing interest rate, one is the gap exposure, and another one is the basis risk. So, internal interest rate risk management. How do we manage the risk? First of all, there are internal techniques. What are the internal techniques? The first internal technique is smoothing. This involves maintaining an appropriate balance between the fixed rate and the floating rate, borrowings or deposits. Okay, you are going to manage a good balance between the two. Okay, either the fixed rate or the floating, between fixed and floating, whether you are doing the borrowings or the deposits. Matching this aims to have a common interest rate for assets and liabilities. Common interest rates for liabilities, which is going to eradicate your basis risk. Now moving on, what is another internal hedging technique? Asset and liability management, the same which we have seen in the Forex. Okay, not only links at an assets and liabilities to the same interest rate, but also it also attempts to match the maturity of assets and the liabilities. Asset and liability management, you are going to have the same maturity for both of them. All right. So over here, balance is also important. Timeline is also important. Both of them should be maturing at the same time period as
This
well.
is gap risk, yeah? ALM
Which
is for
one?
gap risk.
AML
ALM
is
is
for the
for gap risk.
yeah, gap risk. It will eradicate your gap risk.
Okay.
All right. So now moving on, we are going to look at the external techniques. Now for external techniques in interest rate, we have FRA. FRA is basically forward rate agreement, which means you are going to fix a rate with the bank. It is as simple as that. But this structure you need to understand. 39 FRA means it begins in 3 months. After 3 months, you need to borrow after 3 months, and it will be ending after 9 months. It will be ending after 9 months. 3 months from now and ending after 9 months from now, which means you need to borrow for 6 months only. Okay, you will be borrowing it for 6 months only. Moving on, let me just see if there is a question related to it. This one is a question and another one is a question. Chalo, this question let us do quickly. So, Narrow Company's cash flow forecast shows it expects to borrow $2 million from Goodfellows Bank in 4 months for 3 months. In 4 months for 3 months. So, this is a 4-7 FRA. 47 FRA. Why? Because 4 months for 3 months. Just a minute. Okay. So now the company is concerned that the interest rates will have risen by the time the loan is taken out, right? The main reason for entering into the FRA is that right now, whatever is the interest rate, right, you are afraid that that interest rate is going to increase in the future. Okay, the interest rate is 5% and Helpy Bank offers this on the required FRA. You are going to fix this interest rate with the Helpy Bank. So over here, we are solving question number 5. Question number 5. Chalo. So, what is the interest rate as on today? Rate as on today is 5%, and that is exactly the rate which you are fixing with the Helpy Bank. So, you are having a FRA, forward rate agreement, with the Helpy Bank, and apart from this, you are going to borrow from a Goodfellow Bank, another bank which is Goodfellow Bank. From that, you are going to borrow after 4 months. After 4 months for 3 months. Now, what we do is in FRA, we are going to fix a particular rate. So, rate which is fixed over here, rate fixed is 5%. So, after, okay, and determine the cash flows if the interest rate when the loan is taken out is 6.5% and 4%. So, situation number A, we are going to have a look at the cash flows. Cash flows if the interest rate is equal to 6%. Is it 6 or 6.5? 6.5%. So it is going to be 6.5%. So when the interest rate is 6.5%, in that case, what will happen? You will pay a interest. Okay, you will pay a interest to the Goodfellow Bank. What is the amount over here? The amount of the loan is how much? $2 million. So $2 million. $2 million. So what happens over here is this $2 million, on this $2 million, we are going to pay a interest at this particular rate, 6.5%. But at this 6.5%, we are going to multiply it by 3 divided by 12. This is the interest that we are, okay, it is not written over here, 6.5%. All right. IR to remove this. Chalo. 6.5%. So this is the interest that we need to pay. I'm just going to show this as a negative because this is a cash outflow. Now, since we have fixed the interest rate with the Helpy Bank, the Helpy Bank over here is going to give us the set off. Okay, you just write the word set off, that is also fine. It is very easy to calculate the set off. What you need to do is whatever is the rate which is fixed, press F4 minus whatever is the rate given by the whatever is the rate prevailing in the market. Okay, multiply this, like have this in the bracket, close, have this in a bracket. Okay, multiply it whatever is the amount, notional amount, and multiply that with 3 by 12. So this difference is going to be paid. Okay, this set off is going to be given by the Helpy Bank. As a result, the net interest is going to be this minus this. Your net interest is 25,000, which, by the way, have I done something wrong? Let me just see. If the interest rate would have been 5%, in that case, 20 million multiplied by this 3 by 12, 25,000. Okay, so you have fixed, you see, indirectly you have fixed your interest rate expenditure to 25,000. It's just that I will show this as a negative. Okay, and I will show instead of subtracting, I can add over here. The point is that whatever will be the loss over here, if you are suffering a loss, see, you had a loss over it was shown as a negative, right? You had a loss over here, but this loss is going to be set off by the Helpy Bank. You just have to multiply it by minus sign. All right, the calculation is very simple. Whatever is your rate which you have fixed minus the rate prevailing in the market, multiply by the amount, multiplied by the duration, multiplied by -1. That will always be the set off. Now, if you see, if I just change this rate, so this is my net interest, which is, by the way, going to remain fixed. No matter what happens over here, my net interest cost, interest in terms of percentage, will always be this divided by this multiplied by 12 divided by 3 multiplied by -1. You see, 5 percentage only. No matter what happens, it is always going to remain 5 percentage. Even if this, let us say, becomes 4 percentage, then instead of getting the set off, we need to pay the set off. Over here, you are paying an interest of just 20,000 rupees or dollars, but against which you are going to get 5,000 as a set off. You have to pay 5,000 as a set off. So your net interest is technically 25,000, and you have fixed this particular interest rate for yourself. This is why we call this as a forward rate agreement. In the forward rate agreement, you don't have the choice to exercise, right? You have to exercise it, whether it will result in a profit or a loss. Okay, but you are fixing this particular interest for yourself. So that is forward rate agreement. Now, by looking at this, you might think that, sir, I want the benefit over here. If the interest rate becomes 6.5, okay, I want to have the set off so that my interest rate is not exceeding 5 percentage, but when the actual interest rate is 4 percentage, I want to pay only 4 percentage. Okay, I don't want to pay the extra over here that I am paying to the helpy bank. So for that, we have options contract. Options contract are going to give you the right but not the obligation to enter into a particular to have the set off for a particular compensation. So for example, if the rate becomes, if the let us say you are fixing a particular rate of 5 percentage, all right, you are fixing a particular rate of 5 percentage. If the rate becomes 6 percentage, the bank will give you the compensation of 1 percentage. Over here, the bank will pay you 1 percentage. You will receive 1 percentage from the bank. But if the interest rate, let us, you have fixed it 5 percentage, and if the interest rate becomes 4 percentage, then in that case, you don't have to pay anything to the bank. That is where options contract comes into picture. So over here, there are different types. We are going to come back to the interest rate futures, but right now let us discuss options contract. So in interest rate options, this is also just like the insurance. So over here we can have a cap. If you are fixing a cap, if you are having a bottleneck that your interest rate cannot go beyond 5 percentage, right? You are having a cap, you are having a ceiling over here. So if I draw this in a chart, okay, your interest rate is always going to remain within this. It is going to fluctuate within this. It is never going to go up more than 5 percentage. Because if it goes beyond 5 percentage in the market, you will receive a compensation from the option seller. So over here, you have bought a cap. Okay. Then comes the floor. If you are an investor, you are afraid, okay, for an investor, you are afraid that my interest rate should not decrease. Right now, let us say the interest rate in the market is 5 percentage, and you are fixing this particular interest rate with an option seller. As a result, tomorrow, if the market becomes 4 percentage, right, this option seller will give you 1 percentage over here. And as a result, your net interest rate that you are earning from your investment will become 1 percentage. But if the market rate, let us say, becomes 6 percentage, in that case, you don't have to give anything to the option seller. As a result, you will enjoy your interest rate at 6 percentage. This is what you are going to enjoy over here. So that is known as a floor. So if you want to fix a minimum interest rate, then that is known as floor. If you want to fix a maximum interest rate, if you are a borrower, you are going to fix a maximum interest rate, then that is known as a cap. Understood between floor and cap? Clear till here?
So can you repeat it one more time?
Yeah, sure. Sure. Just a minute. I was searching for this put option, call option. Chalo. So if you are a borrower, just look at this. If you are a borrower, all right, and you are afraid that your interest rate will increase. Okay, you are afraid that your interest rate will increase. If your interest rate increases, right, you had a loss over here of 1 percentage, but that loss will be compensated by the option seller. Okay, so your maximum interest rate will always remain as 5 percentage. If the interest rate decreases, if the interest rate becomes 4 percentage, right? You don't have to pay anything to the option seller. Okay, so over here, what will happen? Uh, think this as of negative, 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 negative. All right. Over here, let me just create a table for you. In the case of cap, let us practice some. Let us see different situations for cap. We are talking about the cap. So exercise rate, strike rate, I can say is, let us say 5%. Okay, you have chosen this strike rate. Now market rate is, let us say, 6%. What is the interest that you have to pay? Can you just tell me in this particular situation? Net
I'll
interest
pay
that you are
less
paying.
5%.
Yeah, you will pay less 5%. If let us say the market interest rate is 7%, what will you pay? How much will you
Still
pay?
5%.
Still 5%. Why? Because you are getting a compensation of 2% from your option seller. If the market interest rate is 4%, you will be paying how much?
If the
In
market
the
is,
4%,
then I'll pay 4%.
then you will be paying 4%, because in this case you don't have to pay anything to the option seller. This one is known as put option. You have hedged yourself against the increasing rate of interest. Okay, this is known as a put option. You have fixed a cap for yourself. Now same goes with the floor. In the floor, we have to think from the perspective of the investor. Okay, let us see, you are fixing at a strike price of 5%. All right, over here right now the market interest rate is, let us say, 4%. So you have been given an insurance by the option seller that if the market rate goes below 5%, I will pay you the extra over here. So what is the interest that you will receive in this particular case? Net
5.
5%, right? Because the option seller will give you 1%. If the market interest rate is, let us say, 3%, then what will be the case?
Still 5.
Exactly, right? And if the market interest rate is, let us say, 6%, then how much will you receive? Net.
6.
Exactly. So over here, you are fixing a floor. You are fixing a minimum interest rate for yourself, which is known as a floor. Okay. This is known as a call option. Okay. See, generally, call option, you are protecting yourself from the increase in prices. But when you talk about interest rate, you are protecting, by using the call option, you are protecting against the decreasing interest rate. Put option is protecting you against the increasing interest rate. Okay, so these are the options that you need to buy. Now we are going to talk about collar. So what happens is, this is very nice. Like, we are very happy to have this kind of an arrangement, this kind of an insurance, but we have to pay hefty insurance for this. We have to pay hefty insurance for this. Sorry, premium for this. As a result, what happens that we decide to enter into a collar arrangement, where what we are going to do, we are going to, let us say, we are going to borrow. Okay. So what will happen? I am afraid that my interest rate, let us say, I don't want my interest rate to go beyond 6%, but I am happy, right? It's okay if my interest rate does not go below 4%. Okay. And I know that it will, like, the market interest rates are not going to go below 4%. So what I will do is, I will buy a cap, I will buy a cap and I will sell a floor. As a result, what happens is, what's the benefit over here is that I have to pay the premium over here. I have to pay the premium over here, but I will receive the premium over here. As a result, the premium that you are paying for the collar is the lowest. Premium is going to be lower as compared to floor or cap. And this is the question which you sent me once, right? Collar is going to be the caller is going to have the lowest premium as compared to floor and cap. So what happens over here is, let us say the market interest rate, now we are going to have it over here, and let us say how much we are going to receive, okay, and how much do we have to pay, receive from the option, like from our call option, and how much do we, sorry, put option, and how much we have to pay in our call option which we have sold. This is something which we have sold, this is something which we have bought. Okay, so over here let us say, and over here let us say we have cap of 6 percentage and a floor of 4 percentage. Okay, let us say the market interest rate is 5 percentage. Are you going to receive anything from the option seller from whom you have bought the put? What do you think? Yes, Neha.
Sir, I got confused.
Okay,
Can you
so
repeat the
I'm
question?
okay. Cap is 6 percentage maximum interest rate for yourself. You have arranged this transaction. You have bought the cap. You have sold the floor. Okay, which means you have, yeah, you have sold the call over here, and you have bought the put over here. Okay, which means if the interest rate, if the interest rate, just a minute, put. Chalo, if the interest rate in the market is 5 percentage, the one who has given you the guarantee that I will not let your interest go beyond 6 percentage, is he going to pay you anything over here in this
No,
particular situation? Yes or no?
no, no.
No, right? So he is not going to pay us anything. Do we have to pay anyone anything? We have given him the guarantee that your interest rate will not go below 4 percentage. But right now it is 5 percentage. So that person who has bought the call option from us, he is also happy. He does not need anything over here right now. So we are not going to pay anything to anyone. Okay. So the market interest rate is 5 percentage. Our net interest cost is 5 percentage. This is our cash outflow. Okay. Now let us say the market interest rate is 7 percentage. We have to pay 7 percentage on the loan that we have borrowed actually from the market. We have paid 7 percentage. Are we going to receive any compensation from the person who has given us the cap, from whom we have bought the cap?
1%.
1%, exactly. Chalo, 1% over here. Do we have to pay anything?
No.
No. So my net interest rate is 6 percentage. Right now, again, the same thing. Now let us see, the market interest rate is just 3 percentage. Are we going to receive any compensation?
Can you scroll a bit up?
Yes, sure. Are we going to receive anything over here?
No. But we'll pay
Mm,
1%.
exactly. So over here, my net cost is 4 percentage. All right. Now, if I say the market interest rate is 4 percentage, if the market interest rate is 4 percentage, am I going to receive anything?
Can you scroll up?
Yeah.
It's 4%. No.
No. Do I have to
I
pay
have
anything?
pay all. No.
No. So what is the net interest rate? Net interest rate is 4 percentage. This is negative, not positive. All right. So in this particular case, you can see, now I'm just drawing it over here. Let us say the uh, market interest rate is, let us say, 6 percentage. In this case, am I going to receive anything? Any compensation?
No. No.
No. Do we have to pay anything?
No.
right? So in this case also, my net interest exposure is 6%. So in any case, in any random assumption, let us say the interest rate becomes 10%. All right, this is a wild assumption that the market interest rate is 10%. Are we going to receive any compensation?
4%.
4%. Do we have to pay anything?
No.
No. So what is our net exposure? 6%. Right. So in any particular case, because we have what we have done over here, we have a collar over here, which means our maximum interest rate is 6%. This is a cap for us, and our minimum interest rate is going to be 4%. This is the floor for us. Okay. We have bought a collar, sorry, we have bought a cap and we have sold a floor. You can do it otherwise as well. You can sell a floor and bought a cap. That doesn't matter. Okay. So over here, no, you cannot sell a floor. Selling a floor, which means guaranteeing someone. So that is, yeah, you can do that as well. Doesn't matter. Okay. Now coming back to this example, one more question, one more thing let us do. Let us say the interest rate is 2%. Okay, in the market. Are we going to receive anything?
No.
No. Are we going to pay anything?
2%.
2%. So our net exposure is minus 4%. So at any given point of time, it is never going to go below 4%. It is never going to go above 6%. So this is known as a collar. We are our interest rate is going to be always between this range only. And over here in,
Borrowers will
sorry,
borrowers buy a call option, right?
yeah, borrowers buy a put option. Borrowers buy a put option and sells a call option.
Buys a put option.
Hmm. Can set a maximum on the interest rate they have to pay by buying a put option, and depositors can set a minimum on the interest rate they receive by buying a call option. And over here in the floor, if you see, a borrower would buy a cap and sell a floor, thereby offsetting the cost of buying a cap against premium received by saying, and depositor will do otherwise, would buy a floor and sell a cap.
Got it.
Okay. Now we are moving forward to the interest rate swaps. So last thing is interest rate swaps. Over here, this is the last technique, interest rate swaps. So see, this is a person A, this is a person B. Over here, if he goes to the bank, okay, let us say right now he is having a floating interest, or let us say he is not having a floating interest. Okay, chalo, let us assume a simple case. He's having a floating interest rate loan. Okay, he's having a floating interest rate loan, and this person is already having a fixed interest rate loan. He believes that the interest rates are going to increase in the future. Okay, and he believes that the interest rates are going to decrease in the future, right? So he is afraid that the cost can be lower in the future. My cost could have been lower, but my interest rate is fixed. I am stuck with, let us say, 5%. Right now this person is also paying 5%, but he is afraid that the interest rate is going to increase and it is going to become 6%, and he is afraid that it was going to become 4%. So what they can do is they can swap their principal, right? They can swap their loans. Now onwards, I will pay the fixed interest rate of 5%, okay, no matter what is going to happen in the future, and he is going to pay the floating interest rate. In this way, the person who is able to, whatsoever was your risk, you can hedge that particular risk. If the interest rate actually decreases, this person is going to suffer a loss because he could have paid 4% interest, but now he is fixed at 5%. If the interest rate actually increases, this person is going to suffer a loss because he could have paid at fixed 5%, but now he will be paying at a higher interest rate. That is known as interest rate swapping. Okay. exchange between two parties of interest obligations or receipts in the same currency or an agreed amount of notional principal for an agreed period. So with this, our entire syllabus is over.